calling it right now. The question is whether it's warranted, and if it is, what we're supposed to think about it.
Yeah, I mean, I've never seen such a big disconnect between perception versus what's happening on the ground. So on the ground, we're seeing not elevated defaults. We're still getting very wide spreads. Our companies are performing relatively well. And so obviously there may be prospective issues down the road, but what's being priced in today is not reflective of what's happening.
Is part of the problem that we have these sort of semi-liquid instruments that have been created that sort of create this, allow for this? Frankly, I mean, look, you could just have a classic private credit fund and you're locked in.
Right, so we at BC Partners don't have semi-liquid products, so that obviously protects us. But generally speaking, you know, that structure is set up in a way that you don't have, you know, quote unquote, run on the banks, or you don't have people having to fire sell good assets.
But do you think that the product itself makes sense? Because the truth is, you have, you know, liquidity is available to you typically when you don't want it, and when you want it, it's not available to you.
I mean, I think generally speaking, the product does make sense, because in most market environments, people are able to satisfy their redemptions. And so I think generally speaking, you know, it does make sense.
Does the customer make sense? The Wall Street Journal has a story on the front page today that just kind of points at the idea that all these firms have been chasing retail investors, that that's where the growth was going to come from. But those retail investors get nervous, and maybe it's harder to convince them to stay in, because when they see somebody wants to take their money out, they follow that same path. Is the retail customer there?
Stop stereotyping us.
Growth, let's say in the next couple of years. One of the people they quoted in this story saying there's not going to be a single fund manager.
You wanted us in jail.
Into this for some time to come.
Yeah, I think it makes sense for retail. I mean, retail's still very.
What about AI?
This makes sense in a lot of people's portfolios. And I think that, you know, if you look at returns and a place to get yield in an environment that's hard to get yield, it's a good asset class to get yield.
Do you agree with that quote, though, that retail investors are not going to get put into these funds for some kind?
No, you're full of shit.
Play out, right?
I think the retail channel will be challenged fundraising-wise for some period of time, given what's happening. So I agree with you.
Can I ask you a slightly different question, just about the instrument, and then I want to get into actually the details of private credit itself. I've always thought that the product works.
Retail traders
but
ain't
works in a
smart
slightly
enough,
different way, and that I think regulators will ultimately do this anyway. That a semi-liquid product like this should be effectively attached
Calm down, Jim.
to
It's gonna be a good day.
funds in the retirement space. Insofar as if you're in your 20s, 30s, 40s, 50s, you could be, you know, have a decent percentage of your of a fund in that. But as you get older and may need the money, then it would tail off. Meaning you'd actually create a product that's actually set up to do that, as opposed to what's happening now.
Yeah, I think, listen, I mean, this product's going to evolve over time, and I think what you're talking about is going to come into our space. I mean, our space is still relatively nascent.
Hello.
And we're institutionalizing it. And
Hello. Hello. Hello.
Even if you're not seeing these defaults, the question is whether you believe the marks, meaning the valuations that these private equity firms have put on these businesses, which are not in the public markets, are accurate.
yes, we get asked a lot about that. I mean, our marks, so I'll just speak about our industry. You know, we go through third-party valuation firms, we have auditors, we have public companies that we put these things through. So it's not like we could just value these things where we want to value them. So there's a pretty rigorous valuation process that goes on throughout private credit.
How often does that take place? Like revaluing on a daily basis, monthly? What are we talking about?
For us, because we do it quarterly. For the retail funds, they have to do it daily because they're taking in daily subscriptions.
Right.
My understanding is a little more complicated than what you just described. there is a lot of discretion provided to the funds. And if you actually go through the materials for a lot of these funds, the amount of discretion that they have, even over what the ultimate valuation is high. Do you disagree with that?
I disagree.
I think it depends on where the product is held. So if it's in private funds, you have a little more discretion. If it's in any kind of 40 Act or SEC regulated vehicle, you have a lot more scrutiny on valuations.
Okay. Ted, thank you for coming in. Appreciate it.
Looks like 66916
just
is
past
coming
7 a.m.
in.
On the East Coast right now. You're watching Squawk Box on this Friday morning. I'm Andrew Ross Sorkin along with Becky Quick. Joe is off
Becky.
today. A lot going on. U.S. Central Command saying 4 of 6 crew members now have died following the crash of a KC-135 refueling aircraft in western Iraq. That
Becky
tanker
Quick.
was supporting operations against Iran, according to Central Command. The crash wasn't due to hostile or friendly fire. It says the cause of the crash is under investigation. And the United States has temporarily authorized the purchase of Russian oil stranded at sea to help stabilize energy markets. Treasury Secretary Bessent describing it as a narrowly tailored short-term measure that applies only to oil already in transit. Bessent saying the move would not provide significant benefit to the Russian government. Still, officials in Europe, including their German chancellor, speaking out now against this move this morning. The price of crude right now, you can take a look at 93.79. And the Treasury Secretary did, in the interview with our colleague, Wilfred Frost, for his Master of Investor podcast yesterday. During that interview, Bessent said he believes as soon as it is militarily possible, the U.S. Navy, perhaps with an international coalition, will escort vessels through the Strait of Hormuz. The interview was interrupted for 2 hours when Bessent was called to the Situation Room. Take a look.
I listened to you on the.
The president wants you. Sorry, the president wants you for everybody.
Oh, okay. Okay. No problem at all. See you shortly, Mr. Secretary. You can work that in. Mr. Secretary, I have to say, it's a first, I'm sure, a loss as well, that an interviewee's been pulled away to go to the Situation Room. How was the president? Was he stressed?
No, the president is in great spirits. The Iranian mission is proceeding well ahead of schedule. And I have to tell you, Wolf, that I have a teenager who's considering military service. And I could give this team my highest compliment, from President Trump to the head of the Joint Chiefs to the Secretary of War. I would say that I would trust my child's life in their hands.
During that interview, Secretary Bessent also mentioned that the war has so far cost the U.S. around $11 billion. You can put that on the current price tag.
In the meantime, the U.S. launching new trade investigations into 60 countries to establish whether they've failed to curb imports of goods that were made with forced labor. The so-called Section 301B probes will look into China, the EU, India, and Mexico, among other nations. That announcement came a day after other Section 301 probes were launched, and we'll be speaking with U.S. Trade Representative Jamison Greer. That's coming up at 7:30 a.m. Eastern Time. Let's take a look another look at the futures this morning. They're continuing to climb. When we started the show just over an hour ago, the Dow was flat. The S&P and the NASDAQ were both in negative territory. Now you've got the Dow up by about 170 points. S&P futures up by 21, the NASDAQ up by 78, although it does come after a down day for the markets where all three of the major averages were down by about 1.5%. Check out what's happening with Treasury yields this morning. Right now, the 10-year is slightly lower, but if you've been looking over the course of the last week, it's moved up pretty drastically. 4.25 for the 10-year. The 2-year is at 3.72. And we are awaiting a data deluge that's coming at 8:30 a.m. Eastern Time. That includes the Fed's preferred inflation indicator. In the meantime, economists are trying to continue to game out the changing economic landscape from the oil price surge. Our senior economics reporter, Steve Leisman, is here. This is something to try and figure out. Already this morning, we did see Brent above $100 again.
And it's a moving target. We'll get a look, Becky, at the economy that was, and that's before the attack on Iran, and that comes at 8:30. But the impact of an historic oil price increase is seeping into the forecast even before the old data come in. So here's what we got at 8:30. We got GDP coming in. I mean, get that muted number in part from the government shutdown, and then some delayed data, personal income and spending up a half a point. Estimated consumer spending up 0.3. Headline PCE 2.9, and there's your problem there. Your core PCE going into this issue of higher inflation from oil prices elevated at 3.1%. All that will help fine-tune the baseline for the outlook that is riddled with uncertainty over how high oil will go and for how long. There's general agreement. Several factors will cushion this blow for a while. The United States is less import dependent. The United States uses less oil than it used to for growth. Consumer spending on gas has been declining. Nancy Lazar from Piper Sandler writes, unless $100 plus oil prices are sustained for many months, the impacts to core inflation and GDP are likely to be surprisingly modest. She points out that consumer spending on energy has fallen from 4.5% in 1990 during the Gulf War, just 3% today. Forecasts an average 0.3% hit to spending overall. You can see, though, look at this chart, it's negligible for the wealthiest Americans, but a 10% increase in the price of oil is much more substantial for those with lower incomes. They're going to be hardest hit from high gas prices. Oxford economists saying higher inflation will weigh on households' real disposable incomes, but we expect a smaller hit to spending because households typically tap into their savings during a temporary income shock. Most of the downgrades I've seen so far shaved a few tenths off GDP, but adding as much as a full percentage point to the inflation outlook. Most expect these trends to stop the Fed dead in its tracks from cutting and only resume if it's clear that the oil price shock is passing through the economy without spreading, or the other side is doing serious damage to jobs and to growth.
Okay, so I heard something weird yesterday where it's like, oh, this oil shock is going to put the Fed on hold, and they're not going to do anything until the economy collapses, and then they're going to be rushing to race by cutting rates.
I don't think it's that weird.
Well, it is and it isn't. Like, okay, we don't want to lower rates. We definitely don't want to lower rates. But we do think that this oil price spike is going to be damaging enough to bring the economy to its knees. It's just the case of the Fed having to wait till they see the whites of its eyes.
I think that's right. Otherwise, you have this situation where, make yourself Fed chair.
Yeah.
I have a 3.1% above target inflation rate now.
Right.
I got an oil price surge coming. I've already looked through tariffs. You have small kids, Becky, you remember.
Well, we can't do anything until, but the way the analyst described it was, and then they'll have to cut very rapidly because they'll be behind the curve. I don't know that we want the Fed to be predictive and making guesses because I'm not sure that anybody's all that good at doing it. So maybe this is the best thing to have happen.
Okay, so what you're saying then
no,
is...
I'm not suggesting they should
I'm just throwing it back at you.
Funny.
We're just talking.
Yeah.
That you're saying the Fed should preemptively cut ahead of the potential for oil.
No, that's what I mean. I'm not saying that they should be predictive.
Right,
I don't know that anybody's very good at being predictive, but it is a strange thing to consider. I guess the inclination I would have is, should we look at this as the market differently? That if the Fed cuts any more, it's not because they have the freedom to or the ability to, but because their hand is forced because they worry the economy is going to be in big trouble.
It's unfortunate they'll have to. But remember those three elements I put up. We're less oil dependent.
Yeah.
We don't need oil. We produce a whole lot of our oil. What's going to happen, if you look at that chart I showed, the impact on lower income, this is a massive redistribution. I did some math on this, but if you add $36 a barrel, which we just did, times 13 million barrels, which we produce here, you're just shoveling money to the oil producers, to the shareholders. So it's a
the oil stocks have responded in kind.
It's a poor to rich redistribution inside the country.
Yeah.
Now tell me what the oil companies do with it. There is some thinking on the Fed staff that basically you have, there's that chart again, and that's just for a 10% increase, right? And it's already more like 30.
How long does it have to last? It could be increase in order for that to play out to get a 1% inflation.
That would be some form of sustain for several months if you had that kind of oil price for it. Yeah. And then you have the other thing, which Oxford I think is a very important economic concept, which is the notion of the extent to which consumers use savings or other means to smooth over their lifestyles when they think something is temporary, right? That's really the key, that you think it's going away. So a few things. First of all, if consumers, they use less oil and their amount that they spend on energy is lower, the amount that they get pissed off by energy is much higher. And the idea that, that oil and gas are a leading political element is a huge, and feelings about the sentiment on the economy, it's all about oil and gas.
Yeah, that is.
All right, Governor Quick, I'm going to take
But
your
now you're
ideas
gonna
under
get- now you're
advisement. I'm
getting
going to
into
make some
the politics of
policy.
it, the politics of it, and that's even more.
That's huge, and the Fed will be influenced by that too.
Steve, thank you.
Pleasure.
And
Can't
we'll
wait for
see you in
this.
a little bit with all the data.
Maybe Mr. Greer will solve all this stuff at 7:30, and then we'll see you at 8:30 with the data.
All right, when we come back, the major averages in the red so far this month. The S&P is off by 3% for the month, the NASDAQ down by 1.5%, and the Dow is off by nearly 5%. Bill Nygren of Harris Oakmark Funds will tell us why he thinks the war in the Middle East isn't going to change his view on the markets. Squawk Box will be right back. Welcome back, everybody. The futures have turned around this morning. We are seeing green arrows across the board with the Dow up by about 125 points. S&P futures up by 16, the NASDAQ up by 60. Again, it doesn't make up for the losses we saw yesterday or what we've seen this week or this month. But joining us right now is Bill Nygren. He is partner, portfolio manager, and U.S. investment officer of Harris Oakmark Funds. And Bill, every person who comes in is talking about the war, the spike that we've seen in oil, so many other things trying to reconfigure how they view the market. You're saying you're looking right through all of that. You basically consider it noise.
Right, that's what we've always done at Oakmark. We try to identify securities that we think are cheap based on an outlook 5 to 7 years from now. And even something as important as this war, probably isn't on the radar a year from now. Maybe it affects 1 year cash flows, especially for the oil companies. But for the most part, I don't think it really changes long-term business values. And something we've looked at Oakmark, this is our 35th anniversary year. Mm-hmm. And a few times in communications to shareholders, we've listed each year, what was the thing the market was most worried about? And it's a pretty compelling list when you think about it. We've had COVID and swine flu and bird flu. We've had great financial crisis, a couple wars in the Middle East, a couple wars in Ukraine. The market's up 35-fold during those 35 years. And by being longer term focused, we've been able to almost double that. So I just don't think it pays to try and figure out when those brief moments are you don't want to be invested.
I would guess, based on that kind of outlook, that you're more worried about PE ratios or where stocks are trading, what valuations are at this point.
Absolutely. I think investors in the past decade have been trained to try to identify good companies and just buy them. Don't worry about the price. And again, at Oakmark, we're focused first on price because the price you pay determines how good the outlook has to be for the investment to be successful. There are companies that are really good companies that at 25 times earnings might not be a good investment, and companies that aren't nearly as good that are at 5 times earnings that could be great investments.
Does that mean you ignore where the overall markets are too? Because my question would be do you think valuations are stretched here? We're not at the all-time highs that we were, but we're not even in correction territory for any of the major averages.
I mean, largely we're bottom-up focused, so individual companies. But I think, you hear people say the S&P 500 is averaged like 17 times earnings, and we're at 23 times now, so it's stretched. I think the other side of that is 10 years ago, the S&P was expected to grow at maybe 8% a year, and now it's expected to grow at like 11%. So it's being priced like the growth fund that it has really become.
Sure. I think you have to have pretty strong conviction to have some of the stocks you like, given what's happening with oil prices. One of the stocks you like is Delta. And with oil prices skyrocketing, people are looking around and thinking, uh-oh, what does this mean for airlines and other companies where fuel is such an important input?
Sure. Remember that just a month ago or so, Delta was selling at 72, not 55, like it is today, 58. It's a company that a while ago people thought they'd earn $8 this year. Maybe now it's $6.5. But the futures price of oil, even though it's at $100 now, it's into the 70s before the end of the year. It's under 70 by middle of next year. So this will be a one-year hit to Delta cash flow. And if prices are, as the futures market suggests, kind of back to normal expectations middle of next year.
Is this a recent purchase of yours? Is this something you like recently because the stock came from the 70s down to the 50s?
We have owned Delta for several years, but because it is such a volatile stock, our weightings have changed pretty dramatically. We own more of it today than we did at the beginning of the year.
Warner Brothers Discovery used to be a top holding for you. I don't know if it still is. I know that back in January, you told David Faber that you were more in favor of a Netflix deal than the P-Sky deal that actually went through. How do you feel about it now that it's kind of gone this way and we see that P-Sky is going to be?
Well, it's not that we favored Netflix as a buyer over P-Sky. It was the bids that were on the table at the time. We thought the Netflix bid was superior. Mm-hmm. Given how P-Sky increased their bid, we very much in favor of the way the board handled this. They basically ran an effective auction and the highest bidder won. And as shareholders, that's what we always want.
Is it still a large position for you?
It's still a position. It's not nearly as large, but basically at this point, we consider it over and think this is something the arbitrageurs should be dealing with.
I've got a more complicated one for you on this particular transaction. There's a view among some, including, by the way, people on the board of that company, this is Warner Brothers Discovery, who thought that ultimately Netflix in a certain way would have been a better buyer because there wouldn't have been nearly the kind of debt service that would be required, so that the company long-term
but he sold his stock.
I understand. No, I understand. May have had an easier time. Yeah. Meaning, I think invariably, we can almost say factually, empirically, it will be more challenging for Paramount to make this work than it would have been for Netflix to make this work. I think we could agree on that. Maybe, maybe not. Yeah. But if you don't agree on that, I'd love you to tell me why. But even beyond that, as a shareholder, how are you supposed to think about that?
And would you have sold as much if Netflix was the buyer?
If once they had decided on a deal and it was over, we would have sold as much.
So you were out no matter what.
You were just playing the arbitrage. You didn't want to arbitrage.
We weren't playing the arbitrage at all. We were a purchaser of Warner Brothers shortly after the Time Warner acquisition, the Time Warner acquisition was announced. The stock was in the very low teens. It was a crazy ride to get to almost 30. Right. But I think the board's duty is to get the highest price deal that they think has the highest probability of closing, and that's exactly what this board
But do you think that's all they should be? I think the question, this is why to me it's sort of an interesting philosophical question. Should that be the only duty? And the reason I ask is, if, God forbid, and by the way, I hope great success for the Paramount deal with Time Warner, if, God forbid, in a couple years it is clear that it didn't work, and by the way, Time Warner has been a hot potato for a long time now, where it hasn't always worked. Would you say to yourself as a shareholder, maybe we should have taken the other one? I just wonder how you think about that.
No, would not. You
wouldn't second guess it at all.
Not at all. The board's responsibility is to be a representative of the shareholders and to do what's best for the shareholders. And this deal was superior to the other one. What happens 2 years, 5 years, 10 years from now, that's not the board's issue.
Bill, thank you for coming in. Like I said, it's been a long time. Come back again soon.
Thank you.
Appreciate it.
Coming up right after this, Democratic lawmakers introducing new legislation that would cut taxes for millions of Americans, but it would mean a tax hike for wealthy earners. Robert Frank's going to be here to break it all down. Do not go anywhere. We'll dig into all of it after this.
Time now for today's AFLAC trivia question. What is the maximum number of Friday the 13th that can occur in a single year? The answer when Squawk Box returns. Now the answer to today's AFLAC trivia question. What is the maximum number of Friday the 13th that can occur in a single year? The answer? 3. Months that have a Friday the 13th always begin on a Sunday.
Welcome back to Squawk Box. A group of Senate Democrats coming up with another plan to extract more taxes from the wealthy while giving millions, or millionaires maybe, a tax break. Joining us right now is Robert Frank with more of today's edition of the Inside Wealth. What's happening here?
Well, Andrew, it's really a sort of two-sided process here. The proposal is called the Working Americans Tax Cut Act, but it is also a large tax hike on high earners. So a group of Democratic senators proposing tax legislation that would exempt millions of Americans from taxes. Any income up to $46,000 for individuals or $92,000 for couples would not be subject to any federal income taxes. But to pay for that, taxpayers making more than $1 million a year would get progressive tax hikes. So that's about 1 million taxpayers who would see a tax increase. Those making between $1 to $2 million would pay an extra 5% for a top rate of 42%. The rate goes up, so those making more than $5 million would have a top federal rate of 59%. So for someone in New York City making more than $5 million a year, the top combined state, city, and federal rate would be over 73%. And since Joe's not here and he's going to ask, New Jersey taxpayers, those who make more than $1 million a year, the combined state and federal rate would be over 69%. Democrats have made tax hikes on the wealthy a central policy this year. Washington State is poised to pass its first ever income tax. Taxpayers making more than $1 million a year would pay a state rate of 9.9%. It was just passed by the Washington State House after a 24-hour debate. Interestingly, during that debate, as we mentioned here on the show Wednesday, Starbucks founder Howard Schultz announced on LinkedIn that he's leaving Seattle, moving to Miami after 44 years. The longtime Democratic donor didn't cite taxes as the reason, but he said, quote, "It is our hope that Washington State will remain a place for business and entrepreneurs to thrive." Now, for more on the wealth proposals and what's happening in the tax world for the wealthy, go to cnbc.com/InsideWealth. Sign up for that newsletter.
Okay, you did the numbers, and the massive hike that's going to be faced with this. It's a group of Democratic senators who have come up with this. How many senators? How much support does it have? How much likelihood of passing?
Zero likelihood of passing. It's at least a half dozen senators. What's interesting about this and what's notable is that it's sort of a preview of what the Democrats are really energized about.
And what they will run on.
What they will run on and what they will want to do if they take over the House, if, slimmer chance they get the Senate. But this is really, they're looking for a message right now. And the message is not just we're going to raise taxes on the wealthy, because that hasn't worked in the past. What's different this time is just saying we're going to raise taxes on the wealthy and give tax cuts for everyone else. That is going to be harder for people to vote against, because the Republicans are then going to be in a position to say, wait, why are you voting against a tax cut for 60% of Americans?
Right.
Whereas before,
becomes,
before they could just say, well, they're saying they're raising taxes on the wealthy, but they're actually going to raise them on everyone else eventually, or it's actually going to spill out. And now it's harder to make that argument when what this proposal does is we're going to tax the wealthy and give everyone else giant government checks.
How hard is it to eventually stop a populist argument against that, where it's the numbers are in their favor? Like, if you're voting for your own pocketbook, this is going to get more votes.
Well, I mean, taxing the wealthy is broadly popular in both parties because, again, most people aren't in that million dollar plus income group. But it faces tremendous opposition from lobbyists and from people that support Congress people, the big donors. This, I think, will just add to that pressure. It'll be interesting to see whether, it's going to be harder to stop this time.
Who are the senators? Are they the names I would expect?
Van Hollen is a lead one. Senator Booker is another lead legislator. So it's a lot of the Democratic leaders. Interestingly, it's not Chuck Schumer. It's
Elizabeth Warren.
Warren is not on the list. She is, I think more in the wealth tax category, and that's something we're seeing in California right now. I don't think she's on it. But so these are traditionally, I wouldn't say moderates, but not the Bernie Sanders, Elizabeth Warren wing, which is still advocating a wealth tax. And that's something I guarantee we're going to see come up again, regardless of what happens in California.
You got an update for us on the sort of Howard Schultz move to Miami? What's happening in Seattle? Last time I saw you, we were discussing.
So yeah, Washington State, the House, as I mentioned, they passed that legislation. It'll now go to the governor.
Right.
And it's likely
Do you have
to
to
pass.
get out of the state now ahead of that? Is that how this works?
It takes effect, I think, in 2028 or 2029. So unlike California, where it was retroactive and you already had to move by the time most people found out about it, Seattle, you'll have plenty of time to leave because it's at least 2 years from now that it'll actually take effect.
Which will probably, therefore, limit the legal challenges. Not just the challenge. I'm sure it'll be challenged, but might make.
But the big challenge for California is the retroactive aspect of it. Right.
I still think there is already Republicans in the state of Washington have said this is not constitutional because the state forbids an income tax. This is the state's first income tax, and that this comes after a long ago court ruling that ruled that income tax in Washington State was not constitutional according to the state constitution. So regardless, even though they did leave this generous timeline, it will be challenged.
Okay. Robert Frank, thank you.
Thank you, guys.
Good to see you. Coming up on the other side of this, U.S. Trade Representative Jameson Greer is going to join us ahead of his weekend meeting with the Chinese, which just got more interesting with the launch of new investigations of forced labor practices, part of the potential new way to put tariffs on. Squawk Box, come right back. Welcome back to Squawk Box. U.S. Secretary of the Treasury, Scott Bessent, and United States Trade Representative Jameson Greer are heading to Paris tomorrow to meet with Chinese officials, the meeting coming ahead of President Trump's expected trip to Beijing. And a new wave of Section 301 investigations. Joining us right now is Ambassador Jameson Greer. Good morning to you. Let's start with this meeting, and then we can get into tariffs and everything else. What are you hoping to achieve at this meeting?
It's good to be with you this morning. Like a lot of our meetings we've had with the Chinese over the past year, we want to ensure continued stability in the U.S.-China relationship. It's one of the most important economic relationships in the world. We want to make sure that we continue to get the rare earths we need for our manufacturing base, that they keep buying the kinds of things they should be buying from us, and that the leaders have a chance to get together and make sure that the relationship's going the way we want it to go.
Where do you think that relationship is, given that it's one of the few countries, unlike the others that actually had reached deals on tariffs, they've never reached one? And how does the conversation change given the situation in Iran?
Well, when you look at where we are with China versus 1 year ago, we have a much more balanced relationship with China. I've been saying for a year, where do we want to be with China? We want relations to be stable. We want our trade to be more balanced. We want it to be a non-sensitive goods. And so our trade deficit with China in goods has gone down by 30% over the past year, 3-0. That's a big change. Our imports from China in January were the lowest they've been since 2004. And again, that's not to say we're not going to trade with China. We certainly are, but it's getting to a much more balanced situation.
Can we discuss, though, this situation with Iran? Because clearly that's weighing on our markets, it's weighing on the price of oil, and by the way, weighing on their economy as well.
It is. So when it comes to energy and the effect of the Iran war, it doesn't so much affect U.S.-China economic relations directly between us. Obviously, China relies on oil from Iran. The United States, we're a huge producer of both oil and LNG, but we do export and import a lot. We're a net exporter, but we do import a lot, and we refine here. We import refined products as well. I think what you want to look is what are the feedstocks doing in China, because some of these hydrocarbons go into the plastics industry, the chemicals industry in China. I think we're more resilient on that front because we have a lot of domestic feedstocks and hydrocarbons. So we'll be watching how that might affect the Chinese economy and their ability to produce at the huge volumes they've been producing over the past several years.
What is your expectation for how quickly this war in Iran is going to end? And if it doesn't, what do you think the global impact is going to be?
Well, I think that we're talking in terms of weeks, right? When I speak with Secretary Hegseth or the president or others, they're much closer to it. But obviously, you can't talk about trade without the Iran war coming up and the effect of oil and gas and what that means. I think we're talking about a matter of weeks. Our expectation is that any effects we see will be short-lived. But we want to watch this, right? You could see other effects that affect cycles that we tend to see in commodity markets. So we're watching it very closely, especially in if there are particular spikes or if there are areas where we think we have more resilience.
Which piece of this so far was not on your bingo card in terms of expectations? And I only ask this because I think when the attack was first made, there was a sense that this was going to end very quickly. I don't want to say it was going to be a cakewalk, but I think there was a view that it would be something more akin to that, and it clearly is getting more complicated rather than less, despite whatever successes we seem to be having.
Well, I don't work in the Pentagon. I used to serve in the military many years ago, but all I know is the Pentagon for years and decades has been planning for these kinds of contingencies. We saw the president and his security team execute historic victories in Venezuela. We saw what they did with Iran and the Fordo site last year. I have full confidence in the team that they've planned out all the different scenarios, not just the military scenarios, also the economic scenarios. Again, I think that they're looking at a matter of weeks. When I talk to the secretary, we talk about their levels of missile launches and drones. All that has gone down by 80, 90%. There's a finite amount of ordnance over there that the Iranians have, and Pete and others are in a better position to talk to you about it. But that's how it looks from my perspective.
Ambassador Greer, there was a court filing where a Customs and Borders Protection official said that the government is somewhere between 40 and 80% towards building a system to refund the more than $165 billion that in tariffs that were collected that were then ruled illegal by the Supreme Court. They said that they expect that system to be up and running by the middle of next month. They have an online claim portal where I guess importers and brokers will submit their requests for refunds along with interest. Is there a chance that U.S. taxpayers will lose money on the tariffs that were instituted to try and bring money in if we are paying back those very tariffs with interest?
Well, remember, Democratic attorneys general, they argued for these cases. They asked for the money to go back to companies that were importing goods. That was their ask to the court, and they got their wish, was to take money from the U.S. Treasury that could have been used to pay down the debt or other things and give it back to companies who import foreign goods made by foreign workers. So first of all, there is money going out of the Treasury, or that could, and it's because Democratic attorneys general wanted that. Interest payments, those are par for the course if that happens. Anytime the government has to refund money or anything like that, there's always some kind of interest associated with it.
But it's U.S. taxpayer dollars that would be used to fund the interest if that's the case.
Well, I don't know where Treasury is going to have that. I don't know where they pay the interest funds out. I'll talk to Scott. The point is that the attorneys general of Democratic states, they wanted this money to go back to companies who are importing foreign goods, and they got their wish.
Ambassador, would you and the administration encourage companies that had higher costs during this period to seek refunds, that paid tariffs to seek refunds? And I ask because I've talked to a number of CEOs who have thus far been holding off seeking those refunds, worried potentially about the possibility for retribution for seeking such a thing.
Well, if I were these companies and somehow they get this windfall, the most important thing and the smartest thing they should do is give it as bonuses to their workers. The whole reason the president imposed these tariffs was to try to reshore, to fix our massive imbalance in trade that we've experienced over many years because of China, Vietnam, the EU, and others. If the companies are going to get this windfall, they should pass it along to their workers as a bonus or a raise, because that's the purpose of the program. It's always been the purpose of the program, and the American people should get it, and the companies should give it to their workers.
In terms of the next stage of these tariffs, 301 and otherwise, these investigations that are taking place, how quickly do you think those investigations take place? What kind of reports need to come out of them, and then how quickly can those tariffs be implemented?
So the Section 3 program, these are the types of investigations that USTR, my agency, has done in the past. They're very process-driven, they're transparent, there's an opportunity for hearing, for public comment, and then we typically produce some findings. It could be in the form of a report or otherwise. And if we find that countries have been involved in unfair trading practices like subsidies, excess capacity, allowing goods made with forced labor into their countries, we can quantify that harm to U.S. commerce and then try to resolve that issue with the country. If they can't resolve it or don't resolve it sufficiently, you can impose a tariff or fee or something like that. We're trying to move very quickly to your question. We're trying to move in a matter of months. And with that, we can try to resolve some of these issues that have been plaguing the global trading system for many years, and we're finally trying to solve.
Ambassador Greer, I want to thank you for joining us this morning, as always, and wish you luck in your meetings in Paris.
Thanks so much. Have a good one.
Thanks. You too.
All right, when we come back, stocks on the move, including a sector directly impacted by the war in the Middle East. Squawk Box will be back in just a moment.
morning, everybody. Welcome back to Squawk Box. I'm Contessa Brewer with your Money Movers this morning. Let's take a look at shares of Ulta Beauty. We're watching them sink almost 7% now after reporting earnings below analyst expectations. Look, the midpoint of its full year profit outlook just fell short. Higher costs are dragging down the margins. On the earnings call, the CEO warned that these global conflicts could affect economic conditions. Shares, though, are still up about 80% this year. Fertilizer stocks mostly higher again as the Strait of Hormuz remains closed, and that disrupts global shipments. Investors are betting that domestic makers like CF Industries, you can see it's down fractionally, Mosaic and Nutrien are going to take market share while Middle East output is blocked. We're seeing Nutrien up 1.33% this morning, but on the week, Mosaic and CF are up about 20%, so they've truly moved higher. Nutrien up about 12%. We're going to finish with a check of shares of Once Upon a Farm. It's plunged now 14%. Jennifer Garner founded this snack maker, and these were the first results that they reported as a public company. Revenue roughly in line with estimates, but here was the problem. Forecast was for slowing sales growth for 2026. Those shares are down now 14% in the pre-market and down about 6% from its IPO. Becky?
Contessa, thank you very much. That's Contessa Brewer. Meantime, we still have much more ahead on Squawk Box, including a different look at a current spat between the Pentagon and Anthropic and how it could be helping China in the AI race. And the markets will have several major economic reports to absorb at 8:30 a.m. Eastern Time, including more inflation data. Squawk Box will be right back.
When we come back, spring break travel being greeted by long security lines. TSA workers missing their first paycheck with no end in sight in the DHS funding battle. We're going to talk to former Department of Homeland Security Secretary Jay Johnson about the situation impacting the nation's travel economy. Don't go anywhere. Squawk Box coming right back.
Welcome back, everybody. TSA officers are set to miss their first full paycheck today as the Senate clashes over funding for the DHS bill. Staffing shortages are already leading to long security lines at many airports, with some wait times stretching for hours, in some cases 3 to 4 hours last weekend. Joining us right now is the former Department of Homeland Security Secretary Jay Johnson. And Mr. Secretary, thank you for being with us this morning.
Good morning.
I think it's hard to think about this without thinking about the real impact on the workers who are not being paid for the third time this year. They didn't receive a full paycheck on the 28th of February. Now they're going to miss the entire paycheck. And I heard stories at SeaTac and other airports where they are actually asking people to come with non-perishable foods, with toothpaste and other items that these workers might be able to use because they can't afford them at this point.
Your average TSO, we're talking about aviation security. There's the matter of long lines, but there's also simply the matter of aviation security. These are the people we depend upon to look for bombs and explosive devices on the airplane you're about to get on with your family. They live paycheck to paycheck when they're getting paid. Morale traditionally in TSA is low, and now we're forcing them to go to work without being paid at all. And it puts the agency and its workers under a tremendous amount of stress at a time when there is no doubt a heightened security environment because we've gone to war against a nation that is a state sponsor of terrorism. There were apparently 2 terrorist attacks here in the homeland just yesterday. So it's a bit of a pressure cooker situation.
Do you think that passengers in airports today are at risk because of this situation? Are we less secure?
I won't say that passengers on aviation are at risk, any heightened risk. I think generally, here in the homeland, there is a heightened security threat environment because of the fact that Iran is a state sponsor of terrorism. And we're not just talking about terrorist organization directed attacks like another 9/11, a large-scale 9/11. We're talking about lone actors inspired by terrorist organizations or inspired by the simple fact that we've gone to war in Iran. Someone acting on their own who's deranged and is sympathetic to a terrorist organization. So we're in a heightened security environment generally, and the department of our government that is supposed to ensure our homeland security has been defunded and basically shut down for almost a month now.
So let me ask you, given this scenario of where we are right now, politically and otherwise, and the war that's taking place now in the Middle East, is there something that you would do? By the way, if you were the President of the United States, is there something you would do?
Well, 11 years ago, I faced this exact situation when I was in office. Congress held up funding for the Department of Homeland Security over the issue of immigration. In one sense, history is repeating itself, but the political dynamic was different. And I stressed over and over again that the Department of Homeland Security is not just the immigration enforcement mission. It's aviation security, it's maritime security, it's cybersecurity, it's port security, it's a Secret Service, it's training of federal law enforcement officers. I could go on and on. And in so many respects, we depend upon DHS to protect the homeland and protect the American people. And it's being used right now as a political football. In general, we have to get out of the business of linking a major policy disagreement in Washington with funding the government.
Agree 100%.
First job of Congress is to fund the government, keep the government open. They have the power of the purse. But year after year, and now more often than year after year, we get into these funding fights that go over the line to the point where a department of our national security hasn't been open for a month now.
Yeah,
That's not good for the American people.
It's not good for the American people. It's not good for the TSA officers. It is not good for our security. But I will also say, you were appointed by Barack Obama, a Democrat. There are Democratic senators who say, and congressmen who say that this is their only tool. They have no other tool to protest with, to use, to fight back. What would you say to them?
That argument is made by whoever's in the minority.
Constantly.
11 years ago, I heard that from Republicans
Yeah.
because they were upset about our immigration policies. So this is my message to both Democrats and Republicans. We have to get out of the business of linking a policy disagreement with funding a department of our government. That is a disservice to the American people. We can have these fights over legislation. We can have these fights over border security, over immigration reform, but don't link it to funding the government. The workers are the political footballs, and so often the workers have no voice in this fight.
So basically, shame on anybody who tries to do this.
And how many other contexts in American life do you know where someone is forced to go to work and not get paid?
Right.
Especially if it's a vital mission like aviation security.
Do you find that that's a message that resonates with the party that's not in power at any point in time? Because it feels like whoever's in party, whoever's
Yes, I
in...
believe it does if it's emphasized enough and it's said as loud as it can be, because I think that the American people become frustrated with Washington in general when they see situations like this, where we're not funding the Department of Homeland Security over some political fight, whether it's instigated by Republicans or Democrats. I believe the American public just throws up their hands and say, well, this is Washington, they're all children, and this is not the job that I sent them to Washington to do.
One other related question. We had Jared Cohen here earlier in the week. He had lived in Iran, and he talked about the possibility of sleeper cells and other things that could be either here in the United States or other parts of the world that could present a real challenge to us.
Yep.
How real do you think that is? We talk about this thing that feels like it's a million miles away.
It is real. Terrorist organizations are not like conventional armies. I once had a battlefield commander in Afghanistan explain to me when I was at DOD that very often for every terrorist you kill, you might inspire 2 more. And I have no doubt that there are terrorist operatives, terrorist organizations around the world lying in wait, either for a specific direction or simply because they've been inspired by world events to go carry out an act of violence, which was probably the situation we saw yesterday at Old Dominion and at the synagogue near Detroit.
You think that was part of a larger plan?
See, it's not so much a larger plan. It's very often deranged individuals who feel as if they're obliged to do this because of what's happening in Iran or elsewhere, not because of some specific order by a terrorist organization. That's somewhat conventional thinking. There's the possibility of the lone wolf. We saw a spate of these in 2015, for example, San Bernardino, the Paris nightclub in Florida, where someone who is sympathetic to the ISIS cause, for example,
How do you
carries out an act of violence.
How do you weigh those possibilities against, for example, if we can create, I don't know about regime change in Iran, but if we can eliminate their nuclear threat, would you say to yourself, that is a win, even if it inspires or creates some kind of other terrible challenge along the way?
If you can decapitate a nation that is a state sponsor of terrorism, that is a legitimate government objective. However, that does not eliminate terrorism. That does not eliminate the terrorist threat because, as I said earlier, very often you could be taking somebody off the battlefield, but then you inspire 2 more to act on their own who are sympathetic to the cause. That's where agencies like Homeland Security, like the FBI, play a role in this type of environment, yet the Department of Homeland Security is defunded right now.
Yeah, it defies explanation. You're right. You're right to look at this from a non-political perspective.
Well, here's an example of what I'm talking about. The National Terrorism Advisory System, something I created when I was in office. If you go to the NTAS website right now, because you're interested in learning whether there's a heightened
it's not being
environment,
right now, right?
There's a big red banner that says, due to lack of funding, this site is not being managed.
Right.
So.
Wow. Jay, thank you for coming in. Thank you for talking us through this. I hope your voice is heard in Washington. I hope there is some way to make sure that these employees are getting paid and that we are safe as a result.
Well, thank you for your interest in that workforce.
Yeah.
They don't have a voice in this fight.
Thank you, Mr. Secretary.
Thank you.
All right, folks, it is just after 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Andrew Ross Sorkin, and among our top stories this morning, the United States is launching new trade investigations into 60 countries over imports linked to forced labor. These probes include China, the EU, India, Mexico, and they could give the White House another path to replace some Trump-era tariffs that were recently ruled illegal. Here's the U.S. Trade Representative, Jamison Greer, who joined us just a short time ago.
And if we find that countries have been involved in unfair trading practices like subsidies, excess capacity, allowing goods made with forced labor into their countries, we can quantify that harm to U.S. commerce and then try to resolve that issue with the country. If they can't resolve it or don't resolve it sufficiently, you can impose a tariff or fee or something like that. We're trying to move very quickly.
Adobe looking to make a change in its C-suite. That company saying that its CEO, Shantanu Narayan, is going to be stepping down after a successor has been appointed. He's led Adobe since 2007, and he will remain the chair of the company. That stock is off by about 7.6%.
New this hour, Cuba's president saying his government has held recent talks with the United States. That's the first time they've confirmed that they are now in discussions. He said talks were aimed at finding solutions to their differences, and that those talks are still in its initial phases. He said no fuel has entered Cuba in 3 months, and declining reserves there have made the electrical grid increasingly unstable.
And Defense Secretary Pete Hegseth and the chairman of the Joint Chiefs of Staff, Dan Kane, just beginning a briefing on the war in Iran. We are going to be monitoring that news conference, and we will bring you updates as we get them.
For example, as of 2 days
In the meantime, the Pentagon is calling Anthropic a national security risk, and now the company is suing to fight back. Here's Defense Department Undersecretary Emil Michael, who was on our show yesterday, talking more about that spat.
The truth of it is we can't have a company that has a different policy preference that is baked into the model through its constitution, its soul, its policy preferences, pollute the supply chain so our warfighters are getting ineffective weapons, ineffective body armor, ineffective protection, and that's really where the supply chain risk designation came from.
Joining us right now is Catherine Epstein. She is Rutgers University Professor of History. And Catherine, let's put your view of what this all means and how important this is. How do you see this? In your latest op-ed, you argue that the Pentagon Anthropic dispute is actually good for China. How do you see this playing out?
My concern and what prompted me to write the piece was that the appearance that the Pentagon's behavior might be motivated by something other than the pursuit of technological excellence, the best system that it could get. What I had in mind was tweets or truths by President Trump and statements by Secretary Hegseth to the effect that the problem with Anthropic was that it was a radical woke company. That's a different rationale for the decision to not purchase from them and to put the supply chain risk designation on them than the one that says that the U.S. government can't have a private corporation placing handcuffs basically on warfighters and on Pentagon decision making. And it's a different rationale than saying that a different company has a better product and that's why the U.S. government doesn't want to purchase from Anthropic. And that was what concerned me, the appearance that something other than the pursuit of technological excellence in service of the national interest was what was motivating the decision.
Catherine, you point out that the company's welfare, Anthropic's welfare, isn't at the top of your list of concerns. You're looking at this as a historian. And what does history tell you on this?
Yes, it is. The company's welfare is not at the top of my list of concerns, either as an author whose book was used without permission or payment to train Claude, or as a history professor who is very worried about the implications of AI for the education of young people. But my concern as a historian was that it immediately, when I was reading the kind of reporting about what was going on between the Pentagon and Anthropic, reminded me of a case that I had written about in my most recent book, in which the British Admiralty had basically helped actually to fund initially the development of a gunnery targeting computer before World War I. So these were extremely sophisticated mechanical analog computers that basically predicted where the target of a battleship was going to be at some point in the future when a shell would land on it. They were technological marvels. They were actually regarded in their day as possessing a form of artificial intelligence because of their capacity to generate accurate predictions without human intervention once they had been initialized with data. And the Admiralty basically allowed a naval officer, a British naval officer named Frederick Dreyer, to plagiarize or pirate the Pollen and Isherwood system, the one that had been developed by these two civilian inventors. The Dreyer system was not as good, basically because he didn't fully understand the conceptualization that underlay the civilians' fire control computer, their gunnery targeting computer. But Dreyer was an insider. He was supported by powerful superiors. And even though Collins and Isherwood's system, the civilian system, was clearly preferred by a majority of disinterested gunnery officers, the Admiralty chose to purchase the Dreyer system.
Right.
And that was what concerned me. It was that decision was not driven by the pursuit of technological excellence in service of the national interest. And that was the analogy that I was seeing.
Let me just ask straight up. You know,
Sure.
we had Emil Michael on the broadcast yesterday.
Yes.
He made an argument about why he believed that Anthropic should not be used by the Department of War. And I'll just ask you very plainly, did you believe him?
No, plainly. My attitude is I don't give anyone the benefit of the doubt in this dispute. I wouldn't take what Anthropic says at face value, and I wouldn't take what the Pentagon says at face value. I'm a historian. My business is skepticism of what the sources are telling me and trying to dig and evaluate. So to me, what the Undersecretary was saying is very different from what Secretary Hegseth has said and what President Trump has said. And if it was telling the truth, then Secretary Hegseth and President Trump were not explaining accurately why the Pentagon was making its decisions the way it did. So not everyone can be right here. And given the context of, say, the administration's basically quasi-bills of attainder against law firms, it's not an administration that's been characterized by excessive concern for private property rights. It's too easy, they've made it too easy to suspect that something else is going on here.
Catherine, I want to thank you for joining us this morning. We appreciate it.
Thank you very much for having me.
When we come back, Carlisle, head of global research and investment strategy, joins us to talk Iran and global economic risks. Squawk Box, we'll be right back.
Joining us right now for a closer look at the markets is Jason Thomas, the head of Global Research and Investment Strategy at the Carlyle Group. Good morning to you.
Good morning.
Jason, we're all trying to make sense of these markets. We're going to get some numbers in just a little bit here. But the continued escalation of the situation in Iran, I think, is what's haunting or has been haunting the markets. Where do you land?
Well, it was interesting. Last week, I had a discussion with a old foreign policy hand in Washington, and he suggested that the market may have the conclusion of the conflict wrong. I think a lot of people expect that eventually the U.S. military will have completed all of its objectives. The president will want the war to end. But he suggested history tells us that while one state can start a war, its conclusion generally requires the assent of multiple parties. And the implication of that was that there may need to be either regime change or a negotiated settlement to get the strait reopened. Because really, from an economic perspective, that's all that matters. And I think the risk here is time. How long is it until we have the resumption of flows of 20% of the world's oil, 20% of the world's LNG, similar magnitude of fertilizer, the petrochemicals, 11% of aluminum? So this is really accumulating. The risks accumulate. Of course, the longer the wells are shut down as storage is full, you start to introduce risks of pressure. How much pressure is reduced in the wells, which introduces, of course, the possibility of more permanent losses.
Well, if that's the case, then how would you measure where the markets are right now?
Well, I think there's still a lot of optimism, and I think that there's three things to keep in mind. First, as of February 28th, the morning of February 28th, the U.S. economy was in good shape, still had growth that looked to be about 3%, led, of course, by AI CapEx investment boom, but also an industrial sector rebound that I think really had some legs. The employment report really wasn't as bad as people suggested. We're in a low hire, low fire economy. Yes, there were 1 million fewer workers or people employed in the United States than we thought. There's also more than 1 million fewer people in the United States seeking work than we thought. So there really wasn't as much slack. Of course, the unemployment rate was the same effectively from December. You also, of course, have a U.S. economy that's very different relative to the last energy price shock, which was 2007, 2008. At that time, we were importing energy equal to almost 3% of GDP. Now, we are an energy exporter on net, trailing 12-month energy exports of about 100 billion. That's almost certain to rise just from LNG. And then third, I think that the Fed actually has a lot more room to maneuver later in this year than people think. I know the futures markets have now, I guess, assumed that there won't be any cuts this year, but that's actually not the monetary policy handbook, which since Bernanke-Gertler in 1997 has suggested that the optimal policy in response to a supply shock of this sort is essentially look through it, to ignore it in some sense. So as long as core inflation is well behaved, as long as longer dated break-even inflation is well behaved, the Fed will retain room to maneuver, and you could get lots of cuts later in this year. Again, presuming that this energy price spike is something that resolves itself on the supply side over time.
So you are expecting multiple cuts this year?
I think that what I mean to emphasize is that people who think that we're really in tough straits because the economy is going to be hit very hard by the conflict and that the Fed is handcuffed because of the increase in inflation from the supply shock have it wrong. If this conflict lasts longer than we expect and the strait remains closed and there is damage to the economy, the Fed will cut. And I think they could cut quite a lot. And so I do think that that's something that people should keep in mind. And this, other central banks take a different approach. We can go back to 2008, obviously ECB hiking in response to the shock. ECB also hiked in 2011 when you had an increase in oil prices, broader commodity prices. The Fed didn't move at all at that time, even as inflation went above 3%. So I just think that the reaction function here is what I'm emphasizing. And the Fed will look through this, a supply shock that resolves itself, and cut to the extent that we see, economic damage from all this.
Jason, how do you, when you introduce this sort of the new chair to this, Kevin Warsh, who obviously wants to cut rates, how do you think the board is going to work with him or not early on in his tenure on this particular topic?
Well, 2 weeks ago, I really thought that the talking points for rate cuts was really going to be all about AI. It was going to say, look, we know we have this massive disinflationary shock coming. Everyone can see it. If we wait for it to be really reflected in the data, in the inflation data, we'll have waited too long. We need to get ahead of it. I felt that was going to be the messaging campaign, to start cutting rates even at a time when growth looks solid, when inflation continues to be above target. I think core PC inflation is still going to be about 3%. So based on those numbers, you would say there's not much of a case for cuts. But again, looking to the future, emphasizing again the scale of the change we all know is coming, I thought that that's the direction that they would go and get buy-in from other members of the committee. Now I think it's going to be more challenging, obviously. When you have inflation that's going to move up further from already above target, they're going to have to wait. And I think they're going to have to watch very closely, again, core inflation. Is this entirely explained by energy prices? And then just to see how the longer end of the curve behaves. Of course, there has been an increase in inflation break-evens, understandably, over the near term. But on a longer dated basis, do they stabilize? Do they remain well behaved? Those are the metrics. If that happens, I think they can pivot back to this AI shock story to try to get those rate cuts that the president obviously would like.
Okay, we're going to leave the conversation there. Jason, thank you. Appreciate it.
Thanks for having me.
We are counting down to a flood of data, including the Fed's preferred inflation gauge. Ahead of those numbers, you can check out the futures. Dow futures up by 160 points, S&P futures up by 23, the NASDAQ up by 85. And then former Dallas Fed President and Goldman Sachs Vice Chair Robert Kaplan will join us. Squawk Box will be right back.
Digital publisher BuzzFeed saying it has substantial doubt about its ability to stay in business. The company says it won't provide a 2026 forecast as it evaluates strategic options. BuzzFeed, of course, was popular in the late aughts and 2010s with newsy articles famously known as listicles. It went public back in 2021 as part of a blank check merger, but its stock has fallen 98% since then. CEO Jonah Peretti saying the company believes its market value doesn't reflect the strength of its individual brands, and it is another example of the SPAC craze gone very wrong. And I remember we used to warn our viewers about what was taking place in the SPAC world over and over again, and we actually had many viewers who would say, please stop trying to warn us about this. We want in. Well, here we are. I take no joy in this. It was so obvious to us, I think, at the time about how these movies unfortunately would end.
All right, in the meantime, ByteDance is working on building up its computing power outside China using top-of-the-line NVIDIA AI chips. That's according to the Wall Street Journal. It says that the TikTok parent is working with a Southeast Asian company on plans to use NVIDIA's Blackwell chips in Malaysia for AI research and development. The journal says that the Southeast Asian company is a so-called Tier 1 NVIDIA cloud partner. That means that it can get priority access to the company's latest chips. You can see NVIDIA shares up by about $1.50.
Okay, January PCE, durable goods, personal income, and the first revision of fourth quarter GDP. It is all out, and now it is happening. Rick Santelli is the CME in Chicago. Has got the numbers.
Absolutely, and the numbers are populating here. This is our January read on income and spending, and the PCE numbers expecting up 0.5%. Comes in a bit light, up 0.4% on income. Also up 0.4% is spending. We're expecting up 0.3. That's a nice number. If we look at real spending accounting for inflation, it's up 0.1%. And here we get into the inflation metrics. Month over month, headline PCE up 0.3 as expected. Cooler than the rear view mirror, which was up 0.4. That would be the coolest since Nov of last year. If we take a year-over-year perspective, it comes in at 2.8. 0.1 cooler in both directions, backwards and forwards. 2.8 equals November, October last year, 2.7. Now let's go month over month. Core may be more important, especially considering the news of the day and how that news may filter through over the next several months. Up 0.4 as expected on a month over month core PCE. If we look at year over year, comes in at 3.1 as expected. Although this is the only number 0.1 hotter than the rear view mirror. 3.1, well, that would basically the highest since it was March of 24 to find a higher number. Now let's look at durable goods, shall we? Durable good orders headline expected up 1.1 comes in unchanged. Remember, our last read was minus 1.4, so this is a little bit disappointing. Ex transportation, though, zoom, up 0.4, close to expectations. That follows a 1% increase. It would be the lightest positive number since up 0.2 in October of last year. Now let's look at new orders, non-defense ex-air, proxy for capital spending, a disappointing unchanged. We're expecting up 0.5%. It has been running strong, though. Over the last couple months, it's been up 0.8 and up 0.9 for November. So solid when we look at a multi-month average. Finally, if we switch to shipments, minus 0.1%. That is a bit shocking. We're expecting up 0.4. That'll be the first negative number since August of last year, which equal minus 0.1. Find a smaller number, April of last year, minus 0.2. The GDP, fourth quarter, second time around the block. Our headline number, it gets cut in half. From 1.4 to 0.7. That would be the weakest growth in any quarter since the first quarter of 25. If we look at consumption, 2.0, that's from a 2.4 look on the first look. Second look, 2.0. That would be the lightest since it was only up 0.6 in the first quarter of 25. The price index on GDP, 3.8. 0.2 hotter than both directions, equals the third quarter of 25. To find a smaller number, you're going back to the second quarter of 25. And the last number is core PCE, and that core PCE quarter over quarter is exactly as expected, 2.7. To find a higher number, you're in the third quarter last year at 2.9. Find a smaller number, you're in the second quarter of 25. So these numbers, how do they pan out? Well, you're looking at 4.25 on a 10-year, maybe the best way to assess that. It closed last week at 4.14. We're basically down 11 basis points. 256, we're a 2-year close, down up 14 basis points on the week. And of course, the 10-year is up 11 basis points on the week. Those numbers, they are big, but they're certainly not huge, especially considering the huge news over the last 3 weeks. Back to you.
Okay, Rick, thank you for that. Steve Leisman's at the table, staring at his screen, trying to make sense of what's going on here.
Government somewhat less, experts detracted more from GDP, exports, consumer spending contributed a little bit less. Yeah, that was a big shocker to me. What we care about here, guys, is the extent to which, and I hope Rick is sticking around because we've got to talk about the bond market, but I just want to rip through the numbers here. We care about what the economy was before we're heading into this new world where we figure out what the economy will be with these higher oil prices. Obviously, inflation by the Fed's preferred metric remains high, remains above target, up near 3%, 2.9%. That's a significant number. GDP was weaker in the fourth quarter. We will get some of that back in this quarter when we get to the rebound of government spending from the shutdown coming back in. That should be there. But consumer a little bit lighter, government a little bit lighter, and investment also, by the way, a little bit lighter. In fact, every critical component contributed less to GDP. That's how you got the 0.7. Looked like markdowns across the board. I didn't get the business investment number inside durable goods. I'll look for that. But Rick, there's been a lot of volatility in the bond market. Beginning a day or two after you and I talked about the lack of volatility in the bond market, which is just shows to go you that you should you never know what's going to happen. But I'm especially interested in the 2-year, Rick, and that seems to have coincided with a real rethink of what the Fed might do this year. Want to know what you're hearing from the boys and girls in the pits.
Well, consider yesterday's close in a 2-year note was the lowest yield close since the third week in August of 25. But the 10-year yesterday closed at the 10-year closed at the highest yield since the 4th of February. So I guess what I'm pointing to is that there's been a major flattening of the yield curve, and it really is prompted by the 2-year, and I see where you're going. This is correlating very high with what's trading in Fed fund futures. If you look at the December contract for this year, it's been selling off. And if you overlay what's going on with 2-year yields, they are going back and forth cross-fertilizing each other as investors are taking easing probabilities down. They're taking 2-year yields up, and they're flattening the yield curve.
Rick, real quick, did you get that investment number inside durable goods? Because that's been a bright spot for parts of the economy here. And there, by the way, we have it up now, the latest probabilities on those rate cuts. Flip of a coin for one in September, and more confident one in December now. But you can see how far down they are from where we thought we were. We were going to get 2 rate cuts. Now we're toying with whether or not we get 1, but not 2 this year. A lot to figure out. Also, we've seen the MOVE index, which is the volatility of the bond market, go up, as well as people, Becky, try to figure out just what the heck is going on right now and where these things are going to settle. But we do start, unfortunately, at least when it comes to the Fed's preferred indicator, as opposed to the CPI.
Do remember, though, Steve, the dollar index is now above 100. We haven't closed above 100 in the dollar index since, I don't know, about the 3rd week in November of last year. That is a good thing.
It's a good thing, but it's interesting that you would think dollar being higher and it would create more of a demand for some of our assets.
I like to buy things that come into the country. Yeah, it helps people buy things, and obviously some of its strength is associated with the commodities which are going up, which are potentially inflationary should energy prices stay elevated for a longer period of time. Yes.
Yeah. All right, guys. We have a lot to talk about. Rick, call me over the weekend. Let's go through it all.
Gotcha.
All right, gentlemen, thank you. Right now we want to bring in our panel to talk a little more about this. Former Trump Treasury official Joe Lavorgna and former Biden Treasury official, Kitty Richards. Joe, what do you think happened here? Because I know your take on all of this was that the government, the economy was in pretty good shape before everything happened in the Middle East, but these numbers suggest a little differently.
We kind of came right back, Becky, to where we were in the beginning of the quarter when the outlook was that things would be soft because of the shutdown. It would weigh on income. And as Steve related, you're going to get that payback in the first quarter of 26. So the economy, I think, still fundamentally is pretty healthy. The tax incentives on the building, especially the structures, 100% expensing, and then, of course, the no tax on tips and overtime is going to lead to huge refunds. The biggest issue, though, as you know, is what's happening in commodity markets and energy, because it takes what I believe is a very fundamentally solid economy, one that is going to accelerate, is now cast doubt on it, as you can see in markets, which are worried about the extent and duration of this energy move, because there's nothing that will take liquidity away from households faster than higher gas and oil prices.
Kitty, what do you think? I mean, obviously, the events that are happening on the ground right now are complicating any sort of clear vision on what we might be seeing in the economy, but these numbers do come as a surprise. What are you betting at this point, just in terms of where we stand?
You know, I think these new GDP numbers are surprising. They were much lower than expectations, but they are also consistent with what we've been seeing in the job market. So last month's job market report from BLS showed that we actually lost 92,000 jobs across the economy in February. They also revised down December jobs, and so it was negative. So I'm wondering if we're actually seeing some of those labor market indicators and GDP come into line. That does paint a softer picture. And of course, we're seeing inflation remaining elevated. And the fact that core PCE is still quite elevated, moving into a period where this, chaos in the Middle East, the war that Trump has embarked on, has caused gas prices to go up dramatically in the last week. Those will continue to rise. Oil is trading around $100 a barrel. When you add that on top of persistently high non-energy inflation, we could really start to see inflation tick up.
Hey, Kitty, two things. One is I love the book that's right behind your head. So I wanted to say I appreciate that. I caught that. I don't know if others caught that. I won't say more. Just on the left side of there.
1929.
No, it says too big to fail.
Oh, okay.
And then Joe, it's nice to see you. My question, which relates to where I think Kitty was going with this, is what is the chance, and I know the administration's been pretty persistent with the idea that, if things can get resolved, all of a sudden the price of oil is going to go down again. But what is the chance it remains elevated for some period of time, even after fighting ends, if you believe that is even possible?
Well, the thing is, Andrew, when you get these big oil spikes, they tend to go up very steep. The slope on the line is high, it's sharp, it's almost a right angle. And generally, when the situation is resolved, prices come down. So whenever this crisis ends, and hopefully sooner than later, I do expect prices to go down. The problem is the length and depth with which these prices rise. In 22, we had a lot of stimulus. The economy was overheating. We had very strong job growth, 300,000. Now the job market, I would argue, is going to turn up because it will follow the CapEx trend and the pro-growth tax policy. But with this energy move, that kind of throws a wrinkle in things. It seems to be the markets are still betting on a relatively short conflict. That certainly will help. But again, the longer we keep these prices higher, inflation will go up, that will collapse real income, hurt spending, and lead to a stalling out in growth.
One thing to bear in mind.
Go ahead, Kitty.
One thing to bear in mind about the job market is what we've seen over the past year is that a large share of job growth has been in the healthcare sector. And last year's budget bill, which cut taxes for the wealthy very steeply, but also cut Medicaid and failed to extend really important subsidies for Affordable Care Act coverage, has led to millions of Americans losing their health insurance. That is going to, and also they're facing rising costs for healthcare if they were able to keep their insurance. And that is going to have real impacts on the healthcare sector, on jobs, as well as on Americans' pocketbooks. And I think you're seeing some of those pressures also feed through to that disappointing consumer expenditure that we're seeing. Consumers are really strapped. They're seeing prices rise for utilities, they're seeing prices rise for gasoline, they're seeing prices rise for food, and premiums for healthcare going up by hundreds of dollars a month in many cases. And that's really putting a squeeze on their ability to spend. And consumer expenditures are the driver of GDP growth in this country. And so I'm not as sanguine about what's going to happen in the labor market or with GDP over the coming year.
Hey, Joe, do you worry about that? And I guess if you would put yourself in the Federal Reserve's position, do you worry more about the potential for a softening economy, a softening jobs market, or do you worry more about what these higher oil prices mean for inflation?
Well, on the labor markets, the real wages under the first 11 months, 12 months of President Trump's term have been very positive and very strong. Blue-collar workers have seen huge wage gains. The problem, of course, is now where we are with the situation in the Middle East. So to me, as I said earlier, the economy is fundamentally healthy. But this oil move is a concern, and I do believe, as I said many times, the Fed should be cutting interest rates to help the cyclical parts of the economy to grow, because the Trump tax plan is disinflationary because it increases the supply side of the economy. However, if you're the Fed, having gotten burned very badly with transitory in 22, 23, they're going to sit and wait, as Rick said earlier, and you see it in the markets, we're pricing out Fed easing, so it does cause a risk, because when in doubt, the Fed's going to sit back and is going to wait. They don't want inflation expectations to become unmoored, and because of that, nothing is going to happen. The yield curve is bare flattening. That's not going to be good for interest-sensitive activity, which is why what happens overseas needs to be resolved as soon as possible.
Joe, Kitty, thank you both for joining us this morning. It's good to see you.
Thank you.
Thank you.
Up next, former Dallas Fed President and Goldman Sachs Vice Chair Robert Kaplan on how these numbers may chart the Fed's rate path. Squawk Box will be right back.
Welcome back to Squawk Box. Joining us right now is Goldman Sachs' Vice Chair, Rob Kaplan. He is former president of the Dallas Fed. Good morning to you.
Good morning, Andrew.
You heard the numbers. You've seen where we are. Tell us what you think.
Well, the fourth quarter GDP being weaker is not a surprise. We had a government shutdown for 2 months. And the inflation sticky for January, probably also not a surprise. Obviously, there are bigger events now in the Middle East that have taken precedence over that. And I think the Fed, as a result of it, will be in wait-and-see mode. And I think the wise thing for the Fed out of this meeting, they won't take any action. They have to submit an SEP, a summary projections. But I think avoid being rigid or predetermined or making grand pronouncements would be wise right now. There's too many things that could change, and I think they'd be wise to be patient here.
How does this war in Iran impact things in your mind?
Well, before the war started, I would have said, and our own economist, Jan Hatzius at Goldman Sachs would have said, we're set up for a very strong 2026. Tax stimulus, the AI data center, power, compute infrastructure boom, regulatory reform is going to be helpful. The higher oil prices and the ripple effects to fertilizer or other inputs, if it goes on for a short period of time, we may see the effects wane, but we don't know how long this is going to go on. And so it's going to potentially, the uncertainty with it, as well as the higher price, goes against some of the tax incentives that we think would be stimulative this year. And so it could change the picture. Obviously, if it persisted, you're going to have stickier prices, but we don't know that yet. And so I'd say the picture, we were optimistic going in, and this clouds it.
Well, so the other piece of this, Rob, is here we are in a midterm, year of the midterm. I think there is a question mark, and we were talking about earlier this week whether you think that if in fact this somehow gets prolonged, that the president potentially would pull back from some of it, depending on how politically popular or unpopular it all turns out to be.
Yeah, this is one of those situations we're just a little under 2 weeks in. I think you have to be ready that a week from now, events could change. A few days from now, I'm not thinking about the fall yet. We're only in March. I have a funny feeling that things are going to look different by the end of March than they do right now. And I think you just have to, as a business person, our clients have to keep that in mind. And at the Fed, you definitely have to keep it in mind. I think this SCP, by the way, the projections that are going to come out next week may cause more confusion. Right. The Fed has to make estimates about inflation, GDP, how many rate cuts. And I think it'll have a short shelf life.
Okay, so if you're Kevin Warsh, assuming you pass through the whole thing with flying colors and Tillis doesn't stop you and you get there, then the question becomes, and he wants to lower rates, in the face of this mixed with the AI piece, and who knows what that's going to do to employment, how much easier or harder is this all going to make it?
It's a good thing for Kevin Warsh. He's not in the seat. His first meeting is June. Okay, so by June, we'll have a much clearer picture. So we'll know by his first meeting whether this has been prolonged or not. You notice the forward curve on oil is still downwardly sloping. It's still possible that some of this oil effect will recede. The AI infrastructure part and the government stimulus, the tax incentives, tax on tips, overtime, accelerated depreciation, that's actually stimulative. And you'll have a chance to see whether the AI adoption is starting to create some disinflation. But I think in this kind of environment, 3 months is an eternity. And I think people at the Fed are well aware of it and should be well aware of it. So things may look very different by his first meeting.
Okay, Rob, thank you. Appreciate it. Squawk Box, come right back after this.
Welcome back to Squawk Box, everybody. We made it to Friday. I'm Contessa Brewer here with a look at some of your morning movers. Adobe shares sinking more than 8% after the software giant said CEO Shantanu Narayan will step down after a successor has been appointed. Of course, he's led Adobe since 2007, will remain the chair of the company. They beat earnings, but look at those shares down 8.5%. Cybersecurity stock, SentinelOne, sliding about 4%. It posted better than expected earnings, revenue in line with analysts' expectations, but down almost 4%. And a check of Bitcoin now extending gains since the start of the war in Iran. It's now at 72,757. Crypto-related stocks like Strategy, Coinbase, Robinhood, Riot, all higher today. Up next, the stories making headlines on the show. Squawk Box back right after a break.
All right, welcome back, everybody. Breaking on Squawk Box today, personal consumption expenditures came in at 2.8%. That was slightly below the estimate of 2.9% on a year-over-year basis. The other big number of the morning, the fourth quarter GDP, was revised down to 0.7%. U.S. Trade Representative Jamison Greer saying on Squawk Box in the last hour that the nation's trade deficit with China has dropped by 30%. Ahead of meetings with Chinese officials next week, Jamison said that one top priority will be making sure the U.S. continues to have access to rare earth minerals. And oil is trading lower this morning. Right now, it's down by about 2%. Brent is down by about 1.5%. WTI is at 93.62. All right, folks, that does it for us today. Have a great weekend, and make sure you join us on Monday. Right now, it's time for Squawk on the Street.
Good
Good Friday morning. Welcome to Squawk on the Street. I'm Carl King today with Jim Cramer at Post 9 of the New York Stock Exchange. Faber has the morning off. Oil somewhat steady as the Iran war moves now into its third weekend. Some new reports that countries like France and Italy and India are actually engaging with Iran, trying to secure safe passage through Hormuz. Stocks, meantime, look to hold after the lowest close of the year yesterday. Eco data, a bit of a stagflationary tone, hot core PCE, lowest GDP print in almost a year. Our roadmap today, quote, unparalleled firepower, unlimited ammunition, and plenty of time. The president digs in on Iran. Adobe's under pressure. Shantanu Narayan set to depart. That kind of overshadows an earnings beat. And why the Teamsters are now calling on the DOJ to block Paramount's Warner Brothers deal. Let's begin this morning with the markets as we get ready to wrap up what's been a volatile week for oil and stocks, Jim. And I guess discussion of military strategy and what the end game should be.
Yeah, and it's hard. I mean, obviously, there's overnight comments that the president made and Secretary Hegseth made. And it's difficult. It's difficult because, I'm a stock guy, and we have to opine on political. I made some comments yesterday about the war in Iran. I got to make it clear, I was not saying what should happen regarding the destruction of the country's infrastructure or what I wanted to happen to the people of Iran. I want this conflict solved diplomatically. I think it can. I really do. And I'm going to present something that I think could. But again, I'm a stock guy. And I got to apologize to anybody who thought I supported the destruction of the Iranian people. That would be got to be avoided. It's just got to be avoided. And I want to make that clear. And I don't want to sugarcoat it. I did not say it the way I should. And you have to own that when you get something wrong. I opined in an area that I'm not as good at because that's not what I do. But I just feel like, Secretary Hegseth was speaking this morning. Yep. The president made some comments last night, and they're related to what could happen to Iran and oil and to Russia. And if you don't try to fit it all in, Carl, I think you end up not being as valuable as you like, but I do apologize.
No, I don't think you need to apologize, but the market as a whole, Jim, is trying to widen its bandwidth and understand big questions that are difficult to grapple with. You mentioned the defense secretary today. 15,000 targets now hit. They do expect today to be the highest volume of strikes against Iran. Take a listen to what we got in the briefing a few moments ago.
They are exercising sheer desperation in the Straits of Hormuz. Something we're dealing with. We have been dealing with it and don't need to worry about it.
Some of the commentary from the president, Jim, as you point out, watch what happens to these deranged scumbags today.
Yeah, see, that's what I was worried about. And I was thinking that they might adopt a strategy that the United States has adopted that is suboptimal for a lot of different reasons. I mean, there are a lot of people who could be impacted by this. I know that the secretary was talking about, or at least the paper saying that he didn't want the restraint, which includes not, random killing of people. And I think that the restraint's good because I'd like to think that you can solve this by getting, you always like to be constructive, maybe a ceasefire or a pause. It doesn't sound like the president wants to do that. I know the Iranians want reparations. Maybe you give them development loans from the Gulf states. I do think that despite the fact that the Germans and the British don't want the oil released from Russia, Russia's got a lot of oil, and they're not pumping it all, and I think that that's the spare capacity. So that would be why oil's down.
Yeah, I mean, the Kremlin kind of gloating a bit today about this waiver windfall is worth $150 million a day.
Yeah, it's a hobgoblin of little mind. We don't know who's worse. I know that our allies know who's worse, which they think is Russia, and that we were the vanguard of that, but that was different president.
So you were, I guess weekends are tough, right?
Yes.
Do you go long into the weekend that we're going to get to the banks and some of these levels on the BKX?
We're buying some stuff today for the trust. We've held off. We were waiting for, I follow this thing called the S&P oscillator. And look, I'm not a technician, but it's at -7. And that's been, other than one time -10, that's been where you had to buy. You had to just say, listen, at -7, this is for many years now, this is when you go. So even though it hurts to buy, today is a hurtful day to buy because it's over the weekend, we're buying. And we're putting actual capital to work. And I've been reluctant because it's been a terrible market, but we've been waiting and waiting and waiting. And we did sell some, but I don't want to sound like a seer. A lot of people come on TV and I sold at the top. And I'm like, no, I did not sell at the top.
I don't know what you're talking about.
Some of these stocks, like we sold Dana at the top. But the majority of stocks, like the banks, okay? we've watched the banks come down. We've been waiting. But then today we had it. We had Michael Hartnett, who's a great guy from Bank of America. And when I met him, I said, "Oh my God, I hope I had Magnificent Seven first." You know, you just know, the music. But I do think when he says it's 2007, 2009, and he's obviously trying to point out how bad. We have to buy.
Yeah.
For the trust.
It's a really provocative note today out of B of A. Basically, he goes back to mid to 08,
right,
when the ECB oil was actually peaking, and at the same time ECB was hiking. And as he points out, 74 days later, Lehman goes bust.
Yes,
huge policy error.
But it's interesting you say, because that was the plus 100. Remember earlier the week, when it goes plus 100 oil, 100% increase. It's never been less than 20%, except for when we've had one that's 19. I want to really point out that I know that things are bad with the banks. I know that, but the difference is that it's bundles of loans, of which not all are bad. And I keep going back to what Lloyd Blankfein said in that excellent book, Streetwise, which is that a lot of these banks had really bad packages of loans. These are not. Some loans are bad, and I know we're going to get to Adobe, but the loans that are bad, that are software, most of them are, almost none are in arrears.
Right. Although today, Jim, the discussion's largely about sort of a battle between private credit funds and their lenders at the major banks, and who has exposure to BDCs and CLOs. Names like PNC keep coming up, and B of A, and Wells.
Well, the good news is that the BDCs are not huge. When you looked at the business of Lehman Brothers, it was consumed. I mean, they were like 30-to-1 leverage. At one point, people thought they were 40-to-1 leverage. That's not the case here. I've never liked the business development. I don't like things where you're just going for yield and you're reaching for yield. And I learned that when I was at Goldman. You reach for yield, they would come in and say you're reaching for yield, and that meant that you were an idiot. You hated being called an idiot.
Right.
I do think that what you can do is say it's bad, but it's being recognized. I mean, look, when Morgan Stanley, this was a good one. Like, I talked about Morgan Stanley, checking with Morgan Stanley. I mean, Morgan Stanley is not they're not a private credit bank. I mean, they have collateral. We could take every one of these down. The reason why we're buying today is we think that it's beginning to get a little excessive, the worry about these, because there are, a lot of it is fear. Fear that you're going to be next, you got to take the money out. Some of it is these, they got overly retail. But when BlackRock is down huge, when Larry Fink is down huge, then you don't necessarily want to start betting against Larry. Larry is a tough guy to bet against.
Yep.
And he understands these things. So he has trillions of dollars under management. This is a very, very small piece. But I know that therefore it was sunk anyway. But we're going to look back, I think, and we're going to say, you know what, this was not 2007.
Let's hope so. Certainly,
yes.
The banks have given up basically all of their gains since May of last year.
I know, and I've the bank stock that you mentioned that I was going to buy, Wells Fargo, because Wells Fargo, we have a 34, 35. We bought it when Charlie Scharf went in and did the right thing, and I think Wells comes back. They're having a good quarter, but we also know that the president talked about their credit card. I mentioned it, the 10%.
Yes. Yeah, you kind of thought that was the beginning of the trouble.
It was, and we did some selling because the president, he just digs in. He just doesn't go away.
Right. Meantime, you mentioned Adobe down in the pre-market after more than 18 years. Shantanu Narayan will step down from that role as CEO once a successor is found and stay on his chair. The announcement kind of overshadowed the earnings beat and comes amid all these fears that are impacting the software sector. Here is Narayan on last night's call.
The privilege of leading this company has been the greatest honor of my career, and I'm committed to setting it up for its next decade of growth with the right leader and executive team, in partnership with the board while driving our fiscal 26 strategic priorities. A mission to empower everyone to create represents an even larger opportunity in the AI era.
Nice shout out from Nadella yesterday, and I think since he came in as CEO, Jim, outperformed the S&P.
Oh, yeah, and I want to join all the analysts. I mean, he's a titan. Shantanu is a titan, and he got a lot of people. If you go to a graduate school or undergrad where there's creativity design school, gold standard. and he gave a lot of people the ability to express themselves. Did he catch on to AI early? No, he had a business model that was not oriented. He did have a Firefly, which I think Firefly is fabulous. But you have to remember, Canva, obviously like Canva, Figma, they came in cheaper. Like if the whole suite of Adobe cost me $660, the whole suite of Canva cost my daughter $112.
Yeah.
And that's really it. They became the Lamborghini in a world where the F-150 turned out to be.
No, he's exiting at a tough pivot. Do you think they would have been better off with Figma?
Oh, Canva, Figma, anything that they had bought would have been better.
Really?
Yeah, well, because it would have given them a chance to have two tiers. The Lamborghini and the F-150. And what I feel badly about, people have to understand, this man is the pioneer. And at the same time, we have Carl Eschenbach from Workday, that's software as a service. He stepped down. We have Shantanu who's stepping down. You got to start thinking, wow, software as a service. Well, what's Bill McDermott going to do? Well, he's going to ring the opening bell.
Yeah, we're going to talk to him
What's Mark
later.
Benioff going to do? He's buying back $50 billion in stock. I mean, good. I mean, hey, good luck to you. That's great.
I mean, we've talked all week long about the Salesforce buyback. You don't see it as reckless? You think it is a sign of conviction?
I don't like it. Now, he does have huge cash flow, and the first part, 25, is accelerated. It's going to be done by the end of the year. Mark believes that there's an explosion of cash flow. I'm not, again, we own ServiceNow. I just think that when you do a huge buyback, when you have things that you should maybe put money on, it may be not reckless, but maybe ill-advised.
Right.
Ill-advised.
The other element today, Jim, is Meta delaying the rollout of Avocado, their new AI model on these, they're calling them performance concerns.
Yeah, no, they basically bought a gentleman for $14 billion. They bought Alexander Wang, and I think a lot of people are concerned that they paid too much, and this sets them back versus it's their ChatGPT.
Right.
I still think that Zuckerberg's going to shock us one day and fire half the people, and say, listen, we're going to do a block. We're going to run this company like AI.
You mean a block as in XYZ?
Yes, or I think Oracle's going to do it. I mean, someone has to say, you know what, AI is the greatest thing in the world, and we don't need most of the people.
So you think Dorsey's move was thematically genuine and is a sign of what's to come?
Great question, because Benioff said, listen, he's got his own problems, which meant that company's poorly run, and he has 10,000, you got to take it to 6,000. But I think someone's going to say, you know what, the future is AI. Like, I'm going out to GTC to see Jensen. Jensen wants CEO of NVIDIA.
And we'll see you Monday.
Right, and I think that what's happened is that there are people who say, God, I have excess people. I think a lot of people felt Adobe had excess people.
Well, remember what Alex Karp told us yesterday on this show about how this will affect employment structures in this country, around the world, really.
Right.
And as hiring plans get set for next year, Jim, that's going to be a story as we move further into the year.
So then we go back to what Jensen's going to talk about. I'm going to probe him on this, which is there's been no industrial revolution, this is the fourth, that hasn't created more jobs than the previous. It's hard to see the jobs. Mark Cuban posts a piece about startups, and it looks like, and Cuban is an optimist, and he knows that good business people are optimists. But I think that I want to see the evidence. I mean, because I see that people going the other way. I think that Amazon has a lot of people that they could let go in the white collar.
Right.
And Karp, I don't want to disagree with Karp. I think Karp's a pretty smart guy. His book's real good. But I do think that, you don't see the jobs immediately. In the same way that when the loom was created, the people who were sewing, they didn't immediately they were cast aside.
Yeah. Interesting data out of FreightWaves today. Logistics transport consulting firm looking at what they're calling a wave of layoffs across warehouses, factories, rail terminals in recent weeks. Now, some of that may be due to, I don't know, commodity volatility or what have you, but some of it might be due to tech
robots.
as well.
Yep. Well, if it's dull, if it's dirty, if it's dangerous, which, by the way, warehouse work is dangerous, factory work is, rail terminals is really dangerous. All the rail conference calls always start with how many people they were safe this month. They don't talk about how much they made. They talk about safety, and it's Jensen's role. He wants those jobs taken care of. And I know FedEx, Raj Subramanian, who was just crushing it. They are trying to get robots to unload. The late Fred Smith told me at a football game, he goes, we are going to make it so that the robots will just do all the unloading. The problem is the robots right now can't distinguish between certain size boxes. But Jensen will have this done. It's a priority. Now, by the way, we will see a robot bartender who can make 8 drinks at once.
What?
8 drinks at once.
Is there enough demand for alcohol?
Yeah, and the greatest thing is that you tend not to get a lot of the money. The money goes to the company. That was always tough.
You don't have to tip. There's no tipping the robot.
When I ran a bar, it was remarkable. And when I was behind it, we made a little more money than with other guys.
I'll bet you're a good bartender.
But
yes.
if we get a bartender that can do 8 drinks at once, hallelujah.
Take a look at the pre-market here, going out hopefully on a little more positive note after yesterday. We'll get to some news on retail like Ulta, housing like Lennar, some crypto in a moment. Take a look at some S&P gainers pre-market. There's Simon Property. We'll get to Coinbase too, as crypto's managed to hold on to some gains here, Jim, in a relatively volatile week. Also a nice FT piece about these up-down bets, where you can bet on whether crypto is going to be higher or lower in the next 5 or 15 minutes.
Well, I'm looking at free agency. I don't know about that.
We'll get Kramer's Mad Dash and the opening bell in about 10 minutes. Kramer's Smart Dash as we count down to the bell.
Yeah, we got to talk Lennar, conference call going on soon, but this was a quarter where Stuart Miller said things. I'm going to quote this, then I'm going to tell you what I think could happen. Our first quarter of fiscal year 2026 was defined by the same persistent headwinds that have challenged the housing market for over 3 years. High mortgage rates, constrained affordability, cautious consumer sentiment, and geopolitical uncertainty. Now, Carl, at a certain point, the negativity's got to get built in here, down 20%. And I think that people are going to recognize that when this war is over, rates have to come down.
I mean, we got Freddie Mac yesterday at 6.11, I think, on a fixed. But I mean, are you fascinated by this series of lower highs?
It's just, yeah. I mean, every time rates go down, we get a little buying spurt, and then rates go back up. But I want people to understand, this is a great company. Okay, I mean, it's great. This is not. Look, a lot of Horton's great, and Toll is great, Pulte's great. But when you see this and you realize that the dean of the group, Stuart Miller, is talking again about these headwinds, and they're really hurting the business, you have to say housing is so important to our economy. Come on. Come on.
Yeah, I mean, we could have a long discussion about domestic priorities in the face of Venezuela, Iran.
Absolutely.
There's Cuba headlines today. I mean, the administration's pivoting to a lot of foreign policy.
Yes, they are, and I think that you can't forget. Well, we're having a new Fed chief come in, but you can't forget the domestic economy. Not when Dollar General's just saying things are okay. Not when you get an upgrade to Ollie's. Ollie's, I mean, I'm a member of Ollie's Army, but you know, I'm a private.
Yes. Yeah, we'll get to Ulta and some retail.
Ulta, now her forecast was a little bit harsh. I think you got to bet with, not against.
All right, we'll get to that after the bell. By the way, you mentioned ServiceNow a couple of moments ago. Bill McDermott is actually signing the book at the moment, and he'll join us in the next hour. Back in a minute.
I'm here. I'm here. I'm here. I'm here. I'm here. Oh, we broke resistance. We broke resistance. Yes. 669.16. We broke resistance.
We broke resistance. Jimmy's here.
How do they do it? Okay, what'd you do with the phone? There it is. I got a telephone. Been waiting for your call. Been up drinking Pepto-Bismol. My stomach hurts, and you froze my mind. Before you know it, it's gonna be time. serious situation right here.
As we mentioned, NVIDIA's GTC gets underway Monday. Jim's going to go out there. Jensen Huang set to outline his company's game plan for an AI. Jim, a lot of discussion about sort of competition. We had Lisa Su in South Korea this week.
And he does talk a lot about how great the competition is. Remember, he always says, I'm a lover, not a fighter. This conference is my Woodstock, at least. I mean, your jaw's dropping as he takes you around. What he says. I remember when I asked him, I said, could you, how long would it take the new chip to digest Moby Dick? And he just said, a second. Yeah, a second. And I said, why would you want to read it a second? And he said, I don't know. I said, no, that was a joke. And he said, laughing on the inside, because he's Jensen. I mean, Jensen he's pixie-ish. He's Denny's. He went to a school for
cleaning toilets.
Kids. And he's the most humble guy. I know there are a lot of people feeling he's gotten caught up. I don't see it at all. I mean, this is a man who is a teacher. You see these companies out there.
It's a great lineup, by the way.
Yeah, and Vertiv is on fire. Dell, Nebius, okay? I said, Jensen, really? And he said, we're meeting them, and you'll see. And you go over, and it's just wonderment. It was like the first time I went on the E-rides, which you know, at Disney World, I got rid of that. You go to Disney World, it's like the Jungle Cruise.
E-ticket.
Yeah, and it's like, oh my God. And then you're like, Space Mountain, oh my God. It's just an oh my God conference.
So is your conviction on NVIDIA accelerating?
Unchanged.
It's unchanged.
Unchanged. This is one you want to own, don't trade. The multiple's getting cheaper. It's shrunk before. You never know what Jensen's going to do. You go there and you're wrapped. He has seen the future. And we haven't. Remember, he goes up 20 years and works backward to what the world will be. He's a remarkable man. He's arguably the greatest thinker of our time. And he's a teacher. He's a great teacher.
It's going to be a good week of...
Stifle. So they're talking about NVIDIA this morning. All of a sudden they'll say we're in a bubble, and then they'll say, well, it's time to buy. Time to buy. You gotta know when to hold him. Let's check out the watch list. Today's loser is Meta. 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 Oh, God. What's Meta? Meta on watch. Jim's freaking out on LSH. Meta's on watch. Oh shit. Getting the message out, not looking at the today's lotto. Lotto, the 6:30 strike. Prepare ye in the name of the Lord. 180. This is the 6:30 strike. Uh-oh. Nope. No. Oh, no. No. I thought I had it right here with these 3 candles. They're all lined up, and that turned on me real fast. I got 611 down here for some reason. Okay, come on, you moron. Meta. Break out, you beast. I got more at 140. Oh! Oh! $180. AMD's pulled back here, retesting. I'm at 178 on Meta. Come on now. IWM kind of at a resistance level from yesterday. IWM kind of at a resistance level from yesterday. $249.77. We got NVIDIA at 184 off the 200 on the 1 minute. 4 black crows. Apple needs to break the 200. And I'm in Meta. Nice little pullback to the 9 on the SPX on the 1 minute. We're still bearish on Meta according to the flag, to the cloud, the 9 and the 21. Zuck. Meta Avocado Day. You ever heard of that? Oh, delay. Come on, pop. back to the watch list. Oxy is down a little bit. It's been doing very good. And we got PLTR at resistance levels. You need to put AVGO on watch. And today's winners is Mr. and Coin and Regetta. And Joby had earnings. No, Joby did not. I thought Joby was supposed to get something good this week, but what's your calls? Ooh, now I'm red. What's going on here? Come on, Metter. I think we're going to break the 9. We'll find out. IWM broke resistance. To double top almost. Oh. It's taking forever. Apple's got a double bottom lower low. Nice little breakout this morning on /ES and SPX. Come on, break that 9. I want 623.49 today. $3 bounce. So the SPY bounced off the VWAP first thing this morning on the 1 minute. About 7 minutes into trading hour. I gotta take off my shoes. Whip up some tea. I have to add on to my little meta trade here. It ain't working. $618.78. Well, I gotta watch. Now I'm going back. We're breaking the 9. Jobis. Double top breakout. We just kind of run past resistance on the SPY. This was what I was showing yesterday on the moving. If you use moving averages, for like example, on the SPY this morning, 200 EMA, 200 EMA, 200 EMA, 200 EMA, 200 EMA, 200 EMA. That's your support. So that's where you'd want to try to get into the trade. That second pullback would be that double bottom. Right off the 200. Now I'm green on SP, on Metter. Now I'm squeezing between the 9 and the 21 on the 1 minute. So either get out here, $165. Boom, bang. You did it, Jimmy. You did it, Jimmy. Go to 626.17. Do it. The question's been asked over here at Washboard Jim's house. Do you think we can take this to 626.08? That'd be 626.08. So you get out now at 174.75. Or you take the chance and get out at $2. This morning I'm driving down the road and I'm saying, I'm looking at my miles per gallon. Can I get 31? You know, I'm timing it down to the red light. There's 194, $2.06. Hello? Hello? My ding-a-ling went off. My ding-a-ling went off. $2.12. I don't know how he does it, but damn it, I saw him do it again. I'm out at 212. I hit the 50 SMA. Oh yeah. Yeah, oh yeah. Jimmy's out at 212. He hit the 50 SMA. This is how he does it. You only got one, but sold when I did. Very good. Yippee-yi-yi, yippee-yi-oh. I beat that trade with a double bottom. Nothing better than getting the last of your coffee when there's nothing to be had. Kim, all we got is vodka in this place. I'll drink my coffee and I'll keep my mouth shut. Uh-oh, NVIDIA 200 SMA. Now, this caught my mind yesterday. I heard y'all talking about SPY and, just look at the 3-year chart. I dare you. That's a beautiful trade. I wish I'd have traded that instead, but so 3 years ago we were at 380 points. We're up 300 points in 3 years. That's 3 white soldiers. That's happened 3 different times in the past 12 to 15 years. And every time that's happened, we've consolidated to the right. So we've got the war going on, which is the oil supply, which is a good reason for a good pullback, no matter what. They've been wanting a pullback. They've been asking, begging for one, and we have not got one. So I'm thinking we might consolidate for another 3 months. Unless this conflict gets over, and then it'll be an instant pop. Because what's been going on in the Middle East has been a drag on oil supply for many years now. So maybe it can clean up and help some of other countries. But 20 years from now, maybe you could see a whole different Middle East. I probably won't be able to see it, but she's looking hot today. She's wearing white. George, she's laying into you, ain't she? I don't want to mess this chart up, but you know, I'd love to see this thing pull back all the way down here to 600 again. It says here, Coinbase short interest doubles in 2026. Saudi Arabia cuts oil output by at least 2 million. Well, that don't make sense. HIMX. Came right back to my support level. I wasn't even watching it. Probably set my alert off. There's Metter. 179. It's $5 more possible. We're getting ready to squeeze. We're going to know any second if this thing going to break out or not. We have a beautiful triple top on Nvidia. Yes, I did call it off the 200 just a bit ago for a scalp. Pay attention. Ladies and gentlemen, as I rode through my tickers this morning, I pointed out 2 or 3 good trades. Now here you got a triple bottom off the 200 SMA. Boom, to a triple top exit idea. Out of the trade. Metter. Called down here at the bottom. Boom. Out of the trade. AMD. Had a triple bottom down here. Double top. Out of the trade. Jim, I think we're set up here for the SPY, but I'm going to be extra patient and see if we can pull back and hit the 63 EMA on the 1 minute time frame. And I'm going to go to the cloud chart. That's a double bottom. I'm going to type in SPY. And go to the 5. Oh, 1 minute. Hold on. Okay. See these higher highs? I'm dying. Remember me as Washboardjim, the legend. That's on the 2 minute. Five minute, we're on top of the cloud. Off 3. Oh, look at that. 3 white soldiers. Pull back to support. I missed that one. Meta's at 194. Oh. Do I want back in Meta? No. I want to go through the news and wonder why it took a knife like it did. Does that make sense? What, took a knife? Gotta be a reason. They're at 191 right now. So, I'll tell you when I would get in it, if that'll help you out, because I'm Washboardjim. I'm the founder of the Sneaky Snake Trading Strategy, where I talk about chart patterns, moving averages, and the women back in the 1970s that wore tube tops. Any of you ladies ever wear a tube top? Well, I think I drew that up on there. That's the 5 minute. Well, shoot, man. That looks very healthy right there on the 1 minute. I'd have to set an alert right there at 6:23:60. But I like how it's set up. Jim's setting his alert at the mark at below at 6:23:60 for Meta. And that's, I can accept that, but that's kind of, See, right now you're at support. If this thing's going to stay bullish, it's going to break out now. Back there, we're on that line. Okay, get off the subject. We have a knife. Pull back on the SPY, please. We're looking into the SPY. And I still have time to trade it in the lotto. Today's the 13th. Friday the 13th. That changes everything. Okay, I have to change my strategy around. These are the 673 calls on the SPY at 92 cents. We can come down and hit the 200. Yes, that is the snooty Washboardjim. Come on, baby. Let's break that VWAP. These are the 673s at 92 cents. We're at $1. 2. I'm out. I can be out. Oh. Shiny scalping llama, come on. What's wrong with you? You should have broke out a day or two. You are the lovely spy. Oh, oh, oh! Oh, God. 106. Okay. Panic attack. God darn it. Let's try his best. Hit. Oh, we're back to even. No. 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 See it? I mean, I still keep staring at that 200. And it's right down in here. So I don't know if I should sell this and wait and be smart about this. You be smart. That's a good one. You're now at 97 cents, Jim. You're up $50. Have you ever thought about selling? Yes. Today I'll be going out to lunch. There's not much y'all can do about it. Unless you want to go with me. Break it. We have an expansion pattern coming off the minute, holding up to 200. I'm still fearful that we can come down and hit this. Just like that. It doesn't take much. God. See, just like that. Now, we'll go with my hunch here. $0.78. I want 77, but I'm going to take 78 because I want in. 92 and 78. There it is. Triggered! Man, this ain't working out too. It's got a hold. We got an inverted hammer, kind of like. This is a major support. It's got a hold. No. Now it's a pretty big deep, another buck if it don't hold here. Well, it's not doing very well. Seems like they're pulling it down. Oh, come on. Looked to me like they were trying to pull it down. Somebody trading this has been at it for a while. Come on. When you break. I gotta have 85 cents. Meta's moving up. /ES is at the VWAP. /ES is at the VWAP. Man, you took them off and you're going to have to put them right back on. Well, we're going to find out here. Putsville. SPX is at 66.92.72. Man, I'm telling you, I feel like jumping in SPX. The 6-7. Oh, that's SPY. The 6740s right now it's $6. This kind of a wedge. There it is. I'm going for it. Ladies and gentlemen, Washboardjim, $5.80 to 6740s, 580. Oh damn! Like $50. I mean. We'll get they're at 5 right now, 510. I wanted to hold that 200 and it didn't do it. Now it's at 560. So either get out of it now, lose $20, because it went below my support level, the 200. There's 630. Come on. Blink it. There you go. Now, if you took this trade, I want you to understand what I'm doing here. This is called a fallen wedge. We're at the VWAP on the /ES. So that's some kind of resistance right there. Looks like we got to gain respect above the 200 EMA. Now, if I'd added one on the dip there, I'd be out of this trade. Because we're still bearish. Because we're under the VWAP on /ES and we still haven't broke above the 9. So I can get out of here and be even. Or just wait, see if I can get this breakout. I had 3 white soldiers there. So here's your fallen wedge. Not much of one. Actually, it's not much of one. No, I saw a better fallen wedge than that. He does look a little bit better on the SPX. Come on, break out. There's 620, so I'm up $40. We're hitting the 21. Yeah, this thing ain't moving much. It's got to have a good breakout. And I'm not sure if we had the pullback yet after the breakout of the wedge. So I might add another one. They go, Will. At 540, but didn't. $67.40s. There it is. Come on. Take it. Boom. Perfect. Right there. $5. $5.80 and $5 off the 200. So that's my pullback. Now let's see if this thing really does its charm. So we have snake, fallen wedge, breakout, pullback to the 200. Leaves head and shoulders. So see what happens here in 5 minutes. And I've got $5.80 and $5. That leaves me $5.40. And right now I'm even. Is that how you do it? It's time to make a killing. It's time to make a killing. So I have 2 contracts, one at $5.80 and one at $5. And we have the perfect setup here. We have a lead out hammer. We're at $5.90. I'm up $100. Five minutes later, it only took a minute. And when a minute's gone, the stock is gone, long gone. I said just wait a few minutes. Snake, break out, pull back, oh no. There's some chicken shits in the lineup. Got a fallen wedge, pulled back to the 200 SMA. On the 1 minute time frame. To a head and inverse head and shoulders. Can we break the 63? If we do, I'm seeing 67.09.98 to the penny. You're up $60, Jim. $80 if you ever thought about selling. I'll tell you, see if we break the 63. For you and me. Break it. We're starting to walk out of a squeeze. I see a TTM working. Well, shoot. One thing I don't like to do is wait. It's 9:30. I'm debating what I want to have for lunch. You're at $6. Come on, let's break out. Give me 7 or 8. Now we hit the 63s. So if you're in this stock with me, take some profit off the table if you're able. them off the table if you're able. It won't take too long. I hear that 50 SMA's been doing good for you today. It's making you money. Oh! We got to break up to the 50. Okay, ladies and gentlemen, please make a business decision. Please make a business decision. Out at $7.10, by God. The guy's a nut. I saw it for myself. It's like Elvis. Ladies, please keep your bras on. I'm busy. We'll have no braless people in here today. Okay, well, we nailed it. See how easy it is to use them moving averages? We came back and hit that. I mean, that was beautiful. Look how clean that is. Why did I pick that area right there off the 50 SMA? Because we consolidated here for 5 minutes. That's why. That's a channel of resistance. Not saying we can't break it. We had 2 engulfing candles. We got to consolidate. It's time to take a break. Go eat a steak. Big old fat baked potato. And some green beans. Chicken fried steak down at Mars is the best. I can't let too much out. You'll recognize who I am. $67.40s. They're now at $5.90 to $6. Well, we pulled back to the previous resistance was a 63 EMA. Should I wait or take another trade? You could be stuck. And that would be your kind of luck. Oh gosh, this looks yummy. Ladies and gentlemen, 3 black crows. And we're still bullish. Get ready, 67.40s at $5.20 at 35.30. 5.20, got it. Okay. 40's at 520. Oh, no. Just like before. 3 black crows off the 200. I got the 67 40s at 520. 3 black crows. I kind of jumped in early. I should have waited for that 4th candle, knowing that we were close to that 200 SMA. So if we do hit the 200 SMA, I'll grab another one. Just like I did here. You watch. Jim, you're up $30. Oh gosh, look at that, $50. Oh, I'm up $80 a contract. Again, to the right shoulder of the inverse head and shoulders, right above the 200 SMA. On the 1 minute time frame. Meta's pulled back some. Damn, Jim. I've never seen anything like this. What are you going to do? I'm going to hold on to these. I think we're going to break out. Snake breakout. Well, call that the breakout. And this is the pullback. So the boom will be up here. Oh, a new head and shoulders. We got to break a right shoulder. So that's a double top resistance. That's going to be hard to break. Jim, you're up $20. Have you ever thought about selling and buying a boat? If I break the 200 EMA, I'm gonna be a goat. This can pay for my steak. But I wanna wait, meet that out at the lake. Come on, let's break. We got the right shoulder twice. I'm just very kind of, I don't know, I don't feel too comfortable. Don't forget it's Friday and there's a war in Iran. Yeah, if I get close up to the top again, I'm going to get out and wait and go eat and then come back. But right now, Jim, you're down $70. Have you ever thought about selling or buying back in? Oh. Time to put this up, get Cerium. Oh. Oh boy. Well, there you go. Coming down to a double bottom. For this to stay bullish, it has to hold here. Or more drama. This Friday, you don't want to take too much risk. Come on. Come on, you piece of shit. Uh-oh. Should grab a couple more right here, but I know I'd get caught in this. So now I gotta have chips and salsa and wait. That was on 2 minute. One minute looks promising with that hammer. Mez pulled back, but not to my alert yet. Nvidia's pulled back. AMD's pulled back. Apple had a new low a bit ago. Coin pulled back. Mr. held up. We got a double bottom on AVGO. Intraday. IWM, that triple top, pulled back. Now you're at a Head and Shoulders on the 5-minute, 5-day setting up. That's IWM. We got a new low on QQQ for the intraday. Same as a SPY. New low. There's some selling going on. Google and Magnificent Seven are green. VIX at 2650. VIX. And be adding on here in a second. Some profit up. Don't know how good I'll do on that first one. Come on. Don't do it yet. Oh, that sucks. I tried 290. Come on, give it to me. Come on. $2.90. I smelt it. God darn it. That sucked. There it is. I'm going to get it. Give it to me. It's nothing but a tease right now. It's the hardest thing to wait for. It keeps. I could get 295 easy. There it is. Come on. There it is. I got it. Now let's go. I need a breakout. Bum. I need a miracle. Gosh, come on. I feel like I'm kind of too far out, but come on, beers. Not doing good here. I have to stop out because this, I don't want to get too much hurt. Dadgummit. SPY, I got 665.71 next. We're getting real close to support down here on the IWM. SPY just hit my support. Ooh. More drama. Dang, they let it go. That's $3 drop just right there. $30 clicks. Well, we're at another support on /ES. God. Well, that kind of shocked me.
Between your accounts is easy. Cash moves to your brokerage account. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Blanket.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Oak. Financial future. Oak. What should I eat?
Good morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Jenny Horn coming to you live from our Chicago headquarters. Here's what's coming up on today's show. Our 360 Spotlight will bring you the latest on the consumer sentiment data and how inflation is impacting the K-shaped economy. Now, Meta's delaying its
bearish
project to at least May amid performance concerns. George Schultz will bring you details and an example trade in our disruptor. Adobe posted better than expected earnings after the bell yesterday, but shares are lower in response to its CEO stepping down. Our 360 panel
You got a double bottom on the 5-day.
Outlook for the future of the software company. Now let's check in though on the overall markets as we are seeing some modest weakness today, although the Dow hanging on modestly to a gain up about 0.1%. We are still seeing some collective weakness to close out an expected losing week though. In the Nasdaq down 0.3%, the Russell, the worst performer, down 0.4%, and the S&P's basically lower but modestly so. Now checking in on some of these futures products, we are seeing some weakness in the 10-year. The U.S. dollar actually
6.4308.
about 0.5%. Gold contracting by about 1.5%. Crude oil surprisingly actually relatively quiet today. Well, Bitcoin is really a standout, seeing some recovery after, again, a week of more beaten down price activity. But the real divergence we're seeing here in the overall markets is the fact that crude oil higher and higher seemingly is sending the markets lower and lower. So everything's a bit more muted today versus just the last 4 trading sessions, of course. But now for a look at some of the top moving stocks in today's market, I'm joined by Kevin Green, senior markets correspondent on the Schwab Network. And so, KG, I know that you were diving into all of the latest with CF Industries. Actually, I heard you talking about it yesterday.
Now hit my
radar.
second support channel. Second support.
Unfortunately, a bit of a laggard, but again, this name is still, even with a 6% contraction, up, now about 11% this week. And so, walk us through the latest, the rise and then now fall of CF Industries.
Yeah, we are seeing
One
a
spy.
pullback. This is after a strong run here over the last couple of weeks. Obviously, the Middle East conflict is actually putting a little bit of pressure, not only in the energy space, but also in the fertilizer and chemical space. So names like CF Industries or Nutrien, or even Dow Chemical for that matter, have caught actually a pretty decent bid this week. And what is actually very interesting is the market is positioning that these disruptions will last for a relatively long time, and that CF Industries could be a beneficiary of that. They control around 40% of the North American nitrogen fertilizer product market, and so if we do see prices moving to the upside, obviously they're going to be able to push those prices on the consumer, on their own customers and consumers, and that also could actually expand margins, and then we could see maybe a little bit of a redirect in demand where CF Industries actually
Good morning,
those,
everyone.
Positive tailwinds because of this conflict. So that is why we are seeing this move higher. Now, you are also seeing a combination where natural gas prices inched up here a tad bit over the last week or so because natural gas is a really key input when it comes to fertilizer like potash and things of that nature. But we also have to be mindful as we do see prices for oil moving to the upside. We could see rigs coming back online. That means that U.S. oil production could increase. Along with that, oil production means an increase in natural gas supply. So this is kind of a unique situation that we will see an impact over the next couple of months. And unfortunately, for those farmers out there that are growing crops like corn and soybeans, they may see some pressures heading into the planting season that they did not foresee maybe 2 or 3 weeks ago.
Okay, I know they're not the only name that has seen, this volatility. We also saw LyondellBasell be an outperformer yesterday and tied to this similar news. And so there's other pockets that are being affected in the broader fertilizer space. And so what other names, I mean, are you watching as we do navigate not only the Middle East supply chain disruption, but also this right now cheaper U.S. natural gas compared with Europe?
Yeah, so within the space, once again, Nutrien, which is ticker symbol NTR, also Dow, it's called Dow Inc. right now, but formerly Dow Chemical is another one. A lot of these stocks actually have very low relative float and don't get a lot of attention when it comes to the mainstream investment community. So you are starting to see maybe a FOMO feel that is taking place, and buyers are trying to step in because this could actually have a lasting impact here in the market. Keep your eye out on a couple of other agricultural names that will also have a sympathy play for this as well. ADM, Archer Daniel Midland, is going to be another stock that has been moving up actually really well over the last 6 months. And ConAgra Brands, which we did see a pullback of around 6% because of some other issues when it comes to their business in Brazil and trying to export soybeans there. But that's another agricultural stock that has been on the radar for a lot of these traders. So this is a unique industry, and now it's getting a little bit of attention, and it doesn't take much to have positive institutional inflows really impact these companies to the upside when it comes to stock valuations.
Yeah, and as we of course have seen this week, as we did see new highs on Thursday, but then today giving back some of that strength, but not all the way. We're still again in a pretty nice run this week, all things considered. So appreciate it, Kevin Green, for all of that breakdown. But now to shift and get some insights on the news shaping the overall markets, and for that we welcome in Ed Siddell, CEO of Chief Investment Advisor of EGSI Financial. So durable goods orders, excluding transportation, did come in solid. So with strength across metals, machinery, and electronics, Ed, what really does that tell you about the underlying business demand right now?
Honestly, what it's showing us is that the economy is going in the right direction. Moderately so, stable, but it's headed in the right direction. You know, also when you look at personal income, you know, it's up 0.5%, and again, it's showing that things are going in the right direction.
So as far as personal income, and you mentioned, of course, it did rise while spending outpaced income, but really, how much of that do you see attributed to tax refunds versus genuine momentum?
Well, honestly, we believe it has a lot to do with the tax refunds, and I think we're going to continue to see more of that because that's found money for a lot of families that they didn't have before. So it is creating that immediate disposable income, and they're making use of it. And we see that continuing all the way through the month of April going into May.
Okay, and so do you see any risk of spending continues to outpace income, or does the labor and income backdrop give consumers enough cushion for now?
Yeah, when we look at the revision of GDP downwards, you know, that's really not a big concern to us right now. The way that we're looking at it, we think that has more to do with the government shutdown. But we're keeping a very watchful eye because obviously as oil prices continue to rise, you know, that could damper a lot of that spending going forward because the prices at the pump, that has a huge impact. And so that disposable income from the tax refunds could impact that spending because they're using that to cover transportation.
Okay, and so obviously rising oil can be a pretty substantial swing factor for inflation and growth. And really, at what level does oil price pressure start to then meaningfully change, I mean, some of the expectations now for this year?
Come on, that's baby. That's a great question. I think really what we're going to have to see is get it back down to, you know, the low 60s where it was before the war in Iran. And the problem is that when prices go up, the oil prices per barrel, gas prices skyrocket. And as they come down, the prices at the pump, they're going to slowly come down, not as fast as they went up. So really, we're keeping an eye on the war in Iran. It can't be prolonged. It has to end sooner rather than later, as everyone would agree. Especially as the driving season really starts to hit around Memorial Day going through the summer. So we think that that's really going to impact families going forward.
I mean, absolutely. I do feel like right now the timeline and the uncertainty surrounding the timeline is also just considerably a risk because no one really knows for sure how long this conflict is going to go on. And so as far as, I mean, all those concerns, pricing some of these geopolitical risks, I mean, it's a difficult thing to navigate. How would you say you go about the uncertainty when everyone seems to agree we're not really sure how long this is going to last? And then, of course, the broad implications only get worse as it goes on longer and longer.
You're absolutely right.
She
one of the
is
things that
right.
We're keeping a watchful eye on. We talked about GDP. We talked about oil prices, and oil prices as they rise. I mean, that's inflationary. What we don't want to see happen is having those estimates for GDP continuing to go down as inflation goes up, because then we're really it's more of a stagflation kind of situation, and that's never good. But as far as the markets go, we're really not seeing panic either in the equities or the bond markets. We were expecting a pullback in the first part of the year anyways. We're actually looking at the Iran war as kind of that tipping point, that really the catalyst to create that. And as long as the war is short term, we think that we're very cautiously optimistic that the market's going to turn around and finish positive.
Okay, I like that. I like some optimism for this Friday. And so you did mention some of the actual stability we've seen in not only just equities, but bonds. And has that surprised you, given, I know this week, it's an interesting week to say stable because it hasn't felt that way, but when you assess this year, frankly, it has been.
IWM double bottom.
Broad market positioning, given that optimism, and also just, again, the fact that we have been fairly resilient. And again, I know this is a weird week to say that, but all things considered, you look at this year, it's been better than feared.
When we're looking at the bond markets, as rates have come down, really the Feds are looking at PCE, they're looking at the numbers, they're also looking at the war in Iran, and they're going to have to make that tough decision. Should we lower rates, and what's that going to look like? And I think that's going to be a determining factor as it relates to the bond market going forward. Obviously, there's some credit issues going all around, from the used car markets to some of the private equity funds and the closed funds. But I think as a whole, people are very comfortable. They have confidence in the bond market so far. So we really don't see any issues.
Okay, I think that's interesting because, again, it feels like we're so quick to call doomsday, and it's perhaps maybe a bit too soon and maybe a bit of an overreaction at this point. So I like that. The optimism on this Friday. So appreciate it, Ed Siddell, CEO and Chief Investment Officer of EGSI Financial. Thanks so much for joining us today. Now, plenty more to come on Trading 360. Next, it's the big three stocks, 3 charts, and 3 trades. Rick Ducat will go through the technicals, and Tim Bowen takes us through the trades for Palantir, NVIDIA, and Alphabet. That's next on Trading 360.
Oh yeah. Looks like 63's got a break. SPY and SPX. The 9 on the IWM. And the 63 on the QQQ. Boom, boom, bam.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the
I don't know if I'm going to get what I want out of this. I might have to just get out.
Opening Bell, live at the NYSE, right when it counts.
She looks like you, Pat.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now.
Schwab?
They have everything we need all in one place.
No way.
College fund.
I've been learning about new trading strategies.
Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Welcome back to Trading 360. I'm Jenny Horn. It's time for the big three. 3 stocks, 3 charts, and 3 trades. Rick Ducat will take us through the charts, and here to take us through the trades, Tim Bowen, Chief Technical Trainer at StocksToTrade.com. So, of course, great to see you both, but let's start with the big picture, the overall markets. Tim, we are in a bit of a mess this week, but I will say at least actually as I'm watching, things are turning more positive. So you must be bringing some optimism to the market. Tell us about your thoughts on just the overall geopolitical and macro environment right now.
Well, first off, I usually am pretty casual on these appearances, but FYI, if I'm extra casual today, massive winter storm in Michigan. I was actually just on the roof setting up my Starlink so that I could make the appearance. I didn't want to miss. Almost fell off the icy roof, but I got her done. But that being said, listen, it's that same level that
You're a tough
I talk
guy.
about pretty much every Friday. That kind of 6,700 level on the S&P that we still manage to have found support at. And the point I look at, and the previous guest kind of mentioned it too, and you mentioned it, Jenny. It's like just nonstop bad news. I mean, it's tough to find anything that optimistic market related. Every data point seems negative. Every news item seems negative. But what I like about that is how resilient the market is. I mean, we, just can't get above that 7,000 level. But I think that, a lot of people have, kind of a corny thought experiment, but you go back 6 months and you list out like all of the things going on in the world right now to somebody back last fall, and I don't think they'd be thinking that the S&P was at 6,700 at that point. So to me, that shows that the market has resilience. That shows that there's still enthusiasm out there. People are willing to invest in, particularly a lot of like the AI plays that I'm going to talk about, energy stocks. I shared Chevron last week, and it's at 52-week highs. So I hate to quote that one guy on the other market or other network, but if you know how to look, there's always a bull market everywhere.
Jim Cramer.
And I so agree, and actually that's previously what our guests just talked about. I mean, the resiliency we've seen in bonds as well as equities. It's frankly amazing, and again, I know it's a weird week to say that, but you still, assess 2026 so far, you definitely see that
Boy, you couldn't fool
in the
me.
market. But let's dive into some of these AI picks. Palantir is where we'll start. I will say Palantir is to me always interesting because not only is it an AI tech play, but it also has that massive defense exposure, which frankly has been a huge boom for it. I know we've pulled back about 28% from highs, but hey, 88% gain still in the last 52 weeks, not too shabby.
Yeah, I think, this has been one of my favorite ideas over the last couple years. I think I got to go back and look. I've probably shared it 5 or 6 times on the big three. But as you mentioned, a couple of my main interests, I started an internet company. I actually dropped out of high school to start an internet provider way back in 1994. That's why I'm blown away by that Starlink. I can just throw it on the roof and it works. Wasn't that easy back in the 90s.
No, it wasn't.
But I'm also, just a student of the U.S. military and defense tech particularly, and I love that combination that Palantir brings together. And then the other reason I brought it up is maybe some of you guys saw some of the clips, but Alex Karp had some appearances yesterday, talking about their technology and his mindset. For me, it's just hard not to get excited about a company when you've got a visionary like Alex Karp. Again, it dates me, but I grew up in the 80s and 90s, a fan of Steve Jobs. And I'm not saying Alex Karp, Steve Jobs, but wow, he's a unique thinker. He's driving this company. You've got AI, you've got military technology in the middle of a potentially, regional and hopefully not bigger conflict. So that being said, absolutely love Palantir.
Yeah, he's a visionary, and he always gives us great earnings calls. I'm always like, you have to tune in yourself to really get the full scope of like what he's about and where the growth in the company is headed. Because I mean, their metrics are just outstanding quarter after quarter, and really because of his optimism too. I mean, it's a great earnings call. I always tune in. So now, as we do think through looking at the chart of this name here, Rick. I mean, again, we pulled back considerably from highs, but are actually in a pretty nice bounce from these recent lows.
A name that, amid the software sector devastation, has held up a bit better than many of its peers here. But what we can see, a downward sloping trend line, as you said, kind of taking us down from these highs near 207.50 or so. But from there, we have broken out to the upside. Our blue downward trend line has been broken. Our white short-term trend line is still tilting toward the upside here after price solidified near about 125, 130 or so around this general area. You can see that was a small range-bound area previously here. Then the subsequent lows after the upside breakout align with the old highs. So 120 to 130 roughly would be a supportive zone if price were to take another leg downward. But to the upside here, 169 stands out. That was a low point after a gap up here, and then a repeated low and high point previously throughout the past couple of 3 quarters or so. So now, if we were to look at our other studies here, our moving averages that we follow are all kind of clumped together between roughly 144 to about 155 or so, about a 10-point range. So we can see that when we do have these sideways consolidating moving averages, it speaks to a lack of strong directionality here. So now, as we do see them kind of start to coalesce toward each other, our strongest source of support, our 251, is the yearly EMA. That's the one that comes in near about 145. So that would be the most important boundary to keep an eye on in this name from our moving average perspective here. RSI trailing off somewhat here. Green trend line has been broken along with our price trend line, our shorter term one, on the verge of crossing back below the 50 midline on the RSI, which would be a bearish shift if that were to happen. Our volume profile studies show that we have nodes here near about 124 to 140, and then we are on the verge of potentially giving up the area from 150 to 160 or so. Our point of control comes in near 154. Things pick up again starting around 180 or so.
Okay, and so now to shift into another name that is, of course, seeing also some AI favorability, and it's such a massive player. It's hard to even say what it does. That's Alphabet here, which, when walk us through your thinking with NVIDIA is where we'll go next. We'll do Alphabet last, but NVIDIA here. Also, I think you have to believe in NVIDIA for the overall market's performance. It's such a huge component of not only AI, but just frankly, the overall economy right now. And so NVIDIA, while it has pulled back, I mean, it's always an area for opportunity when you have a name that is so powerful like NVIDIA.
Yeah, and speaking of visionaries, I mean, it's kind of my theme today, but Jensen Huang, another just very unique thinker that's driven this company over the last couple of years. Now, couple reasons I bring it back. I mean, you look at, and I'm really looking forward to Rick's breakdown here because, like, in my opinion, we had that massive run up over the last couple of years. Obviously, probably the best performing stock in the entire stock market. But then you go back to about August, September, and we've just been stuck in this range. Basically, I mean, we had that little spike in November, came right back into the zone, and it's just built this massive 8-month base here. And one of the reasons I brought Palantir and NVIDIA today was because of that partnership they mentioned yesterday of building their own full stack AI operating system, particularly for government and military applications, which I'm sure has a lot to do with what Anthropic did a couple weeks ago. But I think, now we'll see, I'm really waiting for this stock to break out of that range in like 195, etc. But after 8 months, this stock just seemed like it's got to break one way or the other. It's just consolidated for far too long. And in my opinion, that NVIDIA and Palantir news could be the catalyst to finally push it back to new highs.
Yeah, and NVIDIA also with another stellar earnings report.
Spy pullback again.
Maybe as optimistically by the market, but again, I think just because there's so much scrutiny on NVIDIA right now, it's like they could post even better growth beyond even what the street's expecting, and still, for some reason, we're quick to point out the criticisms, but still, his name, as you mentioned, has actually held on relatively stable. So, Rick, as we do assess this chart here, as Tim pointed out, I mean, we've established a pretty nice base now at these current levels.
Yeah, about 170 to 195 roughly. That's where most of the price activity has taken place. You can see here's our November spike to the upside that quickly dissipated. But yeah, I mean, low volatility often can be the precursor to high volatility.
Boy, that's a
as
nice
the,
looking flag.
Kind of, lines in the sand become increasingly entrenched. You know, the
it really is a nice looking
positions get
flag.
more and more established here. So if you do eventually start to get price tipping above one of these important points, it can trigger the cascade of orders that results in a breakout type of price activity here. So you could draw the sideways horizontal lines. Another way of thinking about it would be drawing our symmetrical triangle type shape, our two white trend lines converging toward each other in an increasingly narrowing range. So again, kind of there's two different sets of boundaries. The triangular boundaries would be a bit closer, perhaps around 174 to about 185 or so, 175, 185 around that point. So when we were to look at our next set of studies here, even more clustering together to an even greater extent than our last chart here. Everything kind of converging for our shorter term. Moving averages near about 183, 184. So we also have our yearly 251 at about 168, our orange line there. RSI exhibiting a matching triangular shape here, a hair below the 50 midline though, suggesting more of a bearish outlook here. When we do look at our volume profile study, our thick red line here, our point of control, 182 roughly, is in our most important volume node here. 175 to 190 is really where we match up with our range-bound activity. You often find heavy trading volumes lining up with these range areas here to help identify the important areas of price activity here. So if we were to start to move downward, another small pocket of volume comes in, 155 to 160. Things really start to thin out. Above 190, as I said.
Okay, yeah, and the name that's modestly lower today. We're down about 0.7%. We also do have GTC next week to look forward to as a potential catalyst. Now, last but not least, now we'll discuss Alphabet, which is lower, of course, this year, pulling back about 12 and some change percent from its highs, but it's held on actually relatively better than a lot of the Mag 7 in the broader software slump we're seeing.
Yeah, so a couple things happened this week. Actually, I think both of them were yesterday. So Google is a name that, actually, again, repeat name that I brought. They're still my favorite, big name, publicly traded AI play with Gemini, etc. There's so many of these companies, Apple, etc., that are using their technology. And at this point, as much as I love Anthropic and use Claude every day, we can't trade that. OpenAI is not public yet. So I think that you couple that with Meta, basically sounds like they're scrapping their latest in-house AI, Avocado. Maybe you should come up with better names, Zuck. But anyway, Avocado. And then the other thing, Elon kind of sounds like he's burning down XAI to start over. He tweeted the other day, or I think yesterday, that he had to do that at Tesla. He's had to do that at SpaceX. So I think as much as I believe in Elon and XAI, that's going to take some time. So I think that those two situations have kind of opened up the potential for Google to get more partnerships, to expand, etc. And out of those big three, again, we can't, as traders, we can't trade XAI, we can't trade Anthropic, and we can't trade OpenAI. I think a lot of money will just rotate to Google because Gemini and Nano Banana and all of their tools are amazing, and I think they'll benefit from this opening from Meta as well as XAI.
Okay, and I love the call out of Avocado. I was thinking the same thing, so it's just strange and misleading name of what was an AI product. To me, it should be like a back-end service of a kitchen or I don't even know what. So I totally agree, strange naming. But Gemini has continued to emerge really as one of these front runners, especially hearing some commentary from CEO Mark Benioff, who's praising Gemini over ChatGPT. And so as we look at Alphabet's chart here, Rick, again, not immune to the pullback, but at least, hanging on relatively more stable than, say, a Microsoft, an Amazon, and an Apple.
We're only down a little under 13% off the highs. So this is a stock that it seems to have held up a bit better than many other names in the tech sector recently here. We did have our highs near 349 here after earnings. From there, we have transitioned into more of a falling wedge type of shape here. Our two white lines converging toward each other, but both pointing downward. Now, kind of counterintuitively, this is actually regarded as more of a bullish type of setup here. So we are starting to test that upper boundary. So if we start to push above 305, that could be the recipe for an incoming breakout here that could next test the 320 level, a repeated area of price stopping and starting. So now we can see, similar to our last chart, moving averages clustered together very closely. In this case, they come together between about 305 to 310, but look at our yearly 251 in orange all the way down here near 256.50. So that's kind of speaks to the strength of the rally here and how well things have held on despite the recent broader declines in markets here. RSI trending upward, so seeing a bit of improvement in momentum here, but we are still below the 50 midline, so the bulls would want to cross above that level as well. So now we can see our volume profile study, a lot of the activity concentrated between 300 to 320 or so. Another pocket down here, 277 to about 290. It would be where things would potentially find a foothold once more.
Yeah, and I will say, the only name of these three, at least higher today. So nice place to leave it. So appreciate it, Rick Ducat and Tim Bowen, Chief Technical Trader at StocksToTrade.com. Now, coming up next, we're going to spotlight consumer sentiment. We'll dive into all the expectations and how these numbers perhaps are shaping the overall market. Coming up next.
That's correct. Ate the last of my salsa.
Sometimes, you know, you could have done better. Same goes for where you invest. With Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
CrowdStrike down $5 with a double bottom.
Welcome back to Trading 360. I'm Jenny Horn, live in our Chicago headquarters, and it's time to spotlight consumer sentiment. So we did have this data this morning to help us really give us the state of the overall U.S. economy. Joining us now to help break it all down is Eddie Yoon, partner at Gray Space and the co-founder of Category Pirates. Eddie, always love chatting with you. Walk us through your initial thoughts here on consumer sentiment.
Yeah, thanks, Jenny. There are three numbers that I'm worried about. One is Michigan sentiment came in at 55.5, so slightly lower than February, so it's not getting better. And largely, you see the other number that I'm worried about is that disposable personal income grew about 2 times faster than personal consumption expenditures. And so that's notable because most of last year, the opposite was true. People were spending faster than their disposable income was growing. And so there's been a slight shift here. And the third number is the one that everyone's been talking about, thanks to all the conflict in Iran. U.S. oil prices are up 42%, higher than pre-war prices. And so anytime the consumer is going to drive by a gas station, they're going to feel poor. And so they're going to belt tighten until they get some confidence and resolution around that.
Okay, and so as far as how we're seeing this play into like the consumer habits, and obviously I think that a global war and the global presence of uncertainty is also impacting just the everyday person. How could it not? And so how are we seeing this shift to some of the behaviors in real time? Like, are consumers right now seeing some of these headlines and saying, hey, I should maybe budget for this?
Yes, absolutely. And I think one thing that is working in the consumer's favor is AI. Everyone's been talking about AI, but and not only is it happening on the B2B side, but on the consumer side, it's very much present. We see from IBM about 45% of consumers are using AI for buying journeys, so they're using it to read reviews and shop. 51% are turning to AI for financial advice, according to JD Power. So people are kind of doing both to make sure that they can save money where they can, and when they spend money, they're spending it smartly. And so that's the part that's been interesting. And you see it kind of ripple effect through a couple of different ways. And so not only is the consumer smarter, but AI is actually not just a Mag 7 effect, it's actually transforming old school categories as well, as like Walmart. This is pretty interesting. Jenny, is that they generated about $6.4 billion in advertising globally last year, growing at 46%. That was about a third of their operating income. There are tools like Sparky. I guess 81% of Walmart shoppers are using that to read reviews and check product availability. And what's notable about 6.4, that's a third larger than Twitter's ad revenue was at its peak at $4.7 billion.
Yeah, that's a great point. And I think it's also been so interesting to see how this is influencing like marketing, like the way companies are targeting now consumers. And I mean, frankly, I think it's actually kind of nice because it's typically more catered to you as the consumer based on your browsing history. I think it's a wonderful thing from maybe my own perspective. And we know that this has also been really a part of perhaps rewarding more of this professional class. And so walk us through that, because again, we're seeing this impact different parts of the economy that I think that were initially not read through. And that's become really interesting to see how it's like playing out into some of these, I mean, again, like the professional class workers.
Yes. Well, so the knowledge worker, Category Pirates, we wrote a book called Knowledge Worker is Dead, in part because the proactive are the ones that are using it, like lawyers who are really going in on AI to find clients. And so in our book, Creator Capitalists, we wrote about a couple of our pirates, Pirate Nick Kringus and Lydia Focchini, who are legal tech entrepreneurs. And what they found was that the vast majority of personal injury attorneys are AI invisible, meaning, Jen, if you have a conversation with Claude about them, they're not going to pop up. They put all their money against SEO. And here's the problem, is that what they found was that SEO ranking had a 0.076 correlation with AI visibility. So what you were good at before is not going to translate to it now. And I know this personally. I broke my ankle at Lifetime Fitness. Where did I go? I went straight to AI to ask it medical questions and about my injury. Google never got a glance with it. And so that's a real concern. And anyone, whether you're an attorney, whether you're Walmart or you're a shopper, you're going to see it in a ripple effect where Walmart obviously up, 13% year to date, 49% year over year, but a company like Kraft Heinz that is not probably as embracing AI as they should, they've been down year to date 8% and 26% year over year because people are using AI against them to figure out, hey, is this branded product actually better than private label? And now that private label's continuing to grow 3 times faster than brands, I think they're going to lose out.
Yeah, and I mean, you talk about it disrupting these more traditional spaces. I use it I was just trying to rewire a plug in my home, and I was using it to help me with that, which I was successful. So talk about a legacy of the economy that perhaps I'm even disrupting myself. So as far as some of these winners and losers you see that will be part of this broad shift to AI, I mean, you did mention Walmart, but what else are you seeing as far as the pockets of strength and weakness naturally?
Yeah, no, and anyone else that is just proactive about it, using AI not just to cut costs, but to enhance their super consumer experience. I mean, Walmart's just done a masterful job. Like when they acquired Vizio, you were kind of like, why are you buying a TV manufacturer? But now they have 170,000 TVs in Walmarts that are advertising. They have connected TV as a result of that. And so the companies that are spending money and betting on the future using AI are going to win. And so I would not have expected Walmart to have made this pivot as successfully as they have done. And so they're a great example of you got to embrace it, otherwise you're going to be left behind.
Yeah, and Walmart has really, I think, continued to impress with this omni-channel presence. I mean, it's really now a powerhouse that should definitely not be written as like the second player to Amazon. I feel like they've emerged as really a point of strength, and their chart, frankly, this year really speaks to that. So appreciate it. Eddie Yoon, partner of Grayspace and co-founder of Category Pirates. Always a great discussion. Now, coming up next, we'll discuss the disruptors as we look at Meta after a delay in its broad push to AI. We'll dive into that coming up next.
Boom, boom, boom.
Big day. Keep calm. Keep it calm.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Jenny Horn here in our Chicago headquarters. Let's head though out now to New York for a check on the overall markets and welcome in Nicole Petalides, host of Opening Bell and the Watch List. Nicole, great to be with you here today. We're 2 hours, of course, into the session. What stuck out to you so far?
Look, we have to continue to follow the oil story. Right now, we're seeing oil at $96 the barrel. Had been $120 earlier in the week, but the volatility in oil is spooking the markets without a doubt. Iran, the war continues, Strait of Hormuz closed, and just the disruptions that's happening in the big picture. And that now, a lot of folks are saying it's going to take a quarter or two to normalize everything that's been happening. In the meantime, stocks are faltering and losing some of the momentum that we saw early on. We're seeing the S&P down for the third week in a row. We haven't seen that in a year. So the selling continues underway. We did get in GDP, which was revised lower. We had the core PCE inflation print, which rose, and it's at the 3.1% year over year. President Trump is calling for an immediate rate cut. And March 18th is when the Fed meets next, and though it doesn't seem like they're going to be doing any cutting, the president is calling for that. In the meantime, we continue to watch some of the movers. Linares to the downside, Adobe, Ulta. Those have been some of the names that have reported in the last 24 hours. We've also watched jolts and consumer sentiment. But as we go into the closing bell, we'll see what happens, whether or not we can hold any of these gains here, because right now you've seen the S&P 500 turn into the red. I'll also note the last thing, with a stronger dollar and the 10-year bond yield of 4.25, and that's the highest level that we've seen since early February. So a lot to take in.
Okay, and some of these individual movers, one of the more notable is Ulta falling over 11% as their CEO issued a warning of global uncertainty. And so walk us through these numbers and where really that uncertainty stood out, because again, pretty blistering move to the downside here.
Yeah, it is a big move. In fact, it's the biggest move that we've seen in 2 years, Jenny. I know you and I were talking about Ulta earlier, and it's had an incredible run. It has been a bright spot, sort of a gem in the, consumer staples. People want to spend. They've been focusing not only on makeup, but also on wellness, and they've had a lot of bright spots. But I'll start with the down arrow, and that is just some softness in the guidance going forward, the concerns and sort of cautious tone from the CEO, just talking about the uncertainty that we're seeing in the potential for the economy, the change in volatility. So, and also some of the supply chain inefficiencies. Those were some of the things that hit this name. But I'll tell you, a lot of the analysts still like this name. Deutsche Bank likes it. In fact, they talked about the hot streak that Ulta has been on. They love the Selena Gomez line, Rare Beauty. Saying it did even better than Rihanna's Fenty Beauty, that they have the right leaders in place, they have improved execution, they have key investments that are working. What was another bright spot was the average ticket price. People are spending more. I mean, you almost can't believe it, but 4.2% higher rise in average ticket price. And the number of transactions, so more people are going in there. That rose 1.6%. So those were some of the bright spots in the big picture. And we did see comp sales rising 5.8%. And yes, it was 4.25%, so that was good, and it was certainly better than the prior year. And for now, you see this big pullback, as I mentioned, the biggest in 2 years. But you do have a lot of the analysts. You have TD Cowen with a 750 and Wells Fargo with a 475.
Yeah, and unfortunately not seeing really any improvement here in real time, where there was still definitely those bright spots to look out for, as you did point out. So appreciate it, Nicole Petalides, for that breakdown. But it's now time for the disruptors. So George Tillis, Senior Markets Correspondent, is here with today's company, Meta, delaying the launch of its avocado AI model. And so, George, what does Meta now potentially maybe turning to Google's Gemini say about, frankly, the competitive and very expensive nature of growing in this AI world?
Yeah, I think that's part and parcel of what's going on with Meta, the expense to play catch up in terms of AI modeling, but also CapEx expenses in terms of building out hyperscale data centers and the infrastructure that's needed. And I think that's the overarching problem with the stock since last year, with the stock down about 19% or so over the last 6 months. And today we're seeing a little bit of a drift still to the downside by about 3%. And this was backed based on some news of Meta Platforms delaying their avocado AI platform that was essentially supposed to compete pretty aggressively with Google's Gemini. But also, I suggest this oligopoly that's developing between Gemini as well as Anthropic and ChatGPT. Those three seem to be now, leading the race in AI, inference technologies. So Meta Platforms looks like they're behind the curve, and they looks like they're delaying it until May, based on some operational and performance concerns. But they did talk about how they're going to offer licensing partnerships with Gemini until they can shore up their own technology. So either way, with the market today very volatile, you're obviously seeing some apprehension to buy Meta Platforms, a little bit additional selling pressure in the name. The other thing is irrespective of their CapEx for their own AI technologies, the hyperscale CapEx has been tremendous for this. If you look at sales last year at around $200 billion, and the estimated CapEx spend for this year between $115 to $135 billion, it's about 67% of their total sales for last year. That ratio is very high. It's actually the highest if you look at CapEx to sales out of all the other mega caps out there, with Google being second to Meta. But also on the other side of the spectrum, Apple has the lowest CapEx to sales ratio, and they've also, as a business, decided to adopt Gemini.
Okay, and so as far as now looking at an example trade of Meta Platforms, walk us through your thinking here.
Well, you know what, Jenny, if you look at volatility in the markets, elevated. Anything above 20, that's a sign we're going to sell premium, so we're going to do that here as well. I think if you look at Meta Platforms, the CapEx to sales ratio, which is high, is really manifested into that decline over the last 6 months. From a technical standpoint, to help smooth out the price action, if you look at the weekly chart, it seems like it's nested right around the 100-week moving average, but it also could fall further to the most recent pivot point on the weekly chart going back to November of last year, which is approximately $590. So I'm going to use that as a shelf for our trade, or a potential shelf, and I'm going to go out to April, about 35 days expiration. I'm going to sell the 590
right off support.
580 put spread. So selling the 590, buying the 580 to offset the risk, and altogether you could earn about $2.50 a share, or $250 a contract. So the whole premise behind the trade is to basically allow the stock, if it needs to, drift lower, holding in anticipation of the trade, the 590 level between now and expiration of the third week of April. Now, if it doesn't hold that, you have to consider your break even, which is essentially 587.50, and you're earning 250, but your risk is 750, 33% return on risk, and that full max loss of 750 would occur if the stock just flows out below the 580 level by expiration. But the other thing is the technical pattern of that 590 price action matches the delta on that 590 put that I'm selling, which is around a 30 delta. So that implies, probability-wise, about a 70% probability that the stock will expire, or the stock will trade above 590 between now and expiration the third week of April.
Yeah, and a name that's seeing also some modest weakness today as the market is seemingly not sure what direction to go right now, but appreciate it, George Tillis, for that entire breakdown. Now, coming up next, last but not least, it's time for our 360 round as we highlight Adobe.
Looks like it wants to go down, baby.
6.5% on the session on news its CEO is stepping down and some growth metrics that lagged overall expectations.
Huh.
Hey, Dad. I have a question for you.
Oh.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Kind of strange.
This is Fast Market, built for traders who want more than just headlines.
Touchy
We walk
family.
you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every sector.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Trading 360. I'm Jenny Horn, and it's now time for the 360 round to discuss Adobe. So Adobe did post an earnings beat, but slowing annual recurring revenue growth and announced their CEO is stepping down. And shares are struggling, down about 6.5% here. So for more on this first quarter, I'm now joined by Mark Gibbons, Chief Investment Officer at Gibbons Capital Management, and Matt Mayer, Founder and Chief Innovation Officer at M7 Innovations. So Matt, we'll start off with you. Really, what is the gap that we're seeing between fundamentals and this market reaction? Tell you about what investors are really focused on right now.
Yeah, I would say, Jenny, it's the best of times and it's the worst of times. Adobe's fundamentals are really strong. They beat expectations with $6.4 billion in revenue. The CEO mentioned they've surpassed 850 million monthly active users. That is a big number for a subscription model business. And most importantly, their AI-first offerings like Firefly, they triple that annual recurring revenue. So to me, that's a real bellwether, but the market response tells the bigger story. And they have 2 big headwinds. Number one, can they still dominate when there's all these AI native tools that are popping up like Canva and Figma? And obviously the elephant in the room here, we have the CEO who stepped down without a true successor named immediately. So those are 2 major headwinds that we really have to handle and think about if Adobe will have a light at the end of the tunnel here.
Yeah, and you mentioned on a very critical point of this report, and that's the fact that we're going to see, inevitably some leadership shakeup. And so, Mark, I wanted to get your thoughts there on how much the CEO transition matters and if it's enough to rewrite some of the growth concerns.
Yeah, I think it's it's a pretty big deal. Ryan's been there for about 20 years now, and the company is trying to put a new foot forward in this new AI era. So they really do need new leadership. I actually think that it is the right move, definitely in the long run here. But the company itself is kind of going up against a market that says, prove it to me. So right now, the numbers look pretty good. They beat on revenues and earnings in the report, and the guidance was pretty good. But they're saying, okay, well, right now the numbers look great, but what about 5 years from now? Are these business models going to survive in this new AI atmosphere? And, especially with these new AI models that are basically producing a lot of the products that Adobe does at a basically a better cost point overall. So it's definitely something the market's grappling with right now.
No, absolutely. Definitely something I think that was a huge concern or just focal point really of this earnings event. But Matt, I did want to get your thoughts on Canva, which you mentioned as a real threat. Not only is AI a threat to its entire business model, but you see a lot of these emergent names that are just like hugely popular right now, Canva being one of them.
Yeah, Canva is a serious threat
to Adobe right now. I think Adobe's actually in the middle of a pincer attack. So on the right, you do have Canva. Now you're talking 260 million users of Canva. They have their software in over 200 different countries. They continue to grow, and they are eating market share of Adobe. So that's who you actually have to watch to see, is Canva going to be leaner and meaner and using AI tools to accelerate what they're already offering? On the left side, you do have Claude Code from Anthropic. I think we saw that wipe off $1 trillion of market cap about a month ago when we thought software was dead. I think that's actually a red herring. I don't think someone in a basement is going to vibe code a software that's as powerful as Adobe that has been around for 40 years with tens of thousands of amazing engineers. But I would say watch closely what Canva and Figma do, because that is where Adobe can get really defensive and start to lose ground and not be able to keep up with the pace of AI.
Okay, so Mark, what does the overall Adobe narrative need to shift or change to really show that the next 2 quarters that it can win on value and not just really defend that installed base?
It really has to essentially convince investors that it's not, effectively a large part of its, products are not replaceable by AI. So there are other pockets within software, as we're all having this large software discussion, that seem a little bit more defensive and can be protected against this AI narrative. But really, unless they can do that, it's going to be a little bit of a rough road here, in the intermediate term.
I mean, absolutely, and I feel like we've seen that time and time again. And as we know, there's pretty loud criticisms online about now, like pricing, subscriptions, and Matt, Adobe's revenue engine does lean heavily on these enterprise contracts, but how should investors separate some of the noise from these actual real signals?
It's a great question, Jay. I would say don't always take negative sentiment as a pure signal, because I think a lot of the negative sentiment is coming from what I call the vocal minority. Yes, if you go to Reddit or Twitter or Facebook, you'll find entire communities and subreddits that are committed to just bashing Adobe for their price increases. But a single prosumer that's going to churn and get rid of their subscription is not going to actually hurt the bottom line. I think the key in the tailwind is their enterprise. Creative Suite continues to grow. If we see that these enterprise contracts continue, which I can tell you I work with a lot of Fortune 500s, to churn on your tech stack is not easy. There has to be another tool that is just magnitudes of order better. And right now, Adobe is still really strong and entrenched. So I think they're safe on the enterprise side. They'll deal with the negative sentiment on the consumer side, but I think they can weather that storm. To Mark's point, if they can just get out in front and continue to lead with some of these AI-infused tools that they're bringing.
Yeah, and I do hope that we continue to see just a broader software turnaround, frankly, would even aid some of the recent pressures we've seen with Adobe.
Back-end support.
So appreciate you both, Mark Givens, CIO of Givens Capital Management, and Matt Marr, Founder and Chief Innovation Officer at M7 Innovations. Thank you both for joining us on Trading 360. Now, I'm Jenny Horn. That will do it for us today, as we do close out a bit lower than where we started. Appreciate you all for tuning in. We do a Fast Market with Jay and King Hall coming up next.
11 o'clock.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time.
with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. It's noon Eastern here at the New York Stock Exchange. The stocks are navigating choppy waters today as the war with Iran heads toward a third week. Let's get into a check of your scorecard as we hit the lunch hour on Wall Street. The S&P 500 right now off by 0.4%. The Dow little change this afternoon as we hug the flat line. The NASDAQ 100 is lower by 0.5%, so too is the
Well, we keep
Russell
hovering down here.
2000. In terms of sector performance within the S&P
Dow Jones
500,
market,
we've been watching
NASDAQ
some of the shifting sands
down.
there. You've got utilities still leading, followed by consumer staples and financials. On the flip side, you've got information technology and communication services and materials among the biggest laggards. Here's the roadmap for today's show. We'll look at example option strategies for Apple. Plus, the team from Lightfolio will be along with new data on Dollar Tree. It's got earnings due on Monday. And NVIDIA is also on our radar today ahead of its big GTC conference that kicks off next week. Now that we've got the roadmap for today's trading action, it's time to bring in my co-host. You've got Tom White in our Chicago studio and Joe Mazzola, head trading and derivative strategist Charles Schwab, joining us once again. All right, guys, we got a slew of economic data today that hit the tape with the latest GDP reading that was revised down to show growth of just 0.7%. It wasn't the latest monthly data, all of the data. You know, we got durable goods, we got PCE. But how do you read the tea leaves on this and today's market action, Tom?
Well, I think it goes back to crude oil. I think that is taking the kind of lead where equity markets are going at this point. And we've seen that over the last couple of weeks, and it kind of pushed aside maybe some of the data points. PCE basically came in line. Core was a little bit hot on a year over year at 3.1%. So not close to what the Fed wants, right? That's their preferred gauge of inflation. But at the same time, on the GDP side, you're seeing that pullback from those levels that we saw in the first read. This is a Q2 read, or Q4 read, second time, and it came in at 0.7, so halved what way they came in the first read, 1.4%. So that's a concern. Now, there was some outlaying, maybe some non-clarity type of issues that kind of negatively impacted that GDP report, and that basically was a government shutdown for a while at the end of last year also, and you have to take that into consideration when looking at these backward-looking numbers. You know, the markets are forward-looking, right? But these are going to negatively impact what's going on. But if you saw the reversal in equities today, that's based on the fact that crude oil went from down over 2% to now positive on the day, and that's putting pressure on the equity market. The S&P 500 going for its third straight weekly loss. That's the longest streak that we've seen in a year. So that's a concern right there. NASDAQ down just a little bit on the week. Also, the Dow and Russell kind of lagging at this point, but higher yields causing some pain for equities also. The dollar's been rallying over the last week. And then there's no resolution in the near-term outlook, despite what we hear from the administration on any resolution to the conflict and maybe the Straits of Hormuz opening back up. And those are going to be the drivers for the equity market, and we're seeing that.
Joe, when you look across the heat map and the sector price action, I know we're showing the way crude oil is trading right now, up about 1%. What stands out to you when you look at the price action overall?
Yeah, good question.
I think it's interesting. We had started the beginning of the year talking about this broadening of the market and how everybody was looking at the halo trade and you wanted to own hard assets and you wanted to forego owning technology and software, and now those sectors and those industries seem to be a flight to quality, if you will, or a flight to safety. They tend to be a little bit less dependent upon any type of energy prices. I'm talking about technology in particular, and you're seeing a real narrowing of the breadth. I mean, we're down to maybe around 30% of the stocks trading above the 50-day moving average. So this whole 2023, 2024, even into beginning parts of 2025 game plan, where it was, own high quality tech that's generating a lot of cash flow and earnings, and forego or at least kind of minimize your holdings in some of the others. Those might be coming back into focus a little bit, and it's incredible to see how the rotation has occurred so quickly. But it's being driven by geopolitical events, as Tom mentioned, and even today, as a whole. I was on a little bit earlier with Sam, and at that time, I think equities were up about 40 basis points. And I said, look, this is a good start to the morning, but I'm way more concerned with the close.
Well, I want to go long so much here.
As more and more kind of news came out of the Middle East, it's showing that this is something that traders for Fridays are going to continually want to hedge and want to look to trim positions going into the weekends, because there's just too much geopolitical risk to want to hold big positions on the weekends.
Yeah, no, I just was like, let me check Truth Social to see if there's any new posts from the president with regard to Iran, because you have to pay attention to that, because that can give you some signals around where the direction is going. There were comments obviously made overnight, and originally oil prices were moderating, but as you know, they're ticking higher right now, heading for another weekly increase. And as you mentioned, Joe, markets just remain focused on that, the war between the U.S. and Iran. What's your take when you look across the energy market, Joe?
Well, I mean, look, at one point, crude was down this morning. We had news that India had gotten a tanker through. We had news that there was potential talks between Italy and France with Iran that would allow for them to get some tankers through. We had opened up, or at least we had lessened some of the sanctions on Russia to get some more crude oil, into the system. But all in all, right? I mean, as long as the Strait of Hormuz, is front and center on investors' minds, it's anything, in terms of a sell-off in crude looks short term. And until this is resolved, you're going to continue to see energy prices higher, pain at the pump, and probably some fear in investors. Now, That being said, I think it's important to take into context that we're talking about about a 2.5%, 3% move off the all-time high. So it's nothing that has been, a dramatic move. But I think it's telling that we're not getting back up into that 6,800 range on the S&P 500. Now we're having a hard time getting back to 6,700. If we see some weakness next week or some weakness heading into the weekend, we're only 50, 60 points away from the 200-day moving average around 6,600. So that's probably the next area that we test. And in a fall below that, we'll probably push it back to the October lows around 65.20. And so, those are some levels that I would not be surprised to see the market test within the next couple of weeks, unless there's some resolution. Right.
Okay. All right, let's talk about some individual movers here. You got Adobe under pressure, down about 6% right now. There's a changing of the guard there, announcing their CEO is stepping down. You also had the companies, it came out with the latest earnings release. It was actually better than expected, but, that stock has really had a tough time recently. And I would have thought with the changing at the top that you might see shares shift direction, but that doesn't seem to be the case, and maybe it's because there's not a new CEO anointed at this point. Tom, your take?
Well, I think the stock's in the penalty box right now, and if you looked at the numbers when they were released last night, I was like, oh, okay, they beat on EPS, they beat on revenue, they guided higher for Q2, pretty significantly higher, both in revenue and EPS outlook. And if you look at some of the, the subscriptions from creative and marketing professionals totaled, $4.4 billion. That was up 12%. Revenue rose 12%. And then they throw in there that their CEO from the last 17, 18 years is leaving the company. So that gets thrown into the penalty box, and it takes away all the good things that came out of this report. They tripled the revenue from the AI aspect of their side of the business. So everything seemed good. The bar was really low on the stock going into the report. The valuations that we talked about yesterday were at historic lows on a trailing and forward PE basis. But then this guy that transformed the company, the CEO, is stating that he's leaving, and they don't have anybody in place yet as the board
better get it on
for a new CEO. So yeah, it's probably going to be in the penalty box, and you're seeing the reaction in the stock.
Joe, what's your take on Adobe today?
Yeah, Tom mentioned numbers were good, guidance was strong. We'd asked the question yesterday, right, whether or not the stock, has been sold off enough to where you might get a surprise pop to the upside. Should the numbers perform well? Well, the answer to that was no. But it's not as bad as it could have been. Remember, we were talking about, I think, a 7 to 7.5% pricing in terms of the move from the option. So, 6.5% move. It's contained within that. I think I think Tom is right.
Trying to break 63 here.
This brings up questions of continuity. It brings up questions of kind of how do they allocate capital going forward. And and when you change leadership, especially for somebody who's driven the strategy of the company for 18 years, and you don't have anybody in place already, or at least somebody that was named to be in place, there is going to be some concern from the investor base, and you're seeing concern from analysts. We've had a couple cuts, I believe, D.A. Davidson, Morgan Stanley, KeyBank, all revise their price targets lower for the stock. So it's going to be in transition period, and you're probably going to see the shares in a bit of transition period while they wait for new guidance.
It does seem like that. And to be fair, over the time of his tenure, because he's been in that top spot for almost 2 decades, the shares have actually outperformed on a long-term basis, outperformed the S&P 500 over that same time period. But again, it has been very bumpy recently. And I think that Tom makes a great point, which you reiterated, that it does seem to be just stuck in the penalty box, especially given how they performed in the most recent quarter and their guidance, right? So investors are like, until we see some more clarity, we're not in on this one. This next one is interesting to me. Lennar, those shares are moving higher today. They had weaker than expected numbers on both the top and bottom line. They have a lackluster outlook heading into the spring home buying season. We were talking a little bit about this yesterday heading into this one. And then the CEO is, echoing the challenges that we've heard continuously over the past year and change now in terms of the language that they've used. about the home buying market, right? And just how challenged it is. Tom, what's your thoughts on this one? Because I'm trying to understand why, the reason why the shares are moving higher. Is there some bottom fishing here? I don't know.
Probably. You look at this is a 1 day, 1 year chart, or 1 day, 1 minute chart here. It doesn't give you the full story. Going into this report, Lennar shares were at 3-year lows, which we discussed yesterday. And then you see the top and bottom lines come out. I mean, revenue came in at $6.6 billion. That was below the $6.9 billion they expected. Adjusted EPS, 88 cents versus 95 cents. I go, oh boy, this is going to cause some more pain for Lennar. And then the comments from the CEO. I mean, this isn't a conference call you want to be a part of at this point. Some of the things, persistent headwinds from mortgage rates, affordability issues. Now you've got the war with Iran causing some consternation in the housing market. We've talked about this. There's been a rolling bear market in the housing segment, but this has been one of the big underperformers. And remember, this is probably where there's most demand, at that low end, that first house or that step-up house, as far as their average selling prices, and their margins continue to shrink. Now, they did give a slightly better outlook moving forward for the next quarter and for the full year. I think that maybe kickstarted the stock, but maybe it was an oversold position. The bar was really low going into this one. We're getting a little bit of a relief rally here. That's even with interest rates starting to rise. Remember, the 10-year yield, while it's not the 30-year mortgage rate, it's really tied to that. And we've seen that, you know, the velocity to the upside in the 10-year yield negatively impacting those 30-year mortgage rates, which are starting to creep higher a little bit. So, yeah, this is maybe the bar was so low and there's maybe some short covering at this point, but yeah, it's almost a head scratcher.
Oh man, come back down.
Why is Adobe down, and why is Lennar up when they had opposite type of quarters?
Yes, that's literally what I thought. I literally thought head scratcher. Joe, your thoughts on this one?
I think it has something to do with the fact stock's down 35% in 6 months. Yeah, it's hard to figure out, maybe just some technical oversold conditions. The hard part is just like the CEO said, I don't really see a turnaround in the housing sector anytime soon until you get mortgage rates down, until you get affordability higher. And that's not turning a page anytime soon as interest rates start to creep back up, as Tom mentioned, even on the 10-year yield pushing back towards 4.3%. So it's going to be a rough go. They mentioned that they added 14% in terms of incentives, so they're trying to get buyers back. But there's still this kind of, we haven't hit that intersection where supply and demand are really meeting. There's more supply coming on the market, but the demand's pulling back at this point right now because of the affordability. So either housing prices are going to have to come down, mortgage rates are going to have to come down, but until that happens, you're probably stuck in a bit of a glut of supply of homes on the market.
All right, good stuff. We've got bull versus bear coming up, guys. The guys will get their example trades put together for Apple. It's been under some mild pressure today. We'll have more fast market after this break.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. Apple initiating a couple moves that highlight both the regulatory pressure and pricing strategy. Among those, Apple is lowering the commission it charges developers on the App Store in China. Beginning Sunday, Apple will cut its take on app fees to 25%, down from 30%, while smaller developers will pay 12% instead of 15%. It comes after discussion with Chinese regulators. Separately, Apple's new budget MacBook Neo is generating positive early reviews. Some investors have questioned whether a lower price point could pressure margins. Some analysts argue that its gross margins remain resilient. Shares are under some pressure today. Time now for the tug of war on Apple. For that, let's welcome back in our co-hosts, Tom White and Joe Mazzola. It's bull versus bear time. So before we get to your example trade, got to get your thoughts on Apple. Joe, I'll start with you. Your take.
Yeah, I think the Mac Neo, presents another opportunity for Apple to kind of expand its product base and reach a bit of a lower end consumer. But as you mentioned, Diane, it really comes down to the gross margins, and that's what analysts will be keeping an eye on. I think the most recent report showed gross margins around 40.7%. Analysts are expecting this to take it down, to 40.6. So nothing big. In terms of other product launches, keep an eye on the new iPhone that should be coming out, the cheaper version as well there. There's also rumors of a flip phone at some point coming out. So, with Apple, as long as they can keep the margins high on the services side, they can see a little bit of a crunch on their product side, as long as it's not too dramatic. I think the bigger issue with Apple in terms of the shares as a whole is that it has nothing to do, or little less maybe to do with the product launch, and maybe a little bit more to do with the overall market, because it's not going to be insulated if the market rolls over. Given its market cap and given its contribution to the overall S&P 500, if the market continues to roll over, then it's going to pull Apple shares down. I mean, that's just kind of how it has to happen with its weighting. And I do expect a market rollover. So, I'm looking at some weakness in Apple and maybe even pushing back down towards that 200-day moving average.
Tom, your thoughts on Apple?
Well, you look at it on a forward basis, the forward PE about 30 times, right? But this comes after, iPhone sales ramped up with the release of the iPhone 17, and this is without a lot of the flash of AI, right? They've got that collaboration, that years-long collaboration with Google Alphabet. They're going to continue to leverage that. But I think one of the biggest things, a couple of the biggest things for Apple is they've got over $150 billion cash hoard. So it's kind of used as a safety play when markets are turbulent at this point. So, but it's not immune to pullbacks. I mean, we're down 12% from the recent all-time highs. But I think one of the keys is the CapEx spend for.
It starts to break out of the 63. I'll add.
And their CapEx spend is supposed to be
start a
$14
position
billion this year. I mean, compare that to what we're seeing out of some of the hyperscalers and some of the other Mag 7 names. It's minuscule. So that kind of insulates them from maybe that investment that a lot of these other companies are making. They had good sales. They had a re-acceleration after the iPhone 17 release. Just last week, they released the new products. Joe mentioned the new MacBook that's going to be competing with the Dells and HPs now. This is the lowest price, laptop that they've had. So that's going to be a benefit for them. But then you start worrying about the cost of the new products, the new iPhone 18 that Joe mentioned. How much more is that going to cost due to the components that are starting to ramp up, memory chips,
and other components within there. So that's a concern, not immune from
Break
pullbacks
it.
in the market, but this is one of the more stable companies out there, and they just came off a couple of really solid quarters.
All right, so not immune to the gyrations of the broader market. So let's get into the example trades. Joe, let's start out with yours. What's your approach today?
It's a put calendar, looking at selling the March 20th, and so, or the next week's expiration, the 245 puts, and then buying the April 2nd 245 puts. So basically it's a debit. You should be able to do it somewhere between like 215 and 230 right about now. I think we priced up around 215. And the way that this thing expands in value is if we move back down towards that 245 strike, which just happens to align with that 200-day moving average, as I was talking about. From a technical standpoint, not only has the stock been rolling over, the RSI has been rolling over. That's looking a little bit more, we're looking to show some more weakness. I think it's around 35, 36 right now. You had the 20-day moving average cross below the 50-day moving average. So, like I said, the stock is not immune to market weakness. There have been pockets of strength within technology as the market's kind of sold off. It's been interesting to kind of see the whole halo trade kind of unwind and move back into some more of the tech winners. But I think the bigger concern, like I said, is not individually with Apple. For me, it's more with the overall market, and then looking at some of the technical weakness. Now, the way that this thing expands in value, like I said, if it goes down to 245, and if it does that and stays within this time horizon, so you're going to get two rolls in this. You'll get the roll from the March 20 to 27, should you choose, and if it's not too far below, and then you'll get
Not gonna break it yet.
roll if you want to take that, and you can change
Dog.
the parameters of this trade. So if you're long the April 2nd 245 put, you can make it bullish, you can make it bearish, or you can close out the trade. That's what that's where the flexibility and the optionality comes when you do the time spread like a calendar.
Yeah, let's take a look at Joe's 2-week wide put calendar on that 245 strike. We're going to remember that the 200-day simple moving average, which Apple hasn't been below, because that's going to set up my trade also. But this is the bearish example trade here that Joe brought us, buying the April 2nd weekly 245 put. That's 21 days to expiration. Sell that same 245 put in the near term March 20th monthly options that expire in 7 days. 215 debit. That's going to be a risk, $215 per spread. Now, we always talk about, well, hey, you want it to go at or near the 245 line, which might be an area of support, but you've got a range on this for this stock to trade in to be potentially profitable, maybe 240, 238 on the downside, maybe 250, 252 on the upside where you can be potentially profitable. So while it's pinpointing that 245 strike to the downside, you still have a range, and as Joe mentioned, you get that opportunity to roll that short option over the next 7 days. That creates credits, that increases potential profitability and reduces risk on this type of trade. But you definitely need a move, just a slight move to the downside, because we're sitting about 252 on the shares now, and low cost entry point to get some exposure to the downside here with this calendar trade. That peaks out at or near that 245 strike. So I looked at that same 245 strike, Joe, for my trade. It's neutral to bullish on mine, a little bit passive, but I just looked at selling a cash secured put here. And I used the March 27th weekly options. So you basically have 14 days to expiration. This is one of those strategies that you can do repetitively. If you pick out a price point and you'd sell cash secured puts like this example, this would take advantage of, hey, if the stock stays above the strike I sell, and in this case, March 27th weekly, I sell the 245 put, collecting about 280. It's trading about 330 now, so you can collect a little bit more on that. But that's your potential profit, the credit you collect. $280 if you collect 280. You got a lot of risk, over $24,000 to the downside, but that's if the stock were to somehow go to zero. So keep that in mind. But it takes your break even on this one below that 200-day simple moving average on here. So you got to take that into consideration also. Your break even 242.20 to the downside, Joe. It's neutral to bullish, Joe. You've got a lot of risk because you're selling a naked put here, but at the same time, you either want to just keep the credit that's elevated just due to high volatility, or you're willing to buy the shares if it falls below 245.
Yeah, and it's interesting that both you and I looked at that same level as a level where we think the stock could be approaching. You're looking at it as a buy opportunity. I'm looking at it as an area where the calendar can expand in value. I think that the key to that trade is the willingness to want to buy those shares at that level. And so, kind of in any cash secured put, unless you want to close it out early, if you're selling a put, especially if it's cash secured like that, I think you got to make sure that that's a company that you want to own. You got to make sure that that's a company that you want to own at that price. I think those are two really important considerations for that type of strategy. But yeah, like I said, interesting that we're both looking at the exact same level, two different trades, but both of them looking at that same level, one for a bounce, one for a move down there.
Yeah, and I think you make a good point though. It's capital intensive, right? Because hey, if it does fall below 245, you might get assigned on those short puts that you sold, or if the market's open, you close it ahead of expiration over the next 14 days if you don't want that assignment risk on here. But you've got to be willing to own the shares on a strategy like this, and it's a $252 stock, so capital intensive. So Diane, I guess with the bull bear debate here, is the ideal for both of these trades is the stock to go down to about 245.50 or so, where they both be profitable over the next couple weeks.
Noticed that similarity, and I also noticed that my face was like, ooh, on the capital intensive one. All right, guys, good stuff. We have cash tags coming up. The team from Lightfolio will be along with new data on Dollar Tree. It has earnings due Monday morning. Stay right here on Schwab Network. Fast Market will be back after this break.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardas, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7
Should be very complex. If it's not complex, we might have broke it here.
And in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio. Time now for our cash tag segment. For that, let's bring in our next guest, and that is Andy Swan, co-founder of Lightfolio, taking a look at Dollar Tree across the competitive landscape today. Andy, good to see you. Happy Friday to you. Beware, it is Friday the 13th. All right, let's get into it. So you have new data looking across Dollar Tree compared to Dollar General, et cetera. Take us through what your latest data looks like now.
Yeah, it looks pretty good. I think the big takeaway here is that Dollar Tree is just a different company than it was a year ago. They got rid of Family Dollar, and they've gone to a multi-price strategy that gives them a lot of flexibility with regard to, reacting to tariffs, etc. So this is a company that's really starting to execute well, and I think what we're seeing from customers and from consumers is that they like the changes overall. And so, when I think about Dollar Tree, this is a company that's, beat expectations, I think 3 quarters in a row. They're looking at a 20% jump in earnings year over year. And customers are reacting fairly well to the changes that they've made, which tells us that they have the pricing power to now maintain profitability or expand it going forward and expand those margins a little bit regardless of what tariffs do. So they've made themselves a more dynamic company, and they've also focused in on the Dollar Tree brand, which I think is just exactly what Wall Street was waiting for. So a vastly different company than it was a year ago. I don't think that we're looking at a situation where, comps year over year, what Wall Street's going to be focused on. I think it's going to be focused on, the outlook of the company and how that flexible pricing power is impacting both consumer behavior, which we see as pretty strong, as well as, profitability and margins, which only management can speak to at this point. So we're really looking forward to this call on Monday.
Andy, when you look at this, Dollar General reported already, and the stock slid on pretty good numbers. They beat on EPS, they beat on revenue, and traffic was up. Same-store sales up 4.3%. Dollar Tree the bar seems a little bit lower. Dollar General had rallied a little bit, but when you look at the competitive landscape here, they're equivalent. They're in the same industry. Do you guys have data that kind of reflects that, hey, maybe one's doing better than the other, or maybe they're just in the same boat?
Yeah, I think they're really in the same boat. Dollar General in our data is performing a little stronger, but I do think that they're both in a pretty good position in terms of that K-shaped economy and offering value to people who are seeking value, which is a growing segment of the population. So, excuse me, I think tariff pressures.
You don't sound too good, buddy.
They've reacted in a very convincing way, getting rid of dead weight and getting away from pricing policies that were killing them. And so I put both of the companies in kind of the same boat, but I like Dollar Tree a little better because I think the turnaround story is more convincing. The upside of getting rid of that dead weight is more convincing. Excuse me. So, that's what we're looking at here. I think they could put up a similar type of number as what Dollar General put up in terms of expectations, and the stock would probably react more favorably than it did for Dollar General because, like you said, Tom, the expectations, the bar is a little lower for Dollar Tree here.
Tom took the thought that I was thinking of in terms of going into this, because even Dollar Tree had a little bit of weakness this week because of, it seemed like it was dinged in sympathy to the pressure that we saw on Dollar General. Dollar General is still a little bit of an outperformer compared to Dollar Tree, so you think there's more opportunity for upside from here, Andy?
Do, and I also think that the company can probably speak to, we're seeing a little bit in our data, that the company can probably speak to, some people coming into the store that might not have a year ago or 2 years ago, and that's a little bit wealthier consumer. There's a little bit of a trade down effect. People are seeking value in certain parts of their lives. Even people with, middle income or even upper middle income are seeking value in some parts of their lives so that they can maintain the lifestyle that they have in others, in entertainment, etc. So we're seeing a lot of that kind of overall trend data that I think the company will be able to speak to positively, is that they're able to price now pretty dynamically, and they're also, attracting a customer that when they walk into the store, they see everything as a value and as a deal. So a little bit less price sensitive customers starting to walk in the door right as the company is able to flex their pricing power muscles a little bit stronger than they were a year ago. That's a really good combination, I think, for management to highlight in this call. We'll see if they do it.
Yeah, Andy, I was looking at your other chart, the stock price, which is above maybe the trend line. We've seen some deceleration since the start of the year after the holiday shopping season. But when you look at this and the inflationary pressures that are going on out there, we got a bunch of inflation data this week. Crude oil is back above, $95 a barrel. I mean, does this bode well for these retailers, because the consumer has been resilient, Or does this signal that, hey, that they're going to tighten up spending even in discount stores where they might trade down to?
Yeah, so I think it's really clear, and we've talked about this a lot on this program, is that where you don't want to be as a retailer is right in the middle. You either want to be selling luxury goods to high-income people, or you want to be selling value to everybody else. And so I think that, Dollar Tree is able to sell value to everybody else, and that everybody else category is really starting to grow, and people seeking value is starting to grow. And so I think they're in a good spot here because they're not in that middle kind of no man's land. And so, as we look forward, we think the Dollar Trees of the world, the Five Belows, the Dollar Generals, we think that these companies can really thrive in this environment. The discounters like TJX, et cetera, we think that they can thrive in this environment because they can attract customers they weren't getting before that are less price sensitive. They're seeking value, but they're less price sensitive when they walk into the door. And so the company can probably maintain their margins going forward in a really nice way and expand the customer base that they have. So we think of it as a winning setup for Dollar Tree. We'll have to see how management thinks of it, but I have a feeling they're going to be able to put on a pretty optimistic face looking forward to the rest of 2026.
Okay, it sounds like this reminds me of the conversation that we're having a few years ago of the shift in buying patterns where people were moving from Target to Walmart. That's what I wonder if that's happening here. All right, Andy, we'll leave our conversation there for now. That is Andy Swan, co-founder of Likefolio, with the latest look at Dollar Tree. Okay, the trading perspective, all things Dollar Tree. Tom, you got some good insights from the Likefolio team. I do wonder if that is the pattern that's happening right now. Once upon a time, I think about the patterns with like Walmart and, the shopper that has shifted over there and, it was kind of a hold your nose as you go in there. And I wonder if that's happening now with Dollar Tree and Dollar General. But take us through your thoughts before your example trade, your final thoughts.
Yeah, I thought it was interesting what, Andy kind of laid out there. They got rid of, the drag down on Family Dollar. So that was probably what was holding them back. The stock has pulled back to its 200-day moving average. But at the same time, you look at the response that the stock had to Dollar Generals, which were really good earnings results, and the data that they have on Dollar Tree is a little bit lower, but we're coming probably from an area where is the 200-day simple moving average acting as support. So you got to take that into consideration here. So I looked at a strategy where, hey, if it goes down, if it goes up, I don't care. I just want it to go about one standard deviation. So the option market for next week going into this report on a one-day move, whenever they report Monday morning, is going to be about $8 either way.
If he was swinging.
$8, $9 either way, either direction. So I looked at a double calendar position where it gives me exposure to the upside and the downside about that one standard deviation move either way. So went out to the March 27th weekly cycle, so 14 days to expiration. I'm buying the out of the money 120 call, and I'm buying the out of the money 103 strike put. And then in the near term, March 20th weekly options or monthly options that expire in 7 days, where you're going to capture that earnings event, we'll sell those same strikes, sell the 120 call and sell the 103 strike puts. 1 week wide, double calendar position, paying roughly. Markets are wide on an individual basis, individual option basis, so some price discovery probably warranted here. I've got a debit of $1.30 here, so that would be your risk on this if you paid $1.30, $130 to get that upside and downside exposure here. Now you can see here for the risk profile, you want it to go up to 120 if it's a good report and stock goes higher, or you want it to go down towards 103 to the downside if it's a bad report, or if it sells off, even if it's a good report like Dollar General did. So it gives you that exposure to upside and downside. Now, what you don't want to happen, right? You don't want a 2 or 3 standard deviation. You don't want a $20 pop to the upside or a $20 sell-off to the downside. And in essence, you don't really want the stock to kind of consolidate around 110, 111 here, because that will also impact volatility levels. Now, why is it only $1.30 or $130 in risk to get upside and downside exposure? Well, it's about those volatility levels. that we talk about. So in aggregate, on the March 27th weekly options, where I'm buying the 120 call and the 103 put, you're buying about a 74% implied volatility on aggregate in that option series. In the near-term options, the March 20th monthly options, where you're selling those strikes, you're selling about a 91% implied volatility. So that vol dispersion lowers the entry point price. But this is a double calendar position, Diane. The upside sets up with maybe what Folio's data has, but this also gives you some downside exposure in case the stock does move to the downside.
All right, that makes sense. Good stuff. We've got the breakdown coming up. We're taking a look at NVIDIA ahead of its GTC conference that kicks off next week. We'll have more Fast Market after this break.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall, live on the floor of the big board. Before we get to the breakdown, let me give you a check of where markets stand as we get closer to the bottom of the lunch hour. We are looking at pressure increasing on equities right now. The S&P 500 off by more than 1/3%. Again, as we're watching crude oil prices tick higher. The Dow right now off by a little bit more than 1/10%. NASDAQ 100 down 0.5%. Similar price action in small caps. You're looking at the Russell 2000 off by just shy of 0.5%. Once again, this is crude oil rises, ticking up 1.1% right now for West Texas Intermediate, almost at $97 a barrel, as the Iran war heads into or towards its third week. Meanwhile, NVIDIA is in focus today ahead of its major developer conference coming up next week. Among the headlines surrounding it, according to the Wall Street Journal, ByteDance is planning to use NVIDIA's Blackwell chips to power a large AI computing project in Malaysia, where there's been a big build-out of data centers, not just NVIDIA, other hyperscalers. And keep in mind, NVIDIA's GTC conference kicks off Monday. CEO Jensen Huang set to deliver the keynote that afternoon. Investors will be closely watching for any updates on this next wave of AI chips. All right, time now for the breakdown. For that, let's welcome in George Silla, senior markets correspondent, taking a look at NVIDIA. All right, so let's talk about it. NVIDIA is in focus today. We've got Monday kicking off the GTC conference. Jensen Huang put out this prolific post this week about AI and how he sees it in this 5-layer stack. Take us through how you're breaking NVIDIA down or looking at that one.
Well, that's a good question, Diane. I mean, first off, if you look at NVIDIA's price action in the last 6 months, it's barely budged, around 2% higher. And, every time I look at the financials of this business, it's pretty remarkable. But, even going back to the last earnings report on the 25th of February, you just look at these numbers, they're just phenomenal. I mean, they posted 82% increase in EPS, 73% increase in year-over-year sales, but also quarter-over-quarter, sequentially, they posted 25% increase in sales. And that's remarkable. And the profit margin of this business at 55% is clearly the most profitable of the big mega cap names out there, but it's remarkable that it's really a hardware company for the most part than a software company with those profit margins. So that gives you an idea they have tremendous pricing power and demand. There's no doubt. And if you look at the news today as well, it looks like ByteDance, which essentially is the parent company of TikTok, is going to be using about 500 NVIDIA Blackwell GPU clusters. So the clusters together amount to about 36,000 GPU chips, and they're off the Chinese shores. So there isn't potentially a restriction on some of the exports that of course, NVIDIA is facing exporting to China, because as you mentioned, these are in Malaysia. But nonetheless, there may be some positive catalyst with NVIDIA next week outside of what they are already expecting in terms of deploying new technologies. Rubin platform is the next stage for NVIDIA, which essentially brings together GPU, CPU, and XPU clusters together along with Omniverse software. And that's the next phase of NVIDIA, because they are moving into the ecosystem of inference technologies versus large learning model technologies. In other words, training models, that was the initial catalyst for NVIDIA. And now they're moving pretty aggressively to have a comprehensive technology with the Rubin platform for inference. And again, this transition, I think, is one of the reasons why we've seen some softness in gross margins, because anytime a company adjusts their technology platform or introduces a new product, that can compress gross margins. But one of the things about this stock is, and I'll say this all the time, it's cheap if you just look at it from earnings. 21 times this year's earnings, 17 times next year's earnings. We're talking about PE ratios for stocks that maybe have an earnings yield of less than 7%, and this company is just growing tremendously still. But you got to go with the market. The market is telling us there's a wait and see sort of situation with NVIDIA. And I think that's essentially what we have to take from the last 6 months of price action in this name.
This reminds me of something our colleague Kevin Green said about NVIDIA, is it feels like it's like the star student where you just expect it to perform, right? And so the expectation going into its results is, okay, of course it's going to deliver. And it feels like a little unfair when you think of that. And I just looked at AMD compared to NVIDIA over that 6-month stretch, and AMD has had outperformance compared to NVIDIA. And, so I've noticed that trend and had conversations about that trend where it just seems like stuck in this narrow range outside of that brief breakout that it had in February. Do you think that GTC could potentially be a catalyst or not really, George?
Well, I mean, it could be, Diane. I just think that, absent this event coming up in the next week, Monday and through Wednesday, because I think it's through the 19th, there could be a technology catalyst, which, in a nutshell, would raise price of the stock based on expectations. But, I think if you align that variable alongside potentially now with some sort of a temporary ceasefire in the Middle East, and then also, I talked about this earlier, that there seems to be an underlying bid and accumulation in the mega cap names. So that tells me that there's a penchant for institutional investors to pile in on any good news, either geopolitically, but also, again, idiosyncratically to NVIDIA's technology conference next week. Things seem to be lining up, but the challenge really lies is that we're going, minute by minute on a headline basis. And that's really creating an apprehension for investors to really, stick with bigger names like NVIDIA and, of course, Microsoft and so forth. So my suggestion is that you have to consider the risk of the downside in the overall market, and that's going to maybe stall NVIDIA out. But there's also, I think, a lot of pent-up demand to see this market go higher, but there hasn't really been a clear catalyst.
And that's the thing right now, because there's so much headline risk in play as well. And it feels like you're kind of a little bit in wait-and-see mode, and the equity market being dictated by the gyrations in crude oil. All right, George, we'll leave it there for now. That's George Sillis, Senior Markets Correspondent. Thank you, George. Let's get Tom back in here for example trade purposes. So Tom, you've got an example trade in NVIDIA. Your thoughts before you jump into the example?
Yeah, it's all going to be about GTC. We'll get some clarity on how they are struggling with, orders, production from TSMC and some others that make their chips, and then also what they're doing as far as the Rubin chip and the new orders for that. Because we've all seen the CapEx numbers, right? They're pretty impressive. Now, remember last earnings report, we're off about $16 from those levels where it traded prior to earnings. So the sell-off, even though the company beat, it's almost like, what do they need to do for Wall Street to react positively to this stock? Because they're blowing the doors off of growth numbers, right? And they expect that to continue. Now, a lot of investors think that, hey, this growth is eventually going to have to slow if those CapEx numbers come down. So that's going to be the outlying concern there for investors. But Jensen Huang, he gives his keynote address at GTC on Monday. We'll get some more clarity on how they're working through any production issues, orders for the new chip, how Blackwell's doing. So yeah, we'll get some more clarity. But George made a good point as far as valuations go. This thing is valued the cheapest it's been in over 3 years on a trailing and forward basis at this point. So I looked at a strategy that takes advantage of the IV percentile rank in NVIDIA, even though it's pulled back 14% from those all-time highs that we saw at the end of October, early November. IV percentile rank only about 27%. So I look at a strategy that takes advantage of lower implied volatility when you initiate it. So I went out to the March 20th monthly cycle that expires in 7 days. So you're going to capture the news around the GTC event. And I'm looking at buying a bullish call vertical for an example trade here. Buying the 182.5 strike call, that's just out of the money to the upside, and then against it, because the option market for the next week is pricing in about a plus or minus $11 move. We're going to sell the 192.5 strike call, so a bullish $10 wide call vertical. You're paying roughly about a $340 debit. The debit you pay is going to be your risk, $340 per spread, where you can that can expand to $10 if we get back above the 192.5 level. On this one. Break even on it, 185.90 to the upside. That's only 2.5% above the current share price of just under 182 on the stock. So on a percentage basis, you don't need a big move to the upside. Now, it's a 7-day trade, but maybe we'll get a move on Monday or Tuesday after Jensen Huang speaks and the stock pops back to 190, 195, something like along those lines. This gives you that flexibility that, hey, if the market's open, this thing starts to expand in price. It gives me that opportunity or potential to close a trade ahead of expiration. So keep that in mind on this directionally biased bullish trade here in NVIDIA. If you think it's going to go higher over the next 7 days.
All right, good stuff. That's the example trade there for NVIDIA. GTC conference kicks off on Monday. We will hear from CEO Jensen Huang later in the day. That's going to do it for us today on Fast Market. I'm Diane King Hall alongside Tom White. Our thanks again to Joe Mazzola for joining us all week. Download the Schwab Network app. It's available in the App Store and tune in 24/7 on schwabnetwork.com. Stick around. We've got Next Gen Investing coming up.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network. where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait,
vulnerable.
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have.
More selling?
Difference.
Google.
Someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at SchwabNetwork.com.
Market needs to hold. There's no conviction.
Welcome to Next Gen Investing and happy Friday. I'm Jenny Horn, and we're seeing markets pretty broadly lower on the final session of trading this week as a lack of progress on the situation in the Middle East continues to drive up oil prices. And so starting off the show here with the S&P is down 0.4%, the Dow, which is teetering at the unchanged line but still lower. NASDAQ 100 is down about 0.6%, and the Russell 2000, which actually has improved a bit on the session, is still down about 0.5%. So we know as traffic in the Strait of Hormuz remains halted, and commentary from the leader yesterday alluded to it staying shut, oil and energy-based products continue to rise. So now all four of our major indices are pacing for a losing week, with the NASDAQ 100 seeing at least the smallest weekly losses, down now about 1%, while the S&P 500 is headed for a 1.4% loss this week, which would be its first 3-week losing streak in nearly a year. But throughout the next hour, we will focus on some of the equity news for this Friday the 13th, of course, our second Friday the 13th of this year. We'll kick off things with several earnings movers to keep on your radar. Then we'll discuss Meta shares lower after reports that are suggesting it has postponed the release of its AI model named Avocado. And now with March Madness kicking off next week, we'll talk through the rise of prediction markets and how sports betting is evolving in reaction in real time. And we'll close out the show with El Pollo Loco, a clear bright spot in today's sea of red with shares of over 17% following upbeat fourth quarter results. But here now to help us make sense of all of the movement in this market today, I'd now like to welcome in Diane King Hall, host for Schwab Network. And so Diane, as we start off the show today, I wanted to hear your thoughts on the overall market because there's so much to dive into. I mean, rising oil prices, continuing to really raise these stagflationary concerns, and of course, slowed economic growth expectations, all of it. Walk us through your thoughts.
Yeah, well, listen, as goes oil, so goes the market, and we can see that.
As goes oil, so goes the market.
You initially saw a little bit of nibbling earlier in the session, and then somewhat range-bound as oil was a little bit lower. Once it ticked higher, you started seeing more pressure, more broadly speaking, across the markets as investors kind of hold back on, say, dipping their toes back in the water, especially given where crude oil is up 1% right now, above $96 a barrel. Yes, we're not at the highs that we saw earlier at the beginning of this week, but we certainly haven't come down much. We're still on track for another week of increases in crude oil prices, whether we're talking about West Texas Intermediate or Brent crude. Obviously, West Texas matters more here in the U.S., but again, we've seen pressure on equity markets amid the sharp focus on the geopolitical tensions and the war with Iran, right? We don't have an end in sight yet, although there are investors and strategists that I've talked to that still see as their base case that it's short-lived, and that's why they say we haven't seen more selling pressure, because yes, the S&P 500 is on track for a loss, as you mentioned, but we're not in a correction yet at this point, and there was some expectation of that, seeing that at some point this year, and so far that doesn't seem to be the case. Yes, there has been selling pressure, but it's not violent selling pressure that we're seeing within the markets. What I am seeing ratchet down is takes on where we expect the global economy to be. We got that data in today. We got a slew of economic data in today. Among those, that revision on GDP showing that the economy grew just 0.7% in the fourth quarter. That was sharply lower than the first estimate, and it was also sharply down from forecast. It dovetails with the view that we got from Goldman this week. Hit my inbox actually today, but I know they put out some thoughts on this earlier this week, expecting that we'll see GDP growth lower as a result of these higher oil prices that we've been seeing. They've lowered their 2026 growth forecast by 3 percentage points here. They're expecting growth of about 2.2%. So they are still expecting growth, and some of the economists and strategists that I talked to are still expecting growth for the year, but they are ratcheting down their expectations of how much growth we'll see. None that I've talked to are expecting a recession, but again, there is going to be an impact. And that's the other thing with regard to the data that we got today. This is backwards looking. Obviously, the market is very forward looking, and we know coming up, we'll start to see some of that data be affected by these higher oil prices, especially when you think about inflation, Jenny.
Yeah, and I think a good call out to GDP as well, which is only, I think, adding to concerns over the growth expectations and, of course, the Fed's next move. Really not even next move, just the overall path this year remains fairly unclear given the uncertainty regarding the timelines of some of these resolutions, hopefully resolutions that we see. But let's start off here with Adobe, which Adobe is lower by about 6%. I will say it's improved modestly on the session, but really, unfortunately for Adobe, it does seem like the looming threat of AI, well, they try to frame it as a positive. And I mean, they mentioned these advancements with Firefly. Doesn't seem to be enough when you have your annual recurring revenue continuing to signal some slowing growth.
No, and the challenge is they're going now through a leadership transition. We've got this shakeup in the C-suite without a new leader anointed today. The CEO, Shantanu Narayan, saying he will step down after the company appoints a successor, but we don't have an idea of who that new successor is. It ends about almost 2 decades at the helm of Adobe.
No, this is definitely
He'll stay
oversold.
on as chair of the board, which is similar to the transition to Adobe's founders made when he became CEO. He called that out in some comments. There were some flattering comments made about him from both Microsoft CEO Satya Nadella. You had Figma CEO also making some, positive comments about him. But the issue is it's not helping the stock. Tom White made this point earlier that Adobe seems to be stuck in the penalty box, especially when you look at how they performed on the quarter. They actually beat expectation. It's not just about the quarter gone. Their guidance actually looked good too. To take people through the numbers, adjusted EPS coming in at 606. The street was just looking for 588. So they beat on the bottom line. They beat on the top line, 6.4 billion in revenue. The street was looking for a touch about $6.25 billion. So you saw growth there. Revenue growth was up 12%. And you think about, subscription revenue, that also topped estimates, coming in at 4.39 billion. And AI was actually a growth engine for them in this quarter, because that's been one of the concerns that's been hitting Adobe and others amid the SaaSpocalypse, SaaSlicker, whichever term you want to use, is AI friend or foe. And the view has been it's foe to the companies like Adobe, right? But they've said that, listen, the AI business is the next billion-dollar opportunity. It's helping them. They talked about integrating it across their projects, whether we're talking about Firefly, Acrobat, Photoshop, or Express.
I'm gonna go get my lunch,
They've also rolled out some
I'll be back.
integrations with ChatGPT as well. So it's interesting. They're trying to, kind of work with what could be a threat to them. But again, the stock has just still been stuck in the penalty box, as we can see by the performance right now, Jenny.
I mean, absolutely, and I will say this was one of those initial movers. This was a huge boom for them years ago when they first introduced some of these AI features, and now we're seeing it sort of eat away at that coveted market share in the broader creative and software space. And I like Sassacre, I think, better than even SaaSpocalypse, so I'm glad you brought that to my attention. Now, our next name today is definitely also not a winner by any means on the session here. It's Ulta Beauty.
Did you take Marley's job?
I mean, yeah, and now we're down over 12%.
We're down to my bottom
Really
support.
any
Wow,
today.
I wouldn't even hadn't even been
Overmarket
watching.
Not aiding things here, as it does seem like slowed growth, but also the fact that we saw a really disappointing outlook as they're trying to really refine some more sustainable growth. And so we talked about this name earlier. I think it's really interesting because a lot of times these beauty or cosmetics retailers can actually do quite well in times of economic uncertainty, because as we know too well, you still have to buy makeup products or beauty products, skincare, what have you, if you're accustomed to buying so. And so maybe you can trade down, but it's one of those things where I spend too much money on it. And so I definitely have seen resilient spending in my own, of course, spending habits, but that is not aiding the case for Ulta today.
Yeah, I will say I was surprised by its results. I didn't expect this performance because, listen, whether it's anecdotally, your own experience, or hearing from strategists who cover this, consumers still like their little luxuries. And we talk about the lipstick indicator, and consumers will still, you would think, pay up for that. But this most recent quarter shows there are still some headwinds potentially out there with a mixed report card for Ulta Beauty, and this stock is really being penalized today. Now look, it's still got very strong performance on a year-over-year basis, and maybe this creates a reset and an opportunity for some who've been waiting to get in on this one. But the outlook is a little bit cloudy when you think about Ulta Beauty, so those shares down more than 12% at the moment in terms of how it performed in the most recent quarter. EPS came in at 801. That was lighter than expected. Revenue did top expectations at $3.9 billion. So it did see some sales growth, but not as much as expected. Comp sales were up 5.8%. In terms of their guidance, they're guiding for 2026 a range of 2805 to 2855. The street was looking for 2838 there. Revenue, they're guiding for a range of between 13.13 to 13.26 billion. The street was looking for around a little touch above 13 billion there. So it's just a little bit of a softer outlook for 2026 that's really denting the shares right now. Gross margins declined slightly. They, tied that to some fixed expenses. That was partly offset. They said by lower inventory shrink and some efficiencies within supply chains there. So overall, there are some costs that they're dealing with that are just increasing faster than sales in some areas. So you got a little bit of pressure on margin there. The consumer trends, though, beauty is still healthy, but shoppers are selective. The CEO, Keisha Steelman, talking about this, she said consumers remain engaged, but are more price conscious and selective. So look, we do know that Ulta has both the premium and the mass market size. Some of the themes that were talked about by the CEO was there is a strong focus on value and affordability. Shoppers are becoming more discerning with purchases. That makes me think of the term that we use often when we're talking about the retail space, the choosy consumer, the choiceful consumer. Similar language that we hear when we talk about retailers. She also talked about the competitive nature of the beauty industry, highly competitive, and expecting those trends to persist this year. The macro factor matters here as well. Ulta flagging those global geopolitical tensions as a potential risk to consumer sentiment, and it's a risk factor in the way that we think about crude oil prices. Big part of gas prices is affected by crude oil as well, so that's a have to. I suppose even the little luxuries are, not a need, they're a want for some people. For us, yes, we need it for work, but not everybody doesn't need it for work, Jenny.
That is true, and those are lucky people, because it is not a cheap industry to continue to buy into, of course. And now, our next name today is actually, I think, a surprise winner on the session. That's Lennar, because you think that we would see, with the overall expectations for, again, stagflation and the concerns over growth, and then you have this commentary that, frankly, is not a positive one, that we're seeing these same persistent headwinds that have challenged the housing market over 3 years. That is directly quoting their own management, and yet we're still somehow higher today by almost 3%.
I think I'm gonna go get something to eat.
See again some exposed strain remaining in the housing market by these numbers, Diane.
Yeah, listen, Jenny, this one was a shocker to me because I'm like, they missed I don't get this one. head scratcher to me. They missed expectations on the top line, the bottom line, their outlook is soft. It was kind of depressing when, you know, you listen to the CEO and talk, yes, I know there are headwinds in the space, but, you know, so when you think about that, and maybe the bar was so low, investors are looking for a bottom here and trying to find
Still
that
waiting.
bottom, and that's why they're getting in. Adjusted EPS to take
We
people
gotta
through
break
the
this
numbers, if
Darvis
you're not
box,
caught up, 88 cents per share.
which is
The street was looking for
66488.
96 cents. Revenue is 6.6.
66488 is what we got to break in the 100 EMA. And I'll be back.
Years now, right? High mortgage rates, affordability constraints, cautious consumer sentiment, and the CEO also pointing out geopolitical uncertainty, the conflict with Iran, as another factor that buyers have to contend with now. You know, you've seen some pricing pressure that showed up in the home sales because the average selling price, great for homeowners, it did decline to $374,000 versus $408,000. Lennar has been cutting prices. They've been offering incentives to try to stoke demand. And keep in mind, Lennar doesn't cater to the luxury home buyer. They're really looking for, especially those who are new to the housing market. And that's been a challenge, right? You know, when you think about affordability constraints and over 6%, that has been something that has kept home buyers on the sidelines, waiting for a better entry point, or those who are even looking to, you know, kind of move up from the starter home. Why would you move up from the starter home if you got a 3% rate and you're still dealing with 6%, Jenny?
Yeah, and that's a great point. I think maybe that we're seeing some lift because we did see this 3-year low yesterday, so maybe it was just that we were so beaten down going into this report. And I mean, yeah, it's hard to really understand this one. This is the nature of earnings season, of course, where you're just like, hey, this was objectively not a strong report, but somehow we're etching out a gain today. And so not eating, at least we're still, I mean, we're down 9% this year, and we're still actually lower by about 5.7% this week, but at least closing out the week on maybe a brighter spot here. Now, our next name today, Sentinel-1, which actually was initially lower after its fourth quarter earnings and a softer first quarter outlook, but now amazingly it has turned around, and this is another head scratcher to me, up 2.4%.
Yeah, listen, I was surprised by this turnaround. Great catch there on that because I hadn't seen that one. It was a mixed quarter, though, so maybe investors are focusing a little bit more on the positive. They beat on profit. They had well, on some metrics, slight revenue miss. Some would call this in line with expectation. Profit coming in at 7 cents per share. This was beat by a penny. Street was looking for 6 cents. Revenue $271.15 million. Street was looking for $271.16 million. So when you think about revenue, even that's essentially in line with forecast, but it is up actually double digits on a year-over-year, 20% growth year-over-year. So, you know, that signals obviously that the demand for cybersecurity is still there. It's still strong there. Growth metrics overall still healthy, and maybe that's why things have ticked positive because you have annual recurring revenue ARR up 22%. It crosses over that key billion-dollar milestone that investors want to see. And then, of course, there's the number of large customers who are spending a significant amount, spending more than $100,000 annually. That grew double digits as well by 18%. So that's strength, and it shows that there is enterprise adoption there for the Sentinel-1. So it's a milestone. They have some strength on their balance sheet as well. They ended the year with $769.6 million in cash and equivalents and investments, Jenny. So it gives them flexibility when you're thinking of acquisitions, R&D, et cetera. So, you know, they have a war chest as well, just as a phrase I'm using. It's important in cybersecurity when you think about the competitive landscape where you have to be constantly developing and nimble to keep up with the competition. There was some weak near-term guidance for Q1. Sentinel-1 is expecting EPS of between a penny to 2 cents per share. That's below the consensus view. The street's looking for 5 cents there. So we'll continue to watch this stock and see how investors react to it throughout today's session. Guidance for revenue, they're guiding for 276 to 278 million, roughly in line with expectation. So the suggestion there is growth. There is still growth, but it may be moderating in the near term. The full year outlook is more encouraging than that, forecasting full year EPS of between 32 to 38 cents. Above consensus. Consensus, we're looking for 30 cents. The revenue, they're guiding for 1.9 on a full year basis to 1.2 billion. In line with expectations there. So maybe investors focusing more on the positive now, Jenny.
Yeah, and gosh, I think we need it today. It does feel like that is not the case for the overall market, but at least Sentinel One here turning around pretty nicely intraday. We'll obviously be watching for where they close, but still up over 2%. So we appreciate it, Diane King Hall, for helping us kick off our show today. But coming up next, it's time for Chartmaster, and we are looking at two of our biggest names in the chip space. NVIDIA, of course, and AMD, both are lower today, but amazingly so. Actually still pacing to close out the week higher, with NVIDIA still up about 2% now week to date. So we'll dive into the technicals and some example trades coming up next.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab, they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Next Gen Investing. It's now time for the Chartmaster, and today we are diving into NVIDIA and AMD with Rick Ducat, of course, our Chartmaster himself. And I do think that both of these names, important to note that while we're lower on the session in both of these stocks, we are actually higher in NVIDIA still on the week. And so you tend to forget about that when you talk about like the S&P facing for its third losing week. But NVIDIA has still been resilient. And so walk us through this recent really range we've been stuck in, which is actually encouraging, again, given the overall volatility in the market.
Yeah, and low volatility situations can feel boring while they're happening, but that's often the precursor to high volatility. What I mean by that is we have increasingly entrenched boundaries for our share prices here. You can see kind of 165 to 170 is our two green lines here that represent some notable lows. You can see price bottomed out at the upper edge of that area multiple times here, but then we also have a corresponding ceiling around 195 specifically. So that is our general general sideways range here. We did have this upside excursion all the way up to almost 212, 213, but from there you could draw a downward sloping trend line, and you could draw an accompanying upward sloping trend line going across the lows to give us this more triangular shape here. So depending on how you might look at it, you could have boundaries that are a little bit closer to the current price activity, perhaps more like 175 to 185 representing potential breakout points here. But you know, trend lines are subjective. This is something that you know, use at your discretion when you're doing your trade planning here. So when we see our moving averages, we have our 5, 21, and 63-day exponential moving averages all clustered together right on top of each other around 183, 184 or so. Price has slipped below those, that confluence today so far here. This remains a point to the upside now to watch for potential resistance. Meanwhile, our 251-day EMA in orange comes in right around 168, so that's a downside level to watch out for. The longer-term moving averages are more significant than the shorter. So we also see RSI kind of mirroring our symmetrical triangle type shape here. We are below the 50 midline still here though, so more of a bearish lean somewhat here. So look for price and RSI to exhibit matching breakouts in either direction for further confirmation of a potential breakout. Finally, when we look at our volume profile study, we can see that excuse me, our range-bound area here lines up with our heavy trading zone between about 175 to 190. Our point of control stands out right around 181. If we were to go too far above 190, things thin out pretty dramatically there. Meanwhile, 155 to 160 is another more isolated pocket of activity to the downside. Not a whole lot to break our fall until we get to that area.
Okay, and so as we do think through now trading NVIDIA for example purposes, we do have GTC next week. I know that's been a catalyst that we've discussed a lot, I think, because we're hopeful for any tech catalyst right now to improve the overall trend, but this can often be a buy the rumor, sell the news type event. Doesn't mean it will be that way next week, but something to look out for. So how do you think through this name again, for example, trade purposes?
Well, just kind of thinking that, you know, we're in this low volatility area. This would be more of a directional play, hoping that this kind of a pillar of the market would start to reassert its uptrend here. So we'd be looking at the May 15th expiration in this case, which is our green box here, 63 days out, plus or minus 16% approximately. So now if we were to overlay our other studies here, we can see some areas that kind of stand out to the upside. Would be around 195 and around 212, 211 or so for the our upper part of our range here. So that being said, thinking about some of those general areas, we could structure an example trade +1 May 15th, 190, 210, 215 call butterfly at a $5 debit here. So a bullish trade, 63 days out, $500 debit paid would be our max loss in this risk-defined trade here. So max profit, if we were to expire at that 210 short strike, at which we have two options, but that would be $1,500 here. So roughly 1 to 3 in terms of our risk to total reward potentially here. But you know, this type of trade, an unbalanced butterfly, shows that we have this flat area to the upside here. So if we were to overshoot and expire above our 215 long strike there, we would top out at a profit of $1,000. So we would sidestep that risk of a conventional butterfly, in which we could have a winner turn into a loser here. Break even 195, 7.1% to the upside versus our expected move about 16%. Meanwhile, our long strike at the 215 level about 18% to the upside. So right around that edge of the expected move.
Okay, yeah, so now to shift into AMD, of course, trying to be really the second dominant force in the chip making to NVIDIA, but still not really eating away at that GPU market share that NVIDIA has commanded for quite some time. But as far as the recent technical trends, I mean, we are still holding on to a modest gain this week, but this name a bit stronger on a 52-week basis. But again, different stories that are shaping right now AMD versus NVIDIA.
Yeah, so this one is not quite as clear. NVIDIA had a very clear kind of sideways trajectory. AMD, despite remaining above an important breakout area here, we kind of had these old highs around 187 or so. We never did fill the gap all the way down here near 170. But we did kind of come close to testing those old highs that I just identified here. So we've seen some big swings, a pretty volatile trading range here. But after our last earnings event now, it seems like the prevailing trajectory is this downward sloping channel type shape here that encompasses much of the price action we've seen after earnings. So now we are moving lower once again today, potentially on the road to that 187 level once more. So when we do look at our moving averages, in this case, we have some evidence that the downtrend is continuing to accelerate here. It's because our shorter term moving averages are diverging farther apart from each other. Meanwhile, our orange 251-day EMA remains to the downside as a potential supportive area near about 186, 187. RSI trending upward, but still below that 50 midline here. So our green trend line is still in play. A little bit of a divergence here. We're seeing RSI improving as price kind of seems to be more listless. So look for, again, confirmatory tandem breakouts on this indicator along with price. Now our volume profile study shows that we have slipped below the heavy trading range that's closest to current price activity between about 200 to 220. If we were to move lower, things are showing more increased activity down here between about 155 to 180. So kind of a wider range. Our point of control stands out right around 160. So those would be some noteworthy areas in the coming days.
Okay, and of course we are still down about 2% today, but again, still hanging on to at least a modest gain this week. So as you think through now trading AMD here, which could also see some movement even tied to GTC, walk us through your thinking.
Right, so in this case, looking at May 15th once more, our green box here, plus or minus about a 21% potential expected move here, a range of almost or about $41 or so. So now when we do overlay things, we can see that this range, our green box, lines up pretty well with our volume nodes, and to the upside, it lines up with our gap level that we saw here near about 235. So also kind of the outlook doesn't seem to be quite as good for AMD as NVIDIA. So an example trade in this case, if you had more of a neutral outlook, an iron condor might be one idea to think about. -1 May 15th, 230, 240, 160, 150 iron condor at a 380 credit here. So selling a call spread, selling a put spread here at the same time for a neutral outlook. Again, 63 days out in this case here. Our 380 credit received is our max credit in this case. Our max loss, meanwhile, 620 here. So about a 1 to 2 almost, pretty close to that risk reward setup here. Break evens, we have 2 in this case, as is the case with selling iron condors typically here. 156.20 to the downside, 233.80 to the upside, roughly 20% plus or minus either direction here. Remember, our expected move is about 21%. So this would be more of a higher probability trade based on that expected move here. But it is, the max loss would be within the realm of possibility for this particular trade here. So just something to consider if you had more of a neutral outlook for this particular name.
Okay, yeah, and I think that good ways to be risk defined and of course prepare for some of the unexpected, which turbulence can always occur on a day-to-day basis in these markets. So appreciate it to Rick Ducat for all of that technical and example trade setup. But coming up next, it's time for FOMO, and we will discuss the move today in Meta Platforms, which is down about 1.5% in reaction to some developments from its AI platform Avocado, facing some delays as well as just the ongoing competition from these LLMs like Google's Gemini.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. Now, Meta Platforms is lower today following reports that it could be postponing the release of its AI model, Avocado. So joining me now is Sam Vadas, host for Schwab Network, for some more insight into this story. And so, Sam, down 3.5% here.
Yeah.
How significant is this to Meta's overall AI push? As we know, it's been expensive for the company.
It certainly has, and I think the answer to the question is, Jenny, it depends on who you ask, because I did hear a trader on the floor here today who actually holds a position saying, not too worried about this headline. There's lots of negative headlines out there at the moment. The tape is very sensitive, but the way that I would frame this story as an analogy is that you go to the fruit bowl, you pick up the avocado, it's a bit firm, you need to wait until it's a little bit more ripe. That seems to be the story here with this negative news coming from the New York Times, who is reporting this, that they have indeed got this rollout of the new AI model that's been pushed back after performance concerns here. So that's the headline. The timeline here. Looking like it could be at least May from this month, reportedly. It did look like Mark Zuckerberg, who had been really pushing ahead with this, had been targeting for release this month, but now it has been pushed out. And that's, as you say, Jenny, really spending a lot of money on trying to get this cutting-edge technology out there. So it's unlikely that they're going to reportedly hit this deadline here. It now appears that the new model has fallen short of performance of leading AI models, as I heard you before the break, like Google, OpenAI, Anthropic, and internal tests for reasoning, coding, and writing. So perhaps just not up to scratch as they would like yet. Interestingly, the Times does point out that previously it had outperformed Meta's previous AI model. It had performed better than Google's Gemini 2.5 from March, but it has not performed as strongly as Gemini 3 from November. As we know, there's been a lot of praise around Gemini since then, and obviously that has helped Google's stock as well. A lot of praise coming from the likes of very influential people as well. I think it was Mark Benioff who did talk about that too. What's important with this story here, though, Jenny, is how Meta's AI model does perform is what is being very closely watched by the street and the market right now. So obviously we've got Google, OpenAI, and Anthropic, which are all regarded as being ahead for now, and that's important also from the perspective as what we've been talking a lot about over the last year, from a perspective of how to attract talent to your product, because we know that Meta has been growing out this super intelligence team. It's been trying to pluck a lot of top engineers and people from other companies and paying them, attracting them with huge eye-watering salaries. So this news is significant because also we've had Meta's other projects falling short in the past of expectations. You think of, Llama 4 and also the metaverse. So I think that's perhaps what's weighing on the stock today, but I would put it into context. All the Mag 7 is lower today. In fact, it's the NASDAQ that is really suffering the most. So I think there are just general concerns around technology for us in this session, Jenny.
Yeah, and I mean, especially when you look at this week, we're down about 4.75% this week, which it's not like we've seen a huge winning week for tech by any means, but there are still some pockets of strength, just not fortunately being reflected in Meta shares on a week-to-date basis. But we did also get some reports from Bloomberg of this increased data center spending for Meta. And so how significant is that to this conversation?
I think that's really significant because it's all about the spending and the hidden costs. So Bloomberg's really been looking at the quarterly filings here, and what they've found is how big tech, broadly speaking, a number of companies are actually trying to lock in massive data capacity. And so you've got major cloud companies like your Metas, your Microsofts, your Oracles, your Amazons of the world committing huge amounts of their money to future data center leases. So that's what it's really looking at here. You've got Microsoft and Meta adding about $50 billion in new lease commitments last quarter as they've looked at some of their filings. And across the cloud providers, you're looking at future lease commitments now exceeding $700 billion. And what the Bloomberg report is getting at here is that the costs are mostly hidden for now. So these lease obligations don't actually appear on the balance sheet, and that is because they only appear once the payments actually start. So investors might not actually see the future cost until that burden is actually set in stone. So the spending is obviously being driven by the huge amounts of AI, like the previous story we were talking about. And so all these companies have been really scrambling to bring on more computing capacity to train their models, their AI models. And so, yes, you have these eye-watering sums of Microsoft with $155 billion in future data center lease commitments. You've got Meta with $104 billion. And that just really reflects, I mean, the huge amount of money that is being spent here in order to build out this AI. And Microsoft is ramping back up as well because obviously it had paused some of its data center leasing in much of 2025. Oracle actually has the biggest commitments here. I mean, they've been looking into their numbers as well. $261 billion in future data center lease obligations here. A lot of that is tied to OpenAI. We just heard from Oracle and its earnings just in recent days. Obviously, we know that I believe 60% of that or something, the RPO, is attached to OpenAI, so it's quite significant. But the bottom line here is that, you know, these companies, and Meta included, are spending hundreds of billions of dollars in these data centers on off-balance sheets for now. And I think that is something that's going to be really important for the market to look at, as it's not just the AI disruption fears and the valuations here, it's also been about the funding that has been a really big question for these markets this year, Jenny.
Yeah, and I think a good call out to Oracle. I mean, I feel like that was, you know, we've had so much news this week, it's hard to keep track of what was what, what happened, you know, when. And I think that with spending and some of these overall just credit concerns, Oracle to me is like the depiction of that. But Meta also facing, I mean, some severe CapEx spends. They have to see growth to obviously be able to continue to write this narrative. But so appreciate it, Sam Vadas, host for Schwab Network, for all that breakdown today on Meta platforms, which unfortunately closing out the week on a negative note. But now next, could we see what prediction markets actually mean? Safer and more transparent sports books, and are we seeing them on their way to becoming a new layer of really the financial system? So we'll discuss more recent trends in prediction markets coming up next.
Ooh. That's why I don't go out and eat much anymore. I'd rather cook it. Let's see how it tastes. What? Ain't gonna work.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. We have everything we need all in one place.
I can set up her college fund.
I've been learning about your trading strategies.
Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning movers bring
Try to buy the
three
bottom
of the
again.
biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m.
About
Eastern.
$1.
Morning movers only on Schwab Network.
Welcome back to Next Gen Investing. With March Madness kicking off next week, no better time
March
to dive
Madness.
into sports betting and why prediction markets are starting to look more like financial markets and not traditional gaming platforms. So joining me now is Asif Mir, CEO of Solidus Labs. So Asif, thanks so much for joining me, and of course, happy Friday. So for viewers who are more used to traditional sports books, what is a prediction market, and really in simple terms, and how is it different than just traditionally placing a bet?
Hi, Jenny. Great to be here. Thanks for having me again. So there's quite a few differences between traditional gambling markets and prediction markets. If to highlight a few of them, first of all, I think that prediction markets really play to a user's strengths. They have a different way to possibly observe the world and make different analysis in which they can then open a market and then trade. Now, the most important thing to mention is that obviously gambling and sports betting generally is a state-by-state legislation versus prediction markets that are federally regulated under the CFTC.
God.
These are exchanges, peer-to-peer. You can exit or...
Goodbye. My WM back down here. Nothing's really moved. Nothing's really moved. Let's say they got their rice right. The entrance right in the front to the left, where the taxpayers go pay their taxes, on the west side of the building. First floor. Mara's up today. Double top on the 20-day, triple top. On Mara. More drama. Didn't hold support. Interesting. Yeah, it kind of fooled me. More drama.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Nvidia.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big
Say
rumors,
technology again.
real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for Under 30, and we are looking at a winner today, El Pollo Loco, following its fourth quarter numbers with earnings and revenue growth and optimism being reflected in its same-store sales figures. So joining me now is George Tillis, Senior Markets Correspondent for the network. So George, pacing for its best day since April 2020, so we're up now 17%.
Yeah.
Walk us through this move today.
Well, I think, one of the things we can take away from what's going on with Pollo Loco is that stocks that you don't think are doing well can do well. And if you look at some of the retail names and restaurant names like Pollo Loco, hitting some new 52-week highs on the back of really
El
good
Pollo
earnings,
Loco.
steady growth. And that's what, value investors and even growth investors are looking for, and that's irrespective of what's going on in the overall market. So
I didn't see what happened,
if you look at
sir.
the price action today, up around 16%. Before the move today, the stock was already higher by 28%
God.
over the last 52 weeks. And this, for those who don't know, is a quick serve and fast casual restaurant operator. They have about over 500 domestic stores, a good franchise relative to company-owned base, where about 25% are company-owned, the rest are franchise-owned.
Never heard of them.
And they did post some earnings that were much better than estimated. They posted 25 cents on adjusted
El
basis,
Pollo
beating the 20-cent
Loco.
estimate. So that was essentially about a 26% increase compared to 19 cents last year. And sales quite robust, 8% higher in the high single digits at 123 million versus 122.7 million. But under the hood, if you look at what they reported for system-wide comp sales, they were higher by 2.1%. But at the same time, this is where the kicker is. Transactions were down 2.3%. So if you look at top-line sales up 8%,
that is a kicker.
Transactions down 2.3%, but same-store sales higher by 2%. It gives you an idea this company is actually producing better pricing metrics and generating more
George, I'm
operating leverage,
confused.
because they're generating more same-store sales, which were positive relative to declining transactions.
Okay, and so we know that, the entire restaurant and discretionary space has been relatively challenged with a more cautious consumer. And how are they going about really navigating that they are somewhat outperforming everything else we've heard from anything with restaurant exposure this quarter?
Liar.
Well, that's a good question. I think some of the smaller tier names like El Pollo Loco, in terms of their market cap, which is around 325 million, sales around 480 million. So they're not the multi-billion-dollar names like restaurant brands or so forth. So I think these companies are still generating good revenue numbers because their price points maybe cater a little bit more favorably to the middle-income consumer. And with that said, too, as a business, they're generating better operating leverage metrics. And that's really what you want to see from an investing standpoint in the retail and restaurant space. And they're doing that very well. And, that, like I said, if you look at the ratios of same-store sales to transactions, they are generating a higher dollar spent per customer, and that's really what those ratios represent. And again, if you look at where the stock lies in the position of valuation with its growth again is somewhere in the mid-single digits for sales. The quarter demonstrates some really good EBITDA growth numbers, but the valuation is very balanced at around 11 times this year's earnings, 10 times next year's earnings. And so, again, it's growing at a reasonable price, and that's why you see stock price move higher from bottom left to top right on the chart. Absent what's going on in the total restaurant group. This is a standout company. They're performing operationally very well, executing very well, opening new stores. They're not opening too many. They did talk about how they're going to open effectively about 18 to 20 new locations in 2026. So their growth rates are not tremendous, but relatively balanced.
Yeah, and I think that seems to be the winning recipe here, no pun intended. So that breakdown on El Pollo Loco, which is up still now 6% this week, and of course making a solid move to the upside today. But as we do check in on markets here before we go, we have seen some degree of weakness since really the show began. We did hit session lows in all of our four major averages. We bounced a bit, but closing things out,
like your tacos.
1%, the Dow still the smallest laggard, and Nasdaq down about 0.7%. While the Russell 2000 also down about 0.6%. So
I'd eat there.
four major averages expecting to close out a losing week. The S&P's third, which then puts it on its worst losing streak in nearly a year. That will do it for us for Next Gen Investing for today and this week. Appreciate you all for tuning in. We have the watch list coming up next.
Oh yeah, Jimmy dear. Oh, look at that. Yum, 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 yum. Okay, well.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account. Plus,
SPX failed again.
solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Loco Moco.
Good afternoon. Welcome to the watch list. I'm Nicole Petalides. So glad you're with us. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange, and we have a big show for you today. Stocks went from positive to negative. We're watching oil prices that have been on the rise, and right now, $97.99 the barrel. And one of our guests is making some energy stock picks with names he's looking to outperform the market in 2026. In the options corner, Tom White is standing by and has real outside trades for Norwegian Cruise Line, Occidental Petroleum, and Dow Chemical, 3 names that really have been on the move. And we'll get an inside look at the very latest on consumer sentiment data from the director of that survey from the University of Michigan. As I mentioned, stocks have been trying to give it a go this morning, but it's a down week. We haven't had 3 down weeks in a row like this in a year, with the S&P 500 clocking in its worst day yesterday since February 12th. Right now, the S&P's down 0.5% at 6636, down 36 points. NASDAQ 100 down 0.75% at 24,357. Dow Jones Industrial Average down 69 points, 46,614. And the Russell losing ground as well, down more than 0.5%. Oil and gold are mixed. You know, gold's pulling back, 5,051 a troy ounce, down $75 today.
Woo!
87.85 the barrel.
Time to go out and buy a necklace.
All over the place. I mean, you know, on Monday we were at nearly $120 a barrel. It pulled back right now, 97.88. We've been releasing strategic petroleum reserves, but volatility is evident. And the dollar at 100. We haven't seen that, and I can't remember when. Okay, rub your eyes because that's a big deal. And Bitcoin has gained really pretty nicely. It's at 71,255. That has been on an uptrend. Kevin Green, our senior markets correspondent, is with us, and I think it's worth noting too that the 10-year bond yields are 4.29 now. I mean, we're getting closer and closer to 4.5. Look, third week of losses here for the major averages. Looking at the S&P in particular is when I was saying that. Your thoughts?
Well, Nicole, we're getting really close to some key areas of resistance. If you're looking at the 10-year Treasury yield at that 4.3% level, that was actually an area of resistance that we saw back in early January, where we did start to see a little bit of flush in that yield. And then the dollar, going back to that 100 level, is also going to be key. It's trying to break out higher. And if we continue to see the dollar strengthen, that could also put a little bit of pressure when you're looking at silver as well as gold, as the dollar is now looked at, and has been, obviously, as a flight to safety type of trade, and kind of backing out those rate cut expectations moving forward. Now, the S&P 500 is down about 0.5%, but if you're looking at the sectors, we still have around maybe about six sectors that are in the green so far, a lot more defensive in nature if you're looking at utilities, catching a little bit of a bid, as well as real estate. And technology and communication services is really where we are seeing the majority of the weakness for today. And in fact, we have about 56% of the stocks in the green for the S&P so far, even though we started off the day around 92% or so. So we are seeing some pressure, but we're only 30 points away from the 200-day moving average, which will be a key inflection point for the S&P, where maybe some buyers try to step in and buy the dip. But obviously we know that there's going to be geopolitical risk over the weekend, and that's what the market is positioning for right now.
I think so too.
Getting close to that $100
geopolitical risk.
WTI, only about $2 away from that level right now. On the maybe potential risk that we see this situation escalate, and it does appear that a lot of military action is actually taking place as we speak, which is also causing these energy products like crude oil and gasoline and heating oil to rise higher.
Yeah, we know Pete Hegseth and the Department of War, Department of Defense, will saying that we're going to keep ahead, keep going. At the same time, Iran's been very tight in trying to keep the Strait of Hormuz closed, which they've been doing pretty effectively, and saying that they will continue to fight back. And they talked about $200 oil as a way to pain everybody. In the meantime, we've gotten so much economic data. What stands out? What's important to pay attention to here?
Well, we had $200 oil. So the two main factors that we want to kind of look at here is obviously inflation. So we had core PCE coming in at 0.4% on a month-over-month basis, which on a historical basis is actually relatively hot, but it did meet the street's expectations. And when you're looking at headline CPI, that increased by 0.3% on a month-over-month basis, once again meeting the street's expectations when you're looking at that month-over-month comp. Now, year-over-year, if you're actually looking at headline CPI, it came in at 2.8%. Street was looking for 2.9%, so a little bit better there. We also had the GDP numbers. We talked about this earlier this morning, but I found that to be very interesting as well. Q4 GDP actually grew by 0.7% on an annualized basis, pretty much cut in half from the preliminary print. We will get a final revision here over the next couple of weeks, but you did see the price index also inching to the upside, and the annualized growth rate, once again, this deceleration that we are seeing, at least for 2025, where we did see the lowest growth rate for the U.S. economy since COVID-19. That's also kind of a big deal that the Fed's probably pricing in right now. So a lot of headwinds that we're kind of focusing on. It seems like the market's really trying to get a little bit more defensive, just given the fact that this situation could escalate. But a bright spot in this market here today, Nicole, to keep your eye out on is private credit is actually catching a bid today. So we're not seeing that falter anymore, at least for now.
Yeah, There were so many liquidity concerns. Was it systemic risk or just sort of a one-off type of thing? Thank you, Kevin Green. Appreciate it. So we continue to take a look here at the big picture. Kevin, nice to see you. And we join with me right now here on set. Joy Yang's here, head of product management at Market Vector Indexes. I'm so glad you're with us. I just saw the New York Fed brought their GDP cast down to, for the first quarter, 2.09. I was just talking about this with Kevin. The previous was 2.23%. Look, people are expecting now that this Iran war will hit the economy, maybe inflation, all kinds of things that could happen. What say you?
I think, well, this is definitely a significant disruptive event, right? So aside from the human tragedy, we know there should be some kind of economic consequences, and we're slowly starting to see that. But I think there's still a lot of uncertainty out there. Investors have not panicked as much as we would have expected for an event this size. Markets are down, but they did start up. So I think as news kind of materializes, we'll see it impact the markets more. And specifically, I think what we're starting to see is even in the prediction markets, we're seeing that this is not likely to be a short-term, conclusion to what's happening at the moment. So if this carries on, if oil sustains at $100, this will impact inflation, prices, and again, the psychological effect of investors expecting inflations and prices to remain high.
I think you're right about the no panic. I mean, I know we've had some volatility this week.
She is right, baby.
100-point swing on the Dow. At one point, we had $120 oil. We have the 10-year bond yield at basically 4.30. We haven't seen that. But there hasn't been a panic feeling, has there?
No.
Investors are waiting on the side. They're either expecting a taco reversal, or they've been burnt by taco reversals where they're looking for more information. But also we have to remember what
Did you say taco?
Is about war and its impact on markets, which is usually markets tend to absorb these type of shocks, whether it's in the 70s, oil embargo, or 9/11, or if you look at the great financial crisis, or even more recently, a pandemic, markets have consistently delivered 11% returns year over year, but you don't get 11% returns every year. So you're going to have to suffer some of these drawdowns in order to get rewarded for the risk.
And a lot of times, like what you're saying, is we have the sort of the volatility or the noise, but then in the long run, the stock market's back up again, whether it's 6 months, 12 months, or 18 months, right?
So I think investors have to be disciplined. They have to stay focused. Timing the markets at the moment is probably not the best strategies, because we've seen, even with professionals, some of these hedge funds got recently burned quite badly, trying to time specific events. So I think it's still prudent to think about being in a diversified strategy and to stay focused on, where your long-term goals are going to be and what your risk tolerance really is.
So what do you think is the opportunity here?
So I think, there are some structural shifts. And if you look at emerging markets, although they are not one homogeneous block, we can see that, if you look at these commodities-rich countries, they're going to be less sensitive to supply chain shocks. Brazil is one where interest rates are 15%. Even if you look at Korea, which, these Asian markets are sensitive to these oil shocks, but, Korea had the most significant one-day drop in its market history, yet year to date, it's still up 20%, because these emerging markets have been fiscally disciplined,
right.
And they've been quite resilient if you look at how they pivoted either from the pandemic or even with these tariff issues.
And Brazil, I mean, you were there recently, I believe. What is the sentiment like there?
I think, well, there's going to be an election, so people are watching the elections, but broadly, there's a lot of enthusiasm for the local market, and I think given how the markets are opening up with ETF flows, I think there's more interest also in diversifying away from just looking at Brazil.
What about here at home, like Mag 7? Are those on or off?
I think investors have to be careful when looking at the U.S. markets because they are so concentrated to the AI narrative, right? So now you have equities concentration, but you also have bond concentration with all of these big AI hyperscalers trying to issue bonds, right? So you're highly exposed already to AI, including these venture capitals. So I think it's still prudent to look outside of the U.S., especially with everybody outside of the U.S. trying to, diversify away from their U.S. exposure.
Also, what about the Treasury market? Why is it important when you look at this at 4.29% today? Are you also putting fixed income in a portfolio? You have a higher yield environment now, good or bad, or what do you think?
Well, you have to look at where inflation is going to head, and you have to look at the size of the debt. And we have, still a government that's, waiting to convene. So I think there's a lot of risks here. But there is no alternative to safe havens like the U.S. dollar. It's still, a pretty strong safe haven.
Yeah, you mentioned emerging markets as being an opportunity. What about gold?
Gold is still a strong case, and I think investors look at gold and given the momentum of where it's been heading in the past few months, they think it may be expensive. And so we saw a little kind of profit taking recently because this type of momentum does attract speculators. But I think as we clean up, the leveraged players out of this market, there is still a strong case given how sovereign countries are holding gold and trying to diversify from U.S.
Yeah. Look, I mean, it's pretty, do you expect gold to go back to the highs? I mean, is that where it's sort of headed?
I think if this carries on and there's going to be stronger demand for a real asset, gold will continue to head up, but I think there's definitely a new floor where we can't, we don't know what the fair value.
And crypto has been running up too. Are people sort of, getting out? They were saying that maybe even people in the Middle East are changing their money over to Bitcoin. I don't know if that's true, but Bitcoin's had a nice run. We were at 73,000 earlier today. Some of your thoughts on crypto at all?
I think crypto is definitely, including Bitcoin, is definitely an interesting space to watch. We have what we call the crypto heat monitor, which had been looking at crypto assets in the fear zone. Right. But I think just today it kind of triggered back into kind of a stable area where it's really kind of taken some of that panic out of the market. And as you said, it has real use cases for moving money and being a store of value where investors are back in looking at its fundamental principles.
So it sounds like you're not touching U.S. markets really. I mean, you're doing some fixed income, you're doing emerging markets, you're doing gold, but it sounds like you're not interested in cautious right now on U.S. equities. Is that a good summation?
I think investors need to be cautious. I wouldn't say don't touch it, but I would say please be diversified and think about your concentration risks.
Joy, it's nice to see you. Joy Yang, Head of Product Management at Market Vector Indexes. Thank you. Coming up, Options Corner, Tom White is standing by and he'll highlight the unusual options activity from the day, how investors are looking to trade on recent news of Norwegian Cruise Line, Occidental, and Dow Chemical. Stay with us.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the watch list. Time for our options corner, where we analyze unusual options trades that we're seeing throughout the day. Welcome in Tom White, host of Fast Market here on Schwab Network. And want to get to some key names. You found some bullish trades too. And there's a lot of concern that maybe it was underestimated how much the Strait of Hormuz would really become a topic here on Wall Street, especially as the supply chain disruption, the risks might take a quarter or two to normalize, things like that. At the same time, oil's at $98. Some of your thoughts?
Yeah, if you take a look at just the trajectory that we've seen in crude oil since this conflict started, it's not going to go away anytime soon. And I think the longer that this this war lasts, it's going to negatively impact the length or duration that we're going to see us come out of this. Right? Everybody expects, hey, if they announce some type of ceasefire, they start working with Iran, that oil is going to go back to $60, $70 a barrel. I don't know if that's going to actually happen. And the longer it goes on, the more disruption that it's going to cause, not only across the corporate side, but also the consumer side. So every aspect of the economy. We saw that drop in the GDP today from Q4. I mean, these are lagging numbers, but it's almost reflective of what's going on, that we're seeing a slowdown, and this isn't going to help. So hopefully we can get through this relatively quickly. But the S&P 500 now setting up for its third straight weekly loss. I mean, that's the longest streak that we've had in a year, Nicole. So yeah, a lot of uncertainty out there, and the VIX is reflective of that as volatility continues to rise.
Yeah, and when you talked about GDP, it made me bring the New York Fed GDP nowcast, right? How they brought that down to 2.09% from the previous 2.23. So with each move in oil and each tick up in oil, the sustained move, 10% rise in oil, lowers GDP by 0.1%. The sustained 10% move in oil equals 0.2 plus inflation, on the plus side, so raises inflation. So we have to watch what happens here. In the meantime, let's get to some bullish trades, real trades that you found. Let's look at Norwegian Cruise Line. Why is this one on your radar?
Yeah, it was having a good day at the start of the session. Remember, crude oil was down a couple percent. The equity market was higher, and this thing's reversed, now negative on the day. Down about 22% this month. So reflective of the impact to crude oil prices, to the travel industry, cruise lines, airlines. We've seen these big drag downs over the last couple of weeks in these stocks, down 22%.
In CLH, it's one name I can't remember.
And they've hedged about 51% of their fuel needs for 2026, but only about 27% in 2027.
Oh, we're at a good spot.
Conflict continues to last, or crude oil remains elevated, their fuel prices are going to go, or their fuel needs, what they pay is going to go up pretty significantly. And then last quarter, after earnings, they gave lower than expected guidance to the street. That's why you're seeing some activist investors get involved here. Elliott Investment Management disclosed basically a 10% stake in this company. To try to right the ship, no pun intended, because of the fact that it's lagging its competitors, even Carnival, which it usually outperforms, but this has been maybe an execution problem why Elliott Investment Management is getting involved. But we did see some bullish activity in here. This is really short-term positioning by this trader, maybe expecting crude oil prices to fall sharply, because I think that's going to be the only thing that's going to help the stock. This is out in the March 20th monthly option, 7 days to expiration. Trader bought 9,000 of the 22 strike calls. Only paid an average debit of about 22 cents on these calls. It's really an expensive stock. Not a lot of option premium in these out-of-the-money calls. So the break-even with this trader starts to profit $22.22 over the next week. That's about 16% above the current share price in Norwegian, with call volume about double normal daily average volume. So maybe somebody expecting a little bit of easing on the tensions here, maybe get crude oil down. That would definitely help the travel stocks, including Norwegian.
All right, and look, as oil's on the rise, we got to watch anything related to transports that uses oil. And so as you noted, this name's been under pressure, and a stronger dollar too is an interesting part of the story. How about Occidental Petroleum? Why is that name on your radar?
Well, this is the exact opposite. Company taking advantage of these higher oil prices, and you've seen that in Occidental. It's up 41% so far this year. We hit levels this week that we haven't seen since August of 2024 in the shares. And remember, Warren Buffett owns about over 28% of the shares outstanding in this company. Remember, I think we talked about this 6-8 months ago, how that investment had been degrading because the stock had continued to fall. But now we're seeing that bump up in here. And we got just earlier this week, Wells Fargo double upgraded Occidental to overweight from underweight. They put a price target of $69 up from 47 on this as they adjusted their Permian Basin spending plan. But then, a lot of these stocks just rely on the commodity that they're based off of, and that's crude oil. And that's why you've seen a lot of the movement to the upside. Besides that, Wells Fargo double upgrade. Piper Sandler also this week upgraded the stock to from neutral to overweight also in this company. So saw some bullish activity in here also, not surprising. A lot of people rotating into these energy names. This was out in the April monthly option, so 35 days to expiration. Trader bought 5,000 of the 62.5 strike calls. Paid an average debit of about $1.35 on these calls, so that break even of $63.85. A trader needs to get above there over the next 5 weeks. That's about 10% above the current share price. So not out of the realm of possibility that we can keep going up, but if this drags on, crude oil gets back above $100 a barrel, I think that's what this trader's betting on.
Yeah, look, I mean, you're right around that 52-week high. You look at the XLE, you're seeing 52-week highs. For example, the XLE right now, 3 months up 25%, so definitely, but just this recent run, I mean, just in the last few days, month to date, let's say 3%, but certainly big moves. Last but not least, Dow Chemical.
Down 1% today, but this has been a big winner over the last week. We're up about 11%, up about 58% just so far in 2024. So we've seen a massive rally in a lot of these chemical names. It's just not Dow Chemical, it's Leiden Basel, LYB, and some of the other names within this space that have seen a big resurgence, because you can look there from the chart. This stock was a falling knife, in the middle of 2025, but had a nice rebound here. We've seen about 4 or 5 upgrades in the last week in this stock. Citi upgraded it to buy to $40 price target. Vertical Research to a buy. RBC Capital outperformed. JP Morgan upgraded to overweight. And this comes on the back of the offline capacity in polyethylene, a lot what they produce. Their estimates are anywhere from 15 to 25% of the global capacity is offline.
So
who's taking advantage of that? Well, it's Dow Chemical and some of the other U.S.-based firms here in the chemical space.
That's a good exit idea.
Yeah, a lot of positivity in here, rotation into a lot of these names. We've seen it in Dow. That's why we've seen the stock spike. We did see some more bullish activity in here, probably on the back of all these upgrades and the outlook for this stock. This was also out in the April monthly option, so 35 days to expiration. Trader bought 10,000 of the 37.5, 47.5 call vertical, so a bullish $10 wide call vertical. They bought 10,000 times, paid an average debit of about $1.90 on these call spreads. So that break even where this trader starts to profit above $39.40 over the next 5 weeks. That's about 6% above the current share price. So instead of just buying the outright call, they offset some of the costs by buying a vertical. But big open interest positions on both of these strikes, so maybe they're adding on to a trade that's already probably done pretty well.
Dow?
All right. Well, thank you for all of that. Tom White every
Yeah.
single day here on the watch list with Options Corner. Dow Chemical right now down about 2%. Three key names there to watch: Norwegian, Occidental Petroleum, and Dow. And coming up, we're going to tell you to follow the oil story because obviously it's front and center. I had one guest who said we're going $150, $200 a barrel. In the meantime, what kind of energy stocks or plays can you have for your portfolio? Our next guest does have some picks for you right after this.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the watch list. I'm glad you're with us. I'm Nicole Petalides, and we're live on the floor of the New York Stock Exchange. We have a few movers for you in the market right now. We've been watching Ulta Beauty shares. They've been slipping today after the company reported some fourth quarter sales that were strong and saw growth, but did miss on some of the profits. And it issued a softer guidance for 2026. The net sales rose 11.8% year over year to $3.9 billion, topping the consensus, while comp sales increased 5.8%, supported by the Beauty Unleashed strategy and Space NK acquisition. And looking ahead, Ulta expects net sales for 26 of 6 to 7%, slightly above the estimates, but guided comp sales
little overbought.
were under the estimates. So right now it's down about 13%. Biggest sell-off in 2 years. Adobe shares, well, those are dipping today as well. Did have a beat for the quarter. Revenue rose 12% year over year and topped consensus expectations. Subscription revenue climbed 13% to $6.2 billion.
Okay.
Adobe does expect second quarter quarterly revenue and earnings per share to both beat the estimates. But the company also announced that it plans to have a step down of the CEO, Shantanu Narayan.
Way overbought.
After 18 years in that role while remaining chair of the
We're at
board.
support.
The leadership transition now to the company's future. All right, we're back to business here on oil. Lucas Downey, co-founder of MoneyFlows.com, is with me. And there's been a lot of talk about where is oil headed. Where is oil headed? What do you think?
Yeah.
It's great to see you, Nicole.
Good question.
Great question. I mean, we've been seeing a lot of wild moves that have been happening in the crude space. And what we did over the weekend is we studied a lot of this big move. The first thing that we did was we noticed that USO, that's the crude ETF, it jumped 12.9% in a session. This is
How do you
last
do that?
Friday. We went back in history and asked one question. We said,
What's
well,
that?
what happens to XLE when USO gains 11% or more in a session? Now, there have only been a handful of these instances. And the reality is, over 20 years, 3 months later, 80% of the time, XLE is up an average of 26.3%. If you go out 12 months, the win rate is 80%, and the average gain is 56% for XLE. Now, we didn't stop there because that was just one data point. We asked another more important question that said, okay, in a 6-day period, USO gained 36%. It was 36.4%. Turns out that is the largest 6-day return for USO in its history. So again, about 20 years. I thought for sure this was going to be a big fat sell signal, but it just wasn't the case. And I think the bottom line is 3 months after this big surge in oil prices, XLE gains 6.2% on average. And I think the hallmark piece here is that in all instances, it was 14 instances when XLE gains 20% or more in a 6-day period. Energy stocks, XLE, have never been lower, and the average gain in 12 months is 37.2%.
So the big picture here is that as the oil goes higher, and sustainably so, the oil stocks and the XLE and those names involved will go higher as well, right? Is that sort of the takeaway?
That is the big takeaway. And then when you marry that with the money flows data, year to date, energy stocks have been the number one ranked sector that we have. They've seen the most inflows. You know, we came into the year talking about the year of rotation. Obviously, we didn't know we were going to war with Iran, but, you know, the data confirms basically what we're seeing right now. I mean, this has been the trade since January, energy stocks.
What happened to all the energy that we would need for AI and data centers and all that? I mean, we're talking so much about oil and nat gas and LNG and helium and fertilizers, and we sort of stopped talking about how we're going to power the data centers and all that.
We did, and I think that's just the type of year that we're in. I mean, a lot of things that we were talking about a few months ago. I mean, everybody was bullish on banks and thinking that the calendar was going to explode this year. People have kind of put that aside due to all of the volatility. It's a midterm election year, so I think the narrative is going to be changing a lot, you know, really until we get into Q4.
So at this point, you have oil and gas names that you think people should own, whether it's right now or in the months ahead. Let us know what they are.
Yes, so we're going to keep it very simple from the top. ExxonMobil, right, it's been around for decades, continues to just power higher. We like this name because year to date it's had 11 discrete inflow signals, not one outflow in our data. We like the EPS growth over 2026. They're estimating $6.79 per share. For next year, that's going to go up to $8.47. So anytime earnings are going to continue to expand and you have just gushing inflows of money going into the stock, we want to lean long that name. For the number 2, we're going to go to Chevron. So this is ticker CVX. And just like Exxon, this is a name that's had 13 inflows all year, not one outflow. The earnings for 2026 is $6.43 per share. That's going to go up to $8.49 based on estimates for next year. And so again, earnings are growing, money flows are going into the names, the top ranked sector. You really don't have to get cute here. And then for the third stock, this is going to be Diamondback Energy. This one's a little bit different than the other two. This one is more of like a processing type of company, smaller to $50 billion market cap. But it has had 11 inflows this year, and it's had 4 what we call outlier inflows. And that means that it's one of the highest ranked stocks literally in our data this year. So that makes it a little bit special. And all of these stocks have a great dividend. And we all know that based on history, when volatility strikes, dividends can really help you and your portfolio.
What kind of percentage gains do you see near term and long term for these names?
I could easily see another double-digit gain coming in for all of these stocks going through the next 6 to 12 months.
So yeah, so that's 10% plus, right? I mean, that would be a fair.
I think that would be.
Yeah.
I think that would be at the minimum, and you know, as long as crude oil continues to stay elevated, I think we could get there relatively soon.
It doesn't look like the Strait of Hormuz is opening anytime soon. Oil, obviously, we've had less production from Saudi Arabia and some of the other countries. We're releasing strategic petroleum reserves, but they're not going to meet or exceed what we're missing. That being said, right now, oil's at $98, so 100 is a stone's throw. I won't even say, do you see 100 again? But do you see 120 again? Because we were right there on Monday morning.
Well, I think supply and demand. I mean, we've seen just how fast crude prices can move, especially in these overnight sessions whenever God knows what headlines are going to drop. So yeah, that is not out of the picture. 120 is certainly in the picture. Yes.
Lucas Downey, co-founder of MoneyFlows.com. Lucas, great to see you. Thank you so much. Really appreciate it. And his picks today, Chevron, Exxon, and Diamondback. Thank you. All right, coming up, the lingering uncertainty in this market. How investors can and should stay calm during the bouts of volatility. We'll explain. Our guests are ready. Next on the watch list.
Oh.
Sometimes, you know, you could have done better. Same goes for where you invest.
She did that
Level up
good.
and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardas and
Say,
connect with me on LinkedIn or Instagram.
Look where the SPX went.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim.
Who was not paying attention?
Award-winning trading platforms. Bring your trades into focus
Damn.
on Thinkorswim desktop with
Gimme.
robust charting and analysis tools, including over 400 technical
That's
steps.
it,
Tailor
man.
the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab. Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome back to the watch list. I'm Nicole Petalides. Going back and forth on the Dow, we're up 8 points, but the S&P in the negative. We welcome in Robert Conso, CEO and Managing Director of the Wealth Alliance, to our show to give us some looks at what's going on here in the market. Everybody's trying to make sense or try to understand a little better what's going on with all the geopolitics and the recent economic data. How are you feeling?
Oh gosh, I think the word of the day back is uncertainty. It was there in the Trump era, and the tariffs went down at the end of 25 when the VIX hit 15, and here we are again. And we know why, right? There's just a tremendous amount of volatility in various data points. I know your prior guest was talking about oil. I mean, you saw it, WTI 1231 around 56, 57, goes up to 116, drops down to 78, sitting at around 98. That's big volatility. And you could go further from that. The Fed struggling with what's going on with labor. Labor jobs came out unbelievable around 48, 1231, got revised down to a negative 17,000. January up to 126. February comes out a negative 92. And that that volatility is just causing a ton of uncertainty, and you're seeing that in the VIX starting at 15 and 1231 going up 30 plus and sitting around 27. Just a lot of volatility, and it's coming out in equity markets as well as bond markets. So it's tough for the investor right now.
And at this point now, is it hard to pick stocks to invest in or trade?
It's difficult because what you're seeing is people throwing the baby out with the bathwater. Meanwhile, there are areas that are obviously doing well. You were speaking about today, energy through the roof. You're seeing infrastructure trades up almost 9%.
142.
Year to date. Financials, what we just had, the regulatory changes in reserve and banks that just came out. That was a big deal. First time that happened since the great financial crisis of 08. So there are areas that you can pick and choose, but what investors have to remember is you hear a stat like since 1970, when the top 10 of the S&P are 30% or more of the index, and right now the top 10 are 40% or more. The next 5 years going out, there's a 95% chance that the other 490 will outperform the top 10. And by the way, look at large cap growth. The Russell 1000 down 7.5% year to date, and value up 1%. You can start seeing that happening right now. So the key here is be careful, because you're seeing equities go down, your bond values are going down with the 10-year Treasury going from 3.9 up to 4.2 yesterday. Bond values dropped out. That's scary for the 60-40 investor.
Yeah, at the same time, though, it sounds like you're bullish because you said in 5 years, most of those S&P names are headed higher. So
Yeah.
you're buying in. You're buying in. And what kind of names are you buying? Are they S&P 500 names?
Yeah, said perfectly. We are bullish. Not, listen, when you come off a 3-year double-digit rate of return market, that hasn't happened since the late 90s. You got to keep bullish sentiments in order. And by the way, let's not forget, it all hinges, a lot of it, on how long this war goes on. High oil prices in the 100 plus permeate through a market in big ways. So inflationary concerns start running through, and then you start seeing people feed on themselves. On top of that, you have a very bearish sentiment right now. The American Association of Individual Investors, the AAII, was at 50, now it's at 30. That means negative sentiment, and sometimes that feeds on one another. But yes, we're feeling relatively good about the market because there's a lot of bright spots in economic data. You just saw, it came out today, retail sales, 5th consecutive month, positive. That's big. PCE was relatively unchanged, down a little on headline, up a little on core. That coupled with good CPI numbers, good unemployment numbers. It's really the labor numbers that are really causing the Fed big problems, and they'll have a hard time in July how to deal with that.
So I don't think you mentioned any names, but you would buy the S&P 500. Is that what you're telling me? Because it didn't sound like you mentioned any sectors or specific names to be actionable for advice. But you would buy the S&P 500?
We're leaning into infrastructure trades. That has been very good for us. Like I said, IGF has been up almost 9% year to date. And on top of that, we always, we're diversifiers, which sounds really boring, but they're not. Because when you look at what happened in last year, you had emerging markets number 1, developed international number 2, and the U.S. number 3. What we did is rebalance out of those into U.S. going up, and now what are you seeing this year? It reversed back. So what are we buying this year? We're in EM, developed, and pulling back on U.S. So the old adage of rebalance, it works. It works very well, and you can buy into areas that got hurt, and that's exactly what we're doing now.
And then what about the volatility? The consumer, is the consumer going to keep GDP alive here?
Well, listen, like I said, retail sales just came out, right? It's 0.27 month over month, 5th consecutive month. The consumer is still spending in spite of all the headline risks that you're seeing. It's a major, major backbone of our economy. Inflation is holding steady. The problem with these stats are everyone is saying, well, that's then. And what's going to happen going forward? If this war continues, if we have big spikes continued in oil, well then that's a whole different ballgame. And you're seeing the government do all they can to put out little snippets, release 400 million barrels of oil, watching the Strait of Hormuz, and the list goes on to keep this headline risk down. But if it goes on longer, it's going to be tougher and tougher and tougher for prices, and the consumer can get nervous and start to pull back.
All right, Robert Gonzo, thank you. Great to see you, CEO, Managing Director, the Wealth Alliance. Robert, thanks. Still ahead, we're going to look into those consumer sentiment numbers that we saw look pretty much in line, but lower than the prior month. And what does it mean specifically? What are our takeaways from these numbers? We'll be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the watch list, and we are happy to be joined now by Joanne Shu, Director of the Service of Consumer and Research and Associate Professor, University of Michigan. The preliminary March consumer sentiment data comes out. We saw that 55 number, 55.5 in line, a little less from the 56.6. What are our takeaways? What does this really mean is happening? What's the interpretation, please?
So what's really important to note is that this month's reading, about half of the interviews were conducted prior to the start of the conflict in Iran and half after. And so while we were seeing sentiment on a bit of an upward trajectory before the conflict occurred, once it began, sentiment, all the sentiment gains were erased. Sentiment declined, gas price expectations went up, inflation expectations went up. So consumer views absolutely shifted after that conflict got underway.
So at this point, how do you look at the months over months? I mean, what trends are we seeing? So this is the March preliminary. What are we seeing for monthly trends? Because as you said, look, half of this was done before and half after the Iran conflict. So, you know, what have the prior months been telling us up to this point?
Consumer sentiment has been treading water for several months now. We've had readings that are in the bottom 10% of historical readings. So we've had, slight movements up over the last few months prior to February, March. But really they were very minor, and consumer sentiment was very much treading water. Consumers are quite worried have been quite worried about weakness in the labor market, and they're expecting labor markets to continue weakening. And the main thing that's happening now with the Iran conflict is worries about inflation. Gas price expectations pretty much reacted immediately. And so if gas prices, if energy prices continue to tighten and to heat up, and that passes through to consumer-facing inflation, sentiment is likely to continue to decline.
So inflation worries, do you feel like they are getting accelerated now with the oil story?
They appear to be, yes. Over the last couple of years, consumers had recognized that inflation had slowed, but they continued to express a frustration over the persistence of high prices. Now consumers are worried that slowdown is going to reverse, and so they are feeling increasingly burdened by the prospect of higher prices. The expected personal finances that we measured this month, 7.5% lower month over month. And we saw that across demographic group, across the income distribution, across political affiliation. There was a broad consensus about this. So consumers are quite concerned that their purchasing power is going to be eroded in the year ahead.
The jobs report that came in last Friday and the revisions prior, and you know, as we look at JOLTS, which have been trending lower, how weak is the labor picture, and how does that fit into the sentiment story? Because you said they expect for labor to continue to weaken.
That's absolutely right. So compared to a few years ago when sentiment was also fairly low, like in 2022, 2023, consumer spending remained robust because labor markets at that time were really tight. And our measures show that labor market expectations at that time were quite strong. And that story has completely flipped in 2025 and into 2026. The labor market expectations really deteriorated over the last year, and we still have a majority of consumers expecting unemployment to rise in the year ahead. When we ask people about their personal risk of job loss, that continues to be elevated. Nominal income growth still pretty anemic, unchanged from last month, but at pretty low levels. And again, consistent with the personal finance expectations, real income growth took a step down this month as well.
And would you say it's fair to say, and what I read was that, you know, over the last few weeks or so, that people are staying put in their jobs, you know, that they don't necessarily want to change jobs, they're not necessarily making more money at a new job, you know, that there's a lower quit rate than there has been in the last few years. People now want to stay put. Is that right?
What we're seeing in the data is absolutely that consumers do not feel confident about the labor market. And when they don't feel confident about the labor market, they're less willing to take risks, like quitting a job before finding another. This is not the same situation we were in a couple of years ago. Great resignation, people job hopping, that is certainly not the case now. Consumers are feeling quite cautious about the trajectory of the economy, and as such, they are unlikely to take major risks like trying to job hop.
Yeah, the great resignation, that was actually a big deal. I'm glad you brought that back up. And reminded folks at this time too, you know, how quickly can things turn around? Can we have something positive happen quickly or not necessarily? I mean, are we sort of now in a time where we're going to have to normalize and everyone needs to be patient?
You know, I think one of the big questions from last year was what was happening with tariffs. And consumers were really taken aback by how high the tariff rates ended up being, and they braced for a worst case scenario. So that worst case scenario clearly has not come to fruition, and consumers have been slowly recalibrating their views in light of that. Now, you know, with the Supreme Court ruling on tariffs, throwing tariff policy back into uncertainty, and add on top of that the uncertainty in the Middle East, really all bets are off right now. I think there's a tremendous amount of uncertainty over the factors that consumers believe are going to influence the economy, and I think consumers perceive that uncertainty rightfully so. So as such, you know, when there's so much uncertainty going on, it seems difficult to see how a fast turnaround can happen unless that uncertainty is resolved somehow.
Also a lot of talk about the bright spots. There's been a lot of spending on AI, and that adds to GDP. You've had a lot of CapEx spend. Jobs get created with all the manufacturing and infrastructure being built. The one big beautiful bill. There's been a lot of folks who've come on and said there are plenty of tailwinds.
I think that from the consumer's perspective, the tailwinds that consumers perceive are pretty limited to people at the top of the income and the wealth distribution. Prior to March at least, folks at the top of the wealth distribution, consumers with the largest stock holdings, their sentiment had recovered quite nicely from last year, and then they were supported by strong asset values, strong asset markets. But with the current geopolitical situation, all that is quite up in the air, and we're not necessarily going to be seeing continued strength throughout the wealth distribution.
Joanne Shu, thank you so much. It's great to see you. I really appreciate this conversation very much. Thank you. Director of Surveys and Consumer and Research and Associate Professor at University of Michigan. That's going to do it for us here on the Watch List. Thanks for being with me. I'm Nicole Petalides every single day at 9 a.m. and see you for opening bell, 2 p.m. for the Watch List. Right now, the Dow is up 10, the S&P's down 20. Market on close is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Good afternoon, happy Friday. It's 3 p.m. here on Wall Street and this is Market on Close. I'm Sam Bartis, it's just me today, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We'll recap some of today's economic data and see how the Iran war is impacting consumer sentiment and inflation. Later, we'll discuss the recent market volatility and find out if this market is giving an opportunity to buy the dip or not. And in Options Corner, we'll look at options activity around memory name SanDisk as it gains almost 20% this week. But let's take a look at where markets stand heading into the weekend. We're seeing a bit of de-risking. Typical, as we've seen the last couple of Fridays here, a bit of caution going into the weekend, given, of course, the headlines that we typically get when markets are shut. And that very much seems to be the mood today. We're actually seeing the S&P 500 not managing to hold on to that 6,700 mark we had seen earlier. We had seen all major averages actually opening the day higher before actually turning lower throughout the mid-morning. We saw a reversal, and that was largely to do with oil ticking up. We saw the dollar climbing as well. We're now at 100 on the Dixie. And Treasury yields also, the 10-year, almost approaching 430 right now. I believe we're about 428 as we stand. So a lot of that is weighing on some of this risk sentiment today. As I mentioned, starting higher, but staging a reversal throughout the course of the day. And in fact, technology seems to be getting hit today. The NASDAQ is suffering the most losses percentage-wise. So here's a look at some of these futures products. As I mentioned, we've got the 10-year yield pushing higher. There are concerns around the inflationary pressures and also the cost of this war in Iran. And really, that's where some of the anxieties have stemmed from. And that is globally, as we've seen those yields on the longer end globally actually pushing higher. The dollar index, as I mentioned, at 100 right now. That is pressuring precious metals as well, as we have seen that strength in the greenback today. So we are seeing some steam coming out of gold right now, down almost 1.5%. We're just above the 5,000 mark there on the yellow metal. Crude oil, the big story, the big chart, and what is really driving the market action right now. It's up at 2% right now. Actually, as we started the day lower, we're at $97 a barrel as we stand. Bitcoin, though, still catching a bid. Interesting proxy for some risk on sentiment here at 71,000 and change. So I'm not alone. I've got Nicole Petalides sitting beside me now, just for a breakdown of what we're seeing out there. Nicole, obviously we've had so much information by the way of the economic data, but I mean, so interesting as we look at this index versus the violent churn that we've seen under the surface. I mean, you've been here for so many years, and I mean, I just want to get a sense of what you're seeing out there, what the nature of your conversations have been, just around the volatility and yet somewhat of the resilience we've seen in U.S. markets at the same time.
So when you say the index, you mean the S&P 500
Yeah.
index versus the churn underneath? Because when you look at where the S&P is, I know we're down 3 weeks in a row. We have not seen that in 1 year. So it is showing weakness in the market. But many of my guests coming on still like so many different areas. I mean, they've talked about infrastructure. They still like energy names. Yeah. They are here picking gold. They're here picking the, the S&P minus the Mag 7. Most of the guests that are coming on are still staying positive because that's the resiliency that we saw last year as well. And as well as when you look historically, when you have a war, that the markets do move higher ultimately after that, 6 months, 12 months, 18 months. Yeah. So people are looking at this and saying this is noise and it could affect inflation, right? We can move up if you have it up 10%, oil up 10%, that would hit inflation right now. Let's see, if you have sustained rise in oil, it hits GDP down 0.1%. Okay. And if you have a sustained 10% rise in oil, inflation goes up 0.2%. So you're going to see inflation rise, GDP come down, but it's not catastrophic.
Yeah, it's interesting that you've talked about some of the scenarios that various economists have modeled and the markets are modeling right now. I was talking to the conference board as well, and they have been doing sort of similar scenarios as well as to how high oil has to go and how long it has to stay there to see a marginal impact on GDP. I mean, it's interesting that we did see that big revision to the downside for GDP in Q4, which makes you wonder what the setup looked like going into the energy shock like we've seen now. And big question marks. I'm just wondering, what your guest sort of said. I know you were just speaking to Umish also about their consumer sentiment survey, which is interesting. I think there's a big question mark over the timing of that survey, just how people feel right now versus when they collected some of that data as well. And then also just the PCE, the jolts, which actually doesn't seem to be causing any alarm bells just yet?
Yeah, so consumer sentiment, just had a great conversation with Joanne Shu of the University of Michigan. My takeaway there was, and the point that you made, which is very appropriate, where half of the respondents were before the Iran war started and half were after. So the takeaways there was that we have a weak labor market, that will continue, and that the outlook for inflation was on the rise. But again, not catastrophic. When it came to the PCE, that core rate, the 3.1%, right? You're looking at that, that's a little higher. You have GDP, which was revised down, and the New York Fed comes in just a short time ago today and revises lower to 2.09% from, I think it was 2.33. So I think people are revising slightly.
Yeah, and that's where that stagflation conversation comes into the market, doesn't it? Because obviously you have this situation where the jobs have been coming off, but showing signs of stability. I mean, even with, of course, what we got this weekend with the jolts as well. But it's really that inflation picture that seems to be the worry now if you don't have as stable economic backdrop as perhaps you once thought. I mean, that was pretty much cut in half, that GDP.
You know, I was thinking about how, you know, first of all, you mentioned jolts, right? And that has a 6 handle now. You know, we used to have a 7 handle, 8 handle, 9 handle, where we had 2.1 jobs for everybody looking for a job. It's a different picture now. People are really staying put. This conversation I just had, people are reluctant to quit. It is no longer the great resignation where everybody could resign and they could get a new job and maybe even be paid more. That is not what's happening. People are now more nervous and they're staying put. Also, you're not seeing the job openings, right? Because now you have the 6 handle versus being higher. And so there's just not many jobs out there, as many, because companies are nervous, right? They're not going to put as many out there. As far as the perspective, and I appreciate you asking, I mean, you mentioned on your show one day how we were in the trough of the great financial crisis 17 years ago. And, you know, I can't believe I was standing here in the great financial crisis 17 years ago, and everybody lost half of their money. But this market over time, through every war, through every, you know, Peter Tuchman, who's a great friend of our network, came on and he really wrapped up 2025 when I asked him. He said it was the year of resiliency. There wasn't anything that didn't have this market thrown at it, and it still came out on top. And that's sort of, you know, the great American way. And fundamentals for earnings will be my last point. A lot of the guests come on and say, look, earnings are still pretty good. I can't be too worried when earnings are still looking pretty good.
Yeah, and that's what really is carrying this market through, isn't it? And I will get to some of those earnings at the moment, but just a quick thought on that. And you say the resilience, and obviously what you've seen in the past throughout your extensive career here on the floor is that this really feels, and I think the folks over at Signio did point this out, I'm going to be speaking to them later in the show, it feels like a market that really wants to rally. And we've seen that when you've seen the sensitivity of just a few comments coming from the Trump administration, where then you've seen this rip higher in oil coming off. I think this week has been a little bit more tempered in the sort of volatile sort of swings and reactions that we've seen compared to last week. It's been a relatively calm, I would say, in reaction to that. But yeah, I mean, you're right. It has a way of sort of getting through that. And I think it speaks to some of the comments that our guests have been talking about, is that volatility can be your friend. And I think people are finding some opportunity in all of that churn under the surface.
Yeah, I mean, oil's up 7% this week. I'll go ahead and say, look, Bitcoin has been getting a bid. You know, are people looking to the safe haven of trying to, you know, look at a different way of putting their money, particularly in the Middle East? There's been talk that maybe people in the Middle East are transferring their money over to Bitcoin. That's up 4.3%. It's at 72,000. You know, there's no confirmation of that, but that was one conversation I had.
It's an interesting anecdote. Look, you mentioned the earnings. I do want to just run through some of them because, you know, really interesting as far as some of the companies that we heard from today, the reactions as well. I'm just wondering what the nature of your conversations were around a name, for instance, like Adobe, which has been, you know, obviously the latest test of what we're seeing in the software is, yes, okay, a CEO change. That seems to be the headline here. But what were your takeaways as far as what they had to say here and the reaction we've seen today?
Yeah, I mean, some of the growth that was slowed by the AI-related consumer shifts that they saw. The stock itself has been not in the AI play. It hasn't been particularly good. You know, if you look, it doesn't matter what you look at. One day, 1 week, 1 month, 1 year. down, 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 down. This has gone from $422 down to $244. And so now you have the added, question about who's going to lead this company. And so the recurring revenue growth, some of the AI jitters, RBC Capital saying that they are a little worried about a name like Adobe, but it did have some positive, points within it, and there's things to love about Adobe, but for right now, we're seeing it down 6%.
Yeah. I think they've got more to prove here. I mean, as to whether this was enough to dismiss some of the concerns out there around the broader AI disruption fears. But I want to get a couple of names as well that sort of fit with the theme that you and I were just discussing around the consumer too. I mean, a name like Ulta, a name like Lennar, who we've also heard from. I mean, very telling as to how the economy is holding up right now, particularly because everyone's wondering if Ulta will continue to benefit from the lipstick effect, where you have this pullback in discretionary spending, but people are still willing to splurge on, the makeup and the healthcare and things like that.
I love talking about Ulta because there was a time where Ulta was the market. There was a time that Crocs was the market. There was a time that Monster Beverage was the market. And it really told the story of how people were feeling, how people were spending, in the big picture. I'm going to get out of my Adobe here, but I did have RBC lowering the price target on Adobe to 400 from 430. They maintained the outperform rating, and the company did keep its full year guidance for Adobe. So it's not a terrible story. Like I said, there were some bright spots, but it had the down arrow. For Ulta, it's been the big laggard, another big laggard on the S&P 500. And the bright spots on Ulta is that, they've made acquisitions. They have the new Selena Gomez line that's doing well for them. They talked about the number of people coming in, that the transactions were up 1%, 1.5%. The average spend was up 4% on those transactions. So people are spending. And Ulta, when I looked at that chart earlier today, I couldn't believe the huge move that this stock has had. It's just been a really nice move from $300 to over $700 in 1 year. It's up 65%.
Yeah, I mean, as I said, it was that weak guidance, wasn't it, or that more conservative guidance. But it's interesting because you've had a lot of those in the business of retail, or at least sort of consumer-facing, that have kind of set themselves a lowish bar this year with a lack of visibility moving into 2026.
And I think Ulta was the better player, when you said the conservative guidance, and I think they did use the word something like cautious or something. Softer fiscal year 26 guidance. Right. And even though there were some bright spots, and the analysts thought there were, in fact, bright spots. So maybe the company is being more conservative than they need to be. I don't know. But you make the good point about guidance. It was the worst day in 2 years for Ulta Beauty when you think about it. But the big picture here is that they do have bright spots, and in fact, the analysts were talking about improved execution, key investments, the right leadership, and as I mentioned, the average ticket price is up. People are spending more, and they have more transactions. So even though they're cautious on the uncertainty, Ulta's outperforming e.l.f., Eyes, Lips, Face. It's outperforming Estee Lauder. It's a good stock. It's doing great.
And I love talking about some of these beauty names as well, just given obviously what we've seen over years with COVID, because when everyone was wearing a mask, it was all about what you were doing to your eyes. And then when you removed the mask, it was all about what you did to your lips. And now obviously you're seeing a lot of this mandate of return to the office. You wonder if people are going out and buying more makeup, or what the trend is this year. You know what I mean? It's so fascinating as far as, the cyclicality.
I know what you mean, the video.
Lennar, switching gears quite abruptly, but still consumer facing, obviously, with how people are feeling about that. I was having a fascinating chat with somebody on this show yesterday about who was so bullish, really excited about the housing market this year. Did we see that in the numbers?
Yeah, when you look at Lennar, by the way, I want to pull up the XHB just to see how that index is doing. And it's been on a complete downtrend since February. It went from $123 right now at $100 for the Home Builders Index. And Lennar also had a down arrow today. The home building story, you and I were upstairs. Both of us had noted, you were talking today how high mortgage rates went. I was saying earlier how it had a 5 handle in February. I mean, it's, are people going to be buying houses, and do we need the houses? And we just got in the mortgage apps and building permits, and we've seen some weakness there, even though there has been a little bit of movement in housing and purchasing of housing. Affordability is still very much an issue.
Yes.
And mortgage rates, as you noted today, are back to higher levels, and that's not going to boost the housing market.
No, it's not really what the doctor ordered, particularly coming into a year like this when there had been a lot more optimism, particularly around the trajectory of those rates. And then, as you say, I think it really just comes down to affordability. Margins have been a concern at some of these names as well, with, of course, the incentives to try to get people to buy more homes. But, Nicole, go start your weekend. Thank you so much for helping me unpack some of that today.
No, I enjoyed it very much.
Really appreciate it.
I had a great time. And, when I think about Ulta, is that like a necessity? Is it discretionary, or is it a real staple? Do we need it?
That
a
is
lot
a good
of folks
question.
need it. And it's,
That's right.
sort of quiet luxury. You feel great if you get a new lip gloss or something. Have a great show, Sam.
Thank you. Thank you, Nicole Petalides there from Opening Bell. All right, let's take a look at this week's rotation coming up next and where investors are putting their money to work. That's coming up next on Market on Close.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Sam Bartis. I'm joined now by our next guest, Patrick Mueller, who's the president of Bella Advisors. And thank you so much for your time, Patrick. Really appreciate you joining the show for this Friday. Look, we have seen, obviously, some caution going into the weekend, which has been typical the last few weeks, obviously, with the headlines that we learn about when the markets are closed and the markets have to react to on Monday. Just talk us through your thoughts as we approach the weekend with some of this de-risking and rotation going on right now.
Great question, Sam. Great to be with you. And we've been kind of waiting for a catalyst like this to be happening for quite some time. We've had the markets moving sideways since about early November. And we've been in this price zone, but we've been waiting to come out of it. And I think this is probably going to be the catalyst that's going to move us out of it, where the markets are going to keep continuing to push up, or we're going to start seeing a drawback. And I think that's what people can see here in the near future, is that the markets are going to start pulling back. We might see a run up here in the next week or so, but I think ultimately we're overdue for a pullback, and things have been so overweighted towards tech, and things are rebalancing right now. So I think this is a good time for people to be taking some chips off of the table and keeping some powder dry.
Okay, what's the catalyst for stepping back into the markets? I mean, once you see that pullback, because, I mean, we've seen the average member drawdown of some of these indexes in the double digits. I mean, do you wait for some of these sectors and these sort of unloved names to show a little bit of meaningful upside to then, I guess, catch on to that train, or do you just take advantage of the dip?
I think you take advantage of the dip. I think it's time to
That's right.
Like last year, Sam, we had a good year in the S&P, but you had 40% of the companies that were at a loss. and you had your top 10 companies that equated for 40% of the growth of the market last year. So things are so overweighted towards a lot of your big names, and I would be cautious of that right now and continuing to ride that train. So I personally would be taking some chips off of the table and moving things into different sectors that aren't going to be getting beat up as much in the general markets, in the S&P and the NASDAQ and Dow, and starting repositioning into different sectors.
Okay, so you're not necessarily holding on to cash, you're just rebalancing. So where are you looking? And I mean, as far as diversification, are you also giving fixed income a look, international as well?
Absolutely. International did really well last year, and so that's hard not to take a look at. But we've been repositioning a lot into fixed income, and then also sitting on about 20% in cash, so that way we can pounce when we do see a big pullback here, that we can start buying back in at a certain point and start riding that wave back up again. But some of the things that we've taken a look at, JEPI has been really good. There's a great fund from First Trust that came out, ACYN. It's a structured note ETF that's got about a 12% yield. So that has been fantastic. We're loving that. And we like that fixed income right now as we're going to be going through some of this volatility.
Okay, I mean, I'm wondering what you're thinking about, obviously, with respect to the geopolitics, but with some of the AI disruption fears in this market on top of all the headlines we've been reading about this week with respect to more red flags emerging with respect to credit risk concerns.
And as far as credit risk goes, we need to pay a lot of attention to that. We're at all-time credit card highs right now, and consumers are hurting more than it's being let on in the media right now, and people are actually refinancing their mortgages out of 2-3% mortgages, which are fantastic, and having to refi into 6-7+% mortgages just to get money out, just to stay afloat, because inflation has been such a factor over the last 4 to 5 years. The price of everything has really doubled, and even though those numbers have kind of subsided, people, I don't think, have really recovered from that, and we're really seeing that in this increasing debt. So that's another bubble that we want to be watching out for, not only the AI bubble, but this consumer debt bubble to start paying attention to.
Yeah, and this is obviously why we've seen these financials very much underperforming against other sectors really to start the year, not to mention a bit of that flattening of the yield curve, no doubt not helping. I see you mentioned utilities as well as the AI secret winner here. It's very much been seen as, obviously a de facto sort of tech play and backdoor kind of adjacent way to kind of trade this whole artificial intelligence theme. Where are you looking within utilities?
Yeah, well, Constellation has been good for utilities. We like an ETF called Grid, and to take a look at all of that infrastructure that needs to be put in place for all of these big tech companies and all the energy that's necessary. So that's going to be a huge move moving forward, is what's going to be powering all of this stuff. So that, a good play is, going towards that energy sector and looking at some of those companies and some of those ETFs. That's really going to be leading the path that way as we're seeing all these AI valuations kind of going over all the place, and we might be seeing a pullback on that, but I think the energy is going to stay strong over the next few years.
Okay, so you're looking at energy, obviously utilities, fixed income, bit of international there to diversify the portfolio. How are you thinking about some of the more consumer-facing names, just given some of the concerns out there, particularly with respect to the geopolitical situation unfolding, the energy shock, and just how people are feeling around kitchen table issues at the moment? And as Nicole Panelides and I were just discussing, this sort of low hire, low fire.
Yeah, as far as companies go right now, they're wanting to hold on to good people, and people are trying to keep that money. Companies are trying to keep that money in-house because there's a lot of uncertainty that's out there as far as where the markets are going to be going, where interest rates are going to be going, what's going to be happening around the world, like you said, geopolitically with what we've been doing in Venezuela and Iran and ultimately China and Russia, and where that's going to be going longer term. So there's just so many question marks that are out there that I think big companies are just hesitant right now, but they don't want to give up their good people. They want to be holding on to that talent. So we'll see where things swing moving forward, but it's going to be cautious, and that's why we've seen so many swings going into precious metals, whether it's gold or silver, that have been just doing a tremendous run over the last year or so.
Although they haven't been acting as a typical safe haven in the last 2 weeks, which is interesting, no doubt pressured by that stronger greenback. So obviously something to keep note of. Let's see how long that lasts, though. But you touch on a really interesting investment theme, which I've been tracking for many, many years because I've covered both sides from here and also in Asia. And that is, of course, this repatriation of jobs, manufacturing and companies. I wanted to pick your brains about how you invest as a theme around that. I mean, what companies do you look at? What ETFs are you looking at that manage to capture some of the upside and the benefits of that specifically?
Yeah, all the reshoring that's happening right now with all the tariffs and all the moves to produce goods and services here back in the country, which I think is fantastic. You want to be looking at some of those companies that are bringing things over here. So you've got like GE, you've got Apple, you've got Taiwan Semi, so you've got these different companies that are reshoring back here, and then you've got a great First Trust ETF as well. It's just tracking that. So they've got a really good ETF when it comes to tracking those companies that are going to be starting to manufacture here, and that pro-America move moving forward. But I think that's going to be a great play over the next few years.
Okay, and just as far as the tech, because I know you've written this headline that the S&P isn't the S&P 500 more, it's the S&P tech. I mean, obviously on a day like today when you've got all the Mag 7 down, obviously explains what we're seeing at a headline level. But we very much have been talking about here at the Schwab Network about how you can't be monolithic about tech right now. Which pockets excite you? Which areas do you think there are opportunity? Which do you think are areas that you would like to be a part of, because I'm thinking like memory, for instance, which has had such a big run up and you have so many people asking you questions, or is it a good time or have I missed the boat? How are you thinking about tech?
Here we are at another good spot.
Sam, about tech, because everything is so overweighted towards tech, and there's so much money that has been fueling that, and all of that excess money is going to be coming to a halt probably, I would say around summertime. And they're going to start have to post earnings, right, to back up all of these moves that they're making and throwing all this money into tech right now. So I'm really taking an opposite standpoint and not trying to be overweight in tech, being very cautious, looking at, companies that are reshoring and manufacturing here in the country, looking at energy, looking at defense stocks right now, and ETFs right now can be a good move. So looking at those different avenues versus tech, and then I'm also a big, on value, which has not been getting rewarded lately. So when things start turning, you'll start seeing a flip towards value where you got big companies that are doing good, paying out good dividends, and, hard to ignore companies like, Burke B shares. So those types of plays I really like. And then also, there's never a better time when markets are at an all-time high, Sam, to take some profits. Take some of that off of the table, declare victory, and then wait for those opportunities to present themselves in the next few months.
Yeah, it's interesting. It just feels like it's week by week. The pendulum continues to swing between value and growth and, between some of the dispersion we've seen between tech as well, softwares and semis. But, I mean, maybe it's just a short attention span of these markets. We'll have to wait and see. Patrick, lovely speaking to you. Happy Friday. Have a great weekend. We'll catch you next time. Thanks so much. Patrick Mueller there, RFC and President Bella Advisors. Coming up next, we will discuss the impact of the US and Iran war and if now is the time to buy the dip. That's coming up next on Market on Close.
Trying to reverse. It looked like a good spot when I showed up. I'm a spy.
Don't stop when the market dips.
SPX.
So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you know, you could have done better. The same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. So we remember when Chairman Powell and President Trump were wearing the hard hats and walking through the building with that awkward exchange? Well, we have an update and some breaking news on that situation. A federal judge now throwing out a pair of subpoenas the Justice Department had issued to the Federal Reserve, handing a victory now to the Fed and dealing a heavy blow to that U.S. attorney. So I'm just reading from the Journal here on this news that the U.S. District Judge James Boasberg in a decision unsealed on Friday, ruled the subpoenas were improper. So this is according to court filings just coming out now, saying that there is abundant evidence that the subpoena's dominant purpose is to harass and pressure Powell either to yield to the president or to resign and make way for a Fed chair who will that is the end of the sentence, in fact. So we have seen a win, it seems, like for Federal Reserve, with the judge throwing out the Justice Department subpoenas here. So we will continue to track this news, obviously, as we approach the FOMC next week. So a bit of breaking news there as we have been tracking, of course, this subpoena in the courts over the last couple of months or so, when we do, of course, remember that awkward exchange. All right, welcome back to Market on Close. I'm Sam Vardis. Let's bring in our next guest now, Ahmed Riesgo, Chief Investment Officer at Signio. Ahmed, look, I've heard you talking in recent days about how for this market right now, it feels like Iran first and everything second. Is that really the case here?
Yeah, it's going to be really tough for the market to really get its footing. Remember, the fundamentals of the economy still are pretty solid. There's been some weakening, but overall, the U.S. economy and the global economy, to be quite frank, is in decent shape. So really, the duration of this conflict is really what's going to determine, I think, the near-term move in markets, right?
Yeah, exactly. And I know that you've also said this feels like a market that wants to rally. And, you know, obviously that's been evident. I was talking to Nicole Petalides at the top of the show about that with respect to these little fits and starts we've seen. I mean, any little slight mention of the potential for how long this is actually going to drag on for, coming from whether it's a Trump Truth Social post or the administration themselves, the White House. It does have a market implication, just that I suppose highlights the sensitivity here. Just talk us through your thoughts right now, given just how headline-driven this market is.
Very headline-driven.
The market investors have seen this movie before, right? So we've seen sort of Trump
we got the pullback
scenarios now escalate to the point where things look like they're really going to
still ain't really broke out
that position. So obviously the market's expecting that same playbook to play itself out here. Remember, the S&P is only down, I think, less than 5% from the high in late January. So certainly, if this were to turn or take a turn for the worse, which is not our base case, you will have further drawdowns, much farther lower than where we are today.
What are you telling clients about how to hedge in this kind of environment? I mean, you know, as far as either taking advantage of the volatility or just waiting it out?
Yeah, so it's mostly wait and see now. I will say that we're doing that because we did hedge the portfolios beforehand. So starting in early February, we started buying tactically long oil positions. So what we advise clients to do here over the past couple of days is to start trimming some of those hedges in the expectation that we've already accumulated the returns and that this would be a sort of a slow trickle down. But notice what I said, only half the hedges have come off, because I still think we are likely, perhaps even likely, to see some further volatility here, perhaps an oil price spike that will really lead to the de-escalation, which is what everyone is expecting.
Yeah, I'm wondering if you could sort of talk us through what you're seeing as far as the greenback. I mean, Ahmed, I had a conversation today and I thought it was fascinating. Are we seeing a dollar carry trade unwind here? Just given the performance of the greenback last year, where we're starting to see perhaps what was bought then starting to unravel. And I'm talking about, obviously the performance we've seen in, say, metals, which haven't acted as typically they would in a sort of safe haven type trade.
Yeah, we don't really think so. We think this is more on terms of trade, not to be repetitive. But remember, all these commodities are priced in dollars. And the world realizes quite correctly that the U.S. would fare a lot better than most other economies. In fact, we are modeling that even if oil were to go up, over $120 a barrel for an extended period of time, it probably wouldn't lead the U.S. into a recession. It could get close, but the U.S. is very much insulated, especially vis-a-vis other economies like Japan, South Korea, which are much more highly tethered to the price of oil. So my point is that a lot of this move has been the up move in these commodities, which are priced in dollars. We think this is a short-term move in the dollar in terms of dollar appreciation. We think once this blows over, I think you're likely to see that a trend downward in the dollar reassert itself.
Okay, and as far as the macro picture is concerned, Ahmed, I'm just wondering what the biggest fear is here. I mean, with this energy shock, how are you thinking about it in light of some of the data we got today as well?
Yeah, so I think that the potential fear is that the labor data we've received lately, that the January print ends up being the anomaly and not the trend.
I'd take his trade right here if I had no.
January print was a strong one. The one we got more now for February was not. So our fear is that you might be in a situation where the Fed's actually going to have to start cutting rates quite aggressively because that labor market deteriorates. And obviously a shock, the longer it lasts, the more likely it could actually lead to that outcome. So I know that the market recently here has gone the other way. We've priced out one rate cut since the hostilities began. But in my mind, the asymmetry lies in the other direction, which is that the economic picture deteriorates further and the Fed actually has to come in and cut, but cut for the wrong reason. Cut because inflation's coming down, but because the economy is weakening and the labor market is weakening a lot further.
Yeah, it's a tricky balancing act. I'm just wondering, away from the macro conversation, I like how you framed it. Remember AI? Obviously, we've seen this rotation back into some of these more growthier type names. Seeing a sell-off
Jimmy
today.
didn't dig it.
I was reading a fascinating article out of Bloomberg, actually, just in the last 24 hours, which has been looking into quarterly filings and, obviously some of the hidden costs now with respect to some of the future contracts and the leasing commitments of these hyperscalers not being reflected on the balance sheets yet because they don't show up until the payments start. How are you thinking about this whole AI trade?
So we are starting to think of it not as a single AI trade, but a series of trades. And I think you've seen some bifurcation in the market here, right? Like a few weeks ago, remember, software was coming down quite strongly, but the hardware trade was up. So I think you're going to have to start distinguishing between sectors. Now, on the hyperscalers, we think, and we've been saying this for a while, we don't think growth in the portfolio is going to come from these names. We think these names are going to become a lot more like utilities. We think that they're going to become the defensive sectors of client portfolios, meaning you want to hold them, especially you want to overweight them when things are going bad in the world, when there is a recession, because their earnings will be a lot more insulated from activity. But we don't think the growth is going to be coming from these names, right? I think one of the biggest mistakes that investors make is that they expect the trends of the last 10 years to continue going forward. And we see that that's just not the case. That's not how history works. What we tend to see is that every decade sort of has its own theme. And the hyperscalers was last 10 years theme. Now we're sort of looking for where that next theme is coming from, but we don't think it's coming from the hyperscalers.
Right, it's what they're projecting. It's the capex itself, the money that they're spending, that's the stimulative part that's going out into the broader economy, and then it has that trickle-down effect as to why you're seeing industrials, materials, and all the utilities rallying as well as part of a sort of adjacent theme. I got you. Really fascinating chat, Ahmed. I'm going to let you go and start your weekend. Really appreciate it. Thanks so much for joining us. Happy Friday to you, Ahmed Riesgo, who's the Chief Investment Officer over Insignio. Coming up, it's time for Options Corner. Rick Ducat will join me to walk through the options activity on SanDisk today as the memory stock has gained almost 20% just this week. That's next on Market on Close.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
We're back here on Market on Close. It's time now for Options Corner. So Rick Ducat is joining me, lead market technician. Hello to you, Rick. We're looking at SanDisk today. I mean, this has just been on its head. I mean, out of this world. So just tell me how it stands up to the rest of its peers, because I think they're all along for the ride, but just talk to us about SanDisk.
Yes, of course, and you can see from our comparison chart here, SanDisk just has blown away the rest of the market and the tech sector here. I mean, it's up over 1,265% during the past 52 weeks, so really explosive push to the upside here. And, the memory sector of the semiconductor group is the strongest of the strong, so to speak. This blue line here is the likes of Micron, Seagate, Western Digital, and SanDisk. Everything else is, left in the dust. I mean, even the next best sector is only up 107% versus the memory area of 543% roughly here. So very strong performance. And specifically SanDisk, not really a lot of news today specific to this company here. We do have Micron earnings coming up soon though, so this seems to be perhaps some sympathy activity, perhaps a resurgence after a bit of a drawdown following some notable highs in a rough period for the market.
Just talk us through the technicals on SanDisk specifically then. As you say, no major catalyst today, but very much outperforming in what is otherwise a down market here.
Yes, for sure. So when we look at our price activity recently, you can see we had a very sharp rally starting at this point late last year. It took us all the way up to these highs near 725. From that point, we're only down about 9% or so now. So we can see that after this very steep rally, we had an interesting type of price activity here that many traders traders often look for. We had a period of sideways to downward consolidation that took us back to a supportive area here around 540 roughly, and now we are pushing back to the upside. We have broken above our white trend line here, starting with those highs as well. So some notable activity here. The next step for the bulls would be to take out these best, the closing high that we saw here near about 695, and eventually those intraday highs near 725. Some notable low points of support, 572 and around 540 here marked some low points on our journey to the upside here. When we look at our moving averages, we have, after a period of some declines here, our price activity has closed back above our moving averages. The moving averages are once again sloping to the upside here. So the short-term 5-day EMA comes in right around 630 or so. So that could be one area to watch to the downside. RSI also improving here. We can see that our downward sloping trend line has been broken, and we've pushed above the 50 midline once more. Finally, our volume profile study shows most of the recent trading activity is concentrated between about 570 to 670 or so. So a 100-point range is where we've seen the bulk of our price action here. Another smaller pocket comes in down here near about the 500 level or so.
Okay. And as far as options activity, what are you seeing with this name?
Today's sizzle is about 1.93, so 1.93 times the 5-day moving average of options volume, so a heavier than average day. We can see that we saw about 200,000 or so options changing hands here. The most active month for open interest is our monthly expiration on March 20th, coming up next week here, about 25% of all activity there. One particularly large trade that really kind of made me raise my eyebrows here, plus 15 or minus 1,500, excuse me, June 17th, 2027, 1,000 strike calls, $26.3 million credit received. It was an opening trade here, so some short calls, perhaps some kind of very large covered call position.
And any notable trades catch your eye today, Rick?
Well, you know, we did have that one there, and we also saw a lot of activity in the March 13th expiration, which was today. So beyond that, though, January 2027, about 14% of all activity took place there.
All right, great stuff. Rick, really appreciate it. Thanks so much for that. That is Rick Ducat there. Moving on, and coming up, it's time for Overlooked Stocks. George Sillis has his eye on American public education. Heading into the close, as shares hit an all-time high today. We'll break down the news about that one when Market on Close returns.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
How's it going? First day, so...
Sometimes, you know...
Next. Try it again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Welcome to Schwab Network.
where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. We are approaching the close of trade here, but just for now, let's turn our focus to news overseas. A surprise start to the year for the UK economy, unexpectedly stalling in January, even before the energy shock caused by the Iran war. GDP failed to grow during the month compared to a slight rise in December. Economists had been expecting a marginal uptick of 0.2% for the month. Economists highlight the challenge now is the little momentum the economy had going into the energy crisis. The pound slipped following the data, but the interesting move was in the gilts market.
You got 8 minutes to do it. I don't think we can do it in 8 minutes.
To its highest level in months.
Let's break the 21.
Rise as well.
We can break it, but
next week. Keeping an eye on the Japanese yen as well.
Be a couple big fat candles up here.
Levels since mid-2024 amid the dollar strength at about 159. What's notable is that is close to levels where authorities have previously stepped in to support the currency and limit the weakness. Officials have said that they would refrain from commenting on intervention.
66.30s.
Also with the US, the BOJ will also hold its meeting next week. It's expected to hold and sit on its hands.
$3.40 maybe?
Is reportedly getting access to NVIDIA chips. The Wall Street Journal saying TikTok's parent company is assembling computing power with NVIDIA chips outside of China, working with a Southeast Asian company called Alani Cloud to use Blackwell systems in Malaysia. And it plans to use the computing power for AI R&D to meet rise in demand. All right, we are nearing the end of the
Always clean, may help you.
here, so on the other side, we will bring in Kevin Green to break down the levels that he's watching on the S&P 500 and break down today's action coming up next on Market Focus.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next in investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you know, you could have done better. The same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Very good.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
We're back here on Market on Close. I'm Sam Vardis on the floor of the New York Stock Exchange. We've just got a few minutes left in today's session and for the week, so let's welcome in Kevin Green, Senior Markets Correspondent, to help close out the session. KG, interesting day, a lot of caution going into the weekend, as we've typically seen in these last few weeks. This would be obviously marking the third week of losses here, holding above that 200-day moving average, I believe. I know 6,700 was technically important, but what are you watching right now?
Well, it seems like, 20 points away from the 200-day moving average. At this point, you kind of want to rip the Band-Aid off and try to attempt it and see if some buyers really try to step in here. We started off today actually really strong. We actually had over 90% of stocks in the S&P 500 in the green. We're sitting at around 52-53% right now, so we did lose a little bit of traction, and it's a little bit more defensive in nature. So 6,600 is obviously going to be the next major area of support. We were trying to hold 6,660. We consolidated around that level for about an hour and a half, 2 hours before the flush or that move to the downside. Obviously, the market's really focusing on the geopolitical risk over the weekend. The news reports around potentially having Marines being deployed, additional Marines being deployed within the region, is spooking investors as well as traders, and the unknown that we have given this conflict. So we are seeing some selling activity taking place, and going into the close, if we can hold 6,600, I think that would be kind of a win, but I would rather see us actually test that moving average and then see what happens after the fact. The E-mini S&P 500 futures has pretty much already tested the 200-day moving average, and actually that happened 2 days ago, which we saw a little bit of a bounce or a reaction to the upside before once again kind of failing and retesting this again. So not a really good day, not a really good week. Hopefully we do see a turnaround, Sam, given the fact that this is a kind of a de-risking, a slow de-risking environment that we've experienced over the last month and a half.
Yeah, some of the traders I've been talking to here on the floor over the last couple of weeks have said, obviously going into the weekend, there's been a feeling of not wanting to really hold on to stocks, just because, of course, what can happen while the markets are closed, and why we see perhaps some of this, de-risking going into the weekend. But no doubt pressuring things today, that stronger dollar at 100 for the Dixie. Just talk us through that.
Yeah, this is actually an interesting chart setup. Now, obviously, we have been backing off Fed rate cut expectations for the remainder of the year, and that is one of the reasons why we were seeing a stronger dollar on top of the geopolitical risk. But this 100 level is going to be a key area of resistance. Do we actually see failure next week and kind of reverse some of this bullish trend, or does this actually continue, and do we start seeing the dollar index going around that 103 level? I think that's going to be very critical, not only for the critical metal space, not only for oil, but also for equities. So this is going to be a little bit more of a headwind rather than a tailwind for markets, and kind of out of the ordinary. Now, we do have the Fed meeting on Wednesday of next week. We will get an updated summary of economic projections, and let's see if these Fed members are really trying to back out these Fed cuts for the rest of the year, or do we actually see them kind of holding their expectations like we saw at the previous summary of economic projections. I think that's going to be the telltale sign. And any type of resolution,
being extra cautious these days,
the dollar kind of reverse, and that could also once again be a little bit more of a tailwind for equities. But this is a very strong reversal, something you cannot ignore.
Yeah, for sure, for sure. I mean, we obviously started to see that reversal mid-morning as that dollar picked up. We saw oil picking up, the VIX is, off the lows, or picking up as well, I should say.
Have a great NVIDIA weekend, baby. Well, I'm going to get out of here and enjoy my weekend. I expect you all to do the same. Let's have a good week next week. Kind of semi this week.